Introduction. What this book expects to accomplish. Purpose of this book is to supply, in a form suitable for laymen, guidance in the adoption and execution of an investment policy. Comparatively little will be said here about the technique of analyzing securities. Attention will be paid chiefly to investment principles and investors' attitudes. We shall, however, provide a number of condensed comparisons of specific securities, chiefly in pairs appearing side by side in the New York Stock Exchange list, in order to bring home in concrete fashion the important elements involved in specific choices of common stocks. But much of our space will be devoted to the historical patterns of financial markets, in some cases running back over many decades. To invest intelligently in securities, one should be forearmed with an adequate knowledge of how the various types of bonds and stocks have actually behaved under varying conditions, some of which, at least, one is likely to meet again in one's own experience. No statement is more true and better applicable to Wall Street than the famous warning of Centaury. Those who do not remember the past are condemned to repeat it. Our text is directed to investors as distinguished from speculators, and our first task will be to clarify and emphasize this now all but forgotten distinction. We may say at the outset that this is not a how to make a million book. There are no sure and easy paths to riches on Wall Street or anywhere else. It may be well to point up what we have just said by a bit of financial history, especially since there is more than one moral to be drawn from it. In the climactic year 1929, John J. Raskob, a most important figure nationally as well as on Wall Street, extolled the blessings of capitalism in an article in the Ladies' Home Journal entitled "Everybody Ought to Be Rich." His thesis was that savings of only $15 per month invested in good common stocks with dividends reinvested would produce an estate of $80,000 in 20 years against total contributions of only $3,600. If the General Motors tycoon was right, this was indeed a simple road to riches. How nearly right was he? Our rough calculation based on assumed investment in the 30 stocks making up the Dow Jones Industrial Average GIA indicates that if Raskob's prescription had been followed during 1929 to 1948, the investors' holdings at the beginning of 1949 would have been worth about $8,500. This is a far cry from the great man's promise of $80,000, and it shows how little reliance can be placed on such optimistic forecasts and assurances. But as an aside, we should remark that the return actually realized by the 20-year operation would have been better than 8% compounded annually, and this despite the fact that the investor would have begun his purchases with the GIA at 300 and ended with a valuation based on the 1948 closing level of 177. This record may be regarded as a persuasive argument for the principle of regular monthly purchases of strong common stocks through thick and thin, a program known as dollar cost averaging. Since our book is not addressed to speculators, it is not meant for those who trade in the market. Most of these people are guided by charts or other largely mechanical means of determining the right moments to buy and sell. The one principle that applies to nearly all these so-called technical approaches is that one should buy because a stock or the market has gone up, and one should sell because it has declined. This is the exact opposite of sound business sense everywhere else, and it is most unlikely that it can lead. Torskob 1879195 was a director of DuPont, the giant chemical company, and chairman of the finance committee at General Motors. He also served as national chairman of the Democratic Party and was the driving force behind the construction of the Empire State Building. Calculations by finance professor Jeremy Siegel confirmed that Raskob's plan would have grown to just under $9,000 after 20 years, although inflation would have eaten away much of that gain. For the best recent look at Raskob's views on long-term stock investing, see the essay by financial advisor William Bernstein at www.efficientfrontier.com/ef/197/ or askob.htm. Lasting success on Wall Street. In our own stock market experience and observation, extending over 50 years, we have not known a single person who has consistently or lastingly made money by thus following the market. We do not hesitate to declare that this approach is as fallacious as it is popular. We shall illustrate what we have just said, though. Of course, this should not be taken as proof by a later brief discussion of the famous Dow theory for trading in the stock market. Since its first publication in 1949, revisions of The Intelligent Investor have appeared at intervals of approximately 5 years. In updating the current version, we shall have to deal with quite a number of new developments since the 1965 edition was written. These include 1. An unprecedented advance in the interest rate on high-grade bonds. 2. a fall of about 35% in the price level of leading common stocks, ending in May 1970. This was the highest percentage decline in some 30 years. Countless issues of lower quality had a much larger shrinkage. 3. A persistent inflation of wholesale and consumers' prices, which gained momentum even in the face of a decline of general business in 1970. 4. The rapid development of conglomerate companies, franchise operations, and other relative novelties in business and finance. These include a number of tricky devices such as letter stock, proliferation of stock option warrants, misleading names, use of foreign banks, and others, plus Graham's brief discussion is in 2 parts on P33 and PP 191192. For more detail on the Dow theory, see http://viking.som.yale.edu/will/dow/dowpage.html. Plus, mutual funds bought letter stock in private transactions, then immediately revalued these shares at a higher public price. See Graham's definition on P 579. That enabled these go-go funds to report unsustainably high returns in the mid-1960s. The U.S. Securities and Exchange Commission cracked down on this abuse in 1969, and it is no longer a concern for fund investors. Stock option warrants are explained in Chapter 16. 5. Bankruptcy of our largest railroad, excessive short and long-term debt of many formerly strongly entrenched companies, and even a disturbing problem of solvency among Wall Street houses. 6. The advent of the performance vogue in the management of investment funds, including some bank-operated trust funds, with disquieting results. These phenomena will have our careful consideration, and some will require changes in conclusions and emphasis from our previous edition. The underlying principles of sound investment should not alter from decade to decade, but the application of these principles must be adapted to significant changes in the financial mechanisms and climate. The last statement was put to the test during the writing of the present edition, the first draft of which was finished in January 1971. At that time, the GIA was in a strong recovery from its 1970 low of 632 and was advancing toward a 1971 high of 951 with attendant general optimism. As the last draft was finished, in November 1971, the market was in the throes of a new decline, carrying it down to 797 with a renewed general uneasiness about its future. We have not allowed these fluctuations to affect our general attitude towards sound investment policy, which remains substantially unchanged since the first edition of this book in 1949. The extent of the market's shrinkage in 1969-70 should have served to dispel an illusion that had been gaining ground during the past 2 decades. This was that leading common stocks could be bought at any time and at any price, with the assurance not only of ultimate profit, but also that any intervening loss would soon be recouped by a renewed advance of the market to New High Lev, the Penn Central Transportation Co., then the biggest railroad in the United States, sought bankruptcy protection on June 21st, 1970, shocking investors who had never expected such a giant company to go under. CP 423. Among the companies with excessive debt Graham had in mind were Ling Temkava and National General Corp. CPP 425 and 463. The problem of solvency on Wall Street emerged between 1968 and 1971 when several prestigious brokerages suddenly went bust. What this book expects to accomplish us. That was too good to be true. At long last, the stock market has returned to normal in the sense that both speculators and stock investors must again be prepared to experience significant and perhaps protracted falls as well as rises in the value of their holdings. In the area of many secondary and third-line common stocks, especially recently floated enterprises, the havoc wrought by the last market break was catastrophic. This was nothing new in itself. It had happened to a similar degree in 1961-62, but there was now a novel element in the fact that some of the investment funds had large commitments and highly speculative and obviously overvalued issues of this type. Evidently, it is not only the tyro who needs to be warned that while enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster. The major question we shall have to deal with grows out of the huge rise in the rate of interest on first-quality bonds. Since late 1967, the investor has been able to obtain more than twice as much income from such bonds as he could from dividends on representative common stocks. At the beginning of 1972, the return was 7.19% on highest grade bonds versus only 2.76% on industrial stocks. This compares with 4.4% and 2.92% respectively at the end of 1964. It is hard to realize that when we first wrote this book in 1949, the figures were almost the exact opposite. The bonds returned only 2.66% and the stocks yielded 6.82%. In previous editions, we have consistently urged that at least 25% of the conservative investor's portfolio be held in common stocks, and we have favored in general a 50-50 division between the two media. We must now consider whether the current great advantage of bond yields over stock yields would justify an all-bond policy until a more sensible relationship returns, as we expect it will. Naturally, the question of continued inflation will be of great importance in reaching our decision here. A chapter will be devoted to this discussion. See Chapter 2. As of the beginning of 2003, U.S. Treasury bonds maturing in 10 years yielded 3.8%, while stocks as measured by the Dow Jones Industrial Average yielded 1.9%. Note that this relationship is not all that different from the 1964 figures that Graham cites. The income generated by top-quality bonds has been falling steadily since 1981. In the past, we have made a basic distinction between two kinds of investors to whom this book was addressed: the defensive and the enterprising. The defensive or passive investor will place his chief emphasis on the avoidance of serious mistakes or losses. His second aim will be freedom from effort, annoyance, and the need for making frequent decisions. The determining trait of the enterprising or active or aggressive investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average. Over many decades, an enterprising investor of this sort could expect a worthwhile reward for his extra skill and effort in the form of a better average return than that realized by the passive investor. We have some doubt whether a really substantial extra recompense is promised to the active investor under today's conditions. But next year or the years after may well be different. We shall accordingly continue to devote attention to the possibilities for enterprising investment as they existed in former periods and may return. It has long been the prevalent view that the art of successful investment lies first in the choice of those industries that are most likely to grow in the future, and then in identifying the most promising companies in these industries. For example, smart investors or their smart advisors would long ago have recognized the great growth possibilities of the computer industry as a whole and of international business machines in particular, and similarly for a number of other growth industries and growth companies. But this is not as easy as it always looks in retrospect. To bring this point home at the outset, let us add here a paragraph that we included first in the 1949 edition of this book. Such an investor may, for example, be a buyer of air transport stocks because he believes their future is even more brilliant than the trend the market already reflects. For this class of investor, the value of our book will lie more in its warnings against the pitfalls lurking in this favorite investment approach than in any positive technique that will help him along his path. Air transport stocks, of course, generated as much excitement in the late 1940s and early 1950s as internet stocks did a half-century later. Among the hottest mutual funds of that era were aeronautical securities, and this book expects to accomplish the pitfalls have proved particularly dangerous in the industry we mentioned. It was, of course, easy to forecast that the volume of air traffic would grow spectacularly over the years. Because of this factor, their shares became a favorite choice of the investment funds. But despite the expansion of revenues at a pace even greater than in the computer industry, a combination of technological problems and overexpansion of capacity made for fluctuating and even disastrous profit figures. In the year 1970, despite a new high in traffic figures, the airline sustained a loss of some $200 million for their shareholders. They had shown losses also in 1945 and 1961. The stocks of these companies once again showed a greater decline in 1969-70 than did the general market. The record shows that even the highly paid full-time experts of the mutual funds were completely wrong about the fairly short-term future of a major and non-esoteric industry. On the other hand, while the investment funds had substantial investments and substantial gains in IBM, the combination of its apparently high price and the impossibility of being certain about its rate of growth prevented them from having more than, say, 3% of their funds in this wonderful performer. Hence, the effect of this excellent choice on their overall results was by no means decisive. Furthermore, many if not most of their investments in computer industry companies other than IBM appear to have been unprofitable. From these two broad examples, we draw two morals for our readers. 1. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. 2. The experts do not have dependable ways of selecting and concentrating on the most promising companies in the most promising industries. Missiles, rockets, jets, and automation fund. They, like the stocks they owned, turned out to be an investing disaster. It is commonly accepted today that the cumulative earnings of the airline industry over its entire history have been negative. The lesson Graham is driving at is not that you should avoid buying airline stocks, but that you should never succumb to the certainty that any industry will outperform all others in the future. The author did not follow this approach in his financial career as fund manager, and he cannot offer either specific counsel or much encouragement to those who may wish to try it. What then will we aim to accomplish in this book? Our main objective will be to guide the reader against the areas of possible substantial error and to develop policies with which he will be comfortable. We shall say quite a bit about the psychology of investors. For indeed, the investor's chief problem and even his worst enemy is likely to be himself. The fault, dear investor, is not in our stars and not in our stocks, but in ourselves. This has proved the more true over recent decades as it has become more necessary for conservative investors to acquire common stocks and thus to expose themselves willy-nilly to the excitement and the temptations of the stock market. By arguments, examples, and exhortation, we hope to aid our readers to establish the proper mental and emotional attitudes toward their investment decisions. We have seen much more money made and kept by ordinary people who were temperamentally well suited for the investment process than by those who lacked this quality, even though they had an extensive knowledge of finance, accounting, and stock market lore. Additionally, we hope to implant in the reader a tendency to measure or quantify. For 99 issues out of 100, we could say that at some price they are cheap enough to buy, and at some other price they would be so dear that they should be sold. The habit of relating what is paid to what is being offered is an invaluable trait in investment. In an article in a women's magazine many years ago, we advised the readers to buy their stocks as they bought their groceries, not as they bought their perfume. The really dreadful losses of the past few years and on many similar occasions before were realized in those common stock issues where the buyer forgot to ask how much. In June 1970, the question how much could be answered by the magic figure 940, the yield obtainable on new offerings of high-grade public utility bonds. This has now dropped to about 7.3%, but even that return tempts us to ask, why give any other answer? But there are other possible answers, and these must be carefully considered. Besides which, we repeat that both we and our readers must be prepared in advance for the possibly quite different conditions of, say, 1973 to 1977. We shall therefore present in some detail a positive program for common stock investment, part of which is within the purview of both classes of investors and part is intended mainly for the enterprising group. Strangely enough, we shall suggest as one of our chief requirements here that our readers limit themselves to issues selling not far above their tangible asset value. The reason for this seemingly outmoded counsel is both practical and psychological. Experience has taught us that while there are many good growth companies worth several times net assets, the buyer of such shares will be too dependent on the vagaries and fluctuations of the stock market. By contrast, the investor in shares, say, of public utility companies at about their net asset value can always consider himself the owner of an interest in sound and expanding businesses acquired at a rational price regardless of what the stock market might say to the contrary. The ultimate result of such a conservative policy is likely to work out better than exciting adventures into the glamorous and dangerous fields of anticipated growth. The art of investment has one characteristic that is not generally appreciated. A creditable, if unspectacular, result can be achieved by the lay investor with a minimum of effort and capability, but to improve this easily attainable standard requires much application and more than a trace of wisdom. If you merely try to bring just a little extra knowledge and cleverness to bear upon your investment program, instead of realizing a little better than normal results, you may well find that you have done worse. Since anyone by just buying and holding a representative list can equal the performance of the market averages, it would seem a comparatively simple matter to beat the averages, but as a matter of fact, the proportion of smart people who try this and fail is surprisingly large. Even the majority of the investment funds, with all their experienced personnel, have not performed so well. Tangible assets include a company's physical property like real estate, factories, equipment, and inventories, as well as its financial balances such as cash, short-term investments, and accounts receivable. Among the elements not included in tangible assets are brands, copyrights, patents, franchises, goodwill, and trademarks. To see how to calculate tangible asset value, see footnote T on page 198. Over the years, as has the general market. Allied to the foregoing is the record of the published stock market predictions of the brokerage houses, for there is strong evidence that their calculated forecasts have been somewhat less reliable than the simple tossing of a coin. In writing this book, we have tried to keep this basic pitfall of investment in mind. The virtues of a simple portfolio policy have been emphasized: the purchase of high-grade bonds plus a diversified list of leading common stocks which any investor can carry out with a little expert assistance. The adventure beyond this safe and sound territory has been presented as fraught with challenging difficulties, especially in the area of temperament. Before attempting such a venture, the investor should feel sure of himself and of his advisors, particularly as to whether they have a clear concept of the differences between investment and speculation and between market price and underlying value. A strong-minded approach to investment, firmly based on the margin of safety principle, can yield handsome rewards. But a decision to try for these emoluments rather than for the assured fruits of defensive investment should not be made without much self-examination. A final retrospective thought. When the young author entered Wall Street in June 1914, no one had any inkling of what the next half-century had in store. The stock market did not even suspect that a world war was to break out into months and close down the New York Stock Exchange. Now, in 1972, we find ourselves the richest and most powerful country on earth, but beset by all sorts of major problems and more apprehensive than confident of the future. Yet, if we confine our attention to American investment experience, there is some comfort to be gleaned from the last 57 years. Through all their vicissitudes and casualties, as earth-shaking as they were unforeseen, it remained true that sound investment principles produce generally sound results. We must act on the assumption that they will continue to do so. Note to the reader: this book does not address itself to the overall financial policy of savers and investors. It deals only with that portion of their funds which they are prepared to place in marketable or redeemable securities, that is, in bonds and stocks. What this book expects to accomplish. Consequently, we do not discuss such important media as savings and time deposits, savings and loan association accounts, life insurance, annuities, and real estate mortgages or equity ownership. The reader should bear in mind that when he finds the word now or the equivalent in the text, it refers to late 1971 or early 1972. Commentary on the introduction. If you have built castles in the air, your work need not be lost. That is where they should be. Now put the foundations under them. Henry David Thoreau, while didn't otice that Graham announces from the start that this book will not tell you how to beat the market. No truthful book can. Instead, this book will teach you 3 powerful lessons: how you can minimize the odds of suffering irreversible losses, how you can maximize the chances of achieving sustainable gains, how you can control the self-defeating behavior that keeps most investors from reaching their full potential. Back in the boom years of the late 1990s, when technology stocks seemed to be doubling in value every day, the notion that you could lose almost all your money seemed absurd. But by the end of 2002, many of the .com and telecom stocks had lost 95% of their value or more. Once you lose 95% of your money, you have to gain 1,900% just to get back to where you started. Taking a foolish risk can put you so deep in the hole that it's virtually impossible to get out. That's why Graham constantly emphasizes the importance of avoiding losses, not just in chapters 6, 14, and 20, but in the threads of warning that he has woven throughout his entire text. But no matter how careful you are, the price of your investments will go down from time to time. While no one can eliminate that risk, to put this statement in perspective, consider how often you are likely to buy a stock at $30 and be able to sell it at $600. Commentary on the introduction will show you how to manage it and how to get your fears under control. Are you an intelligent investor? Now let's answer a vitally important question. What exactly does Graham mean by an intelligent investor? Back in the first edition of this book, Graham defines the term, and he makes it clear that this kind of intelligence has nothing to do with IQ or SAT scores. It simply means being patient, disciplined, and eager to learn. You must also be able to harness your emotions and think for yourself. This kind of intelligence, explains Graham, is a trait more of the character than of the brain. There's proof that high IQ and higher education are not enough to make an investor intelligent. In 1998, Long-Term Capital Management LP, a hedge fund run by a battalion of mathematicians, computer scientists, and 2 Nobel Prize-winning economists, lost more than $2 billion in a matter of weeks on a huge bet that the bond market would return to normal. But the bond market kept right on becoming more and more abnormal, and LTM had borrowed so much money that its collapse nearly capsized the global financial system. And back in the spring of 1720, Sir Isaac Newton owned shares in the South Sea Company, the hottest stock in England. Sensing that the market was getting out of hand, the great physicist muttered that he could calculate the motions of the heavenly bodies, but not the madness of the people. Newton dumped his South Sea shares, pocketing a 100% profit totaling £7,000. But just months later, swept up in the wild enthusiasm of the market, Newton jumped back in at a much higher price and lost £20,000 or more than $3 million in today's money. For the rest of his life, he forbade anyone to speak the words South Sea in his presence. Benjamin Graham, the intelligent investor Harper and Row, won 9 for 9, Pete 4. A hedge fund is a pool of money, largely unregulated by the government, invested aggressively for wealthy clients. For a superb telling of the LTM story, see Roger Lowenstein, When Genius Failed Random House, 2000. John Carswell, The South Sea Bubble Crescent Press, London, 1960, pp. 131-199. Also see www.harvard-magazine.com/issue/MJ99/damn-D. Hummel. Commentary on the introduction. Sir Isaac Newton was one of the most intelligent people who ever lived, as most of us would define intelligence. But in Graham's terms, Newton was far from an intelligent investor. By letting the roar of the crowd override his own judgment, the world's greatest scientist acted like a fool. In short, if you failed at investing so far, it's not because you're stupid. It's because, like Sir Isaac Newton, you haven't developed the emotional discipline that successful investing requires. In Chapter 8, Graham describes how to enhance your intelligence by harnessing your emotions and refusing to stoop to the market's level of irrationality. There you can master his lesson that being an intelligent investor is more a matter of character than brain. A chronicle of calamity. Note, let's take a moment to look at some of the major financial developments of the past few years. 1. The worst market crash since the Great Depression, with U.S. stocks losing 50.2% of their value or $7.4 trillion between March 2000 and October 2002. 2. Far deeper drops in the share prices of the hottest companies of the 1990s, including AOL, Cisco, JDS Uniphase, Lucent, and Qualcomm, plus the utter destruction of hundreds of internet stocks. 3. Accusations of massive financial fraud at some of the largest and most respected corporations in America, including Enron, Tyco, and Xerox. 4. The bankruptcies of such once glistening companies as Conseco, Global Crossing, and WorldCom. 5. Allegations that accounting firms cooked the books and even destroyed records to help their clients mislead the investing public. 6. Charges that top executives at leading companies siphoned off hundreds of millions of dollars for their own personal gain. 7. Proof that security analysts on Wall Street praised stocks publicly but admitted privately that they were garbage. 8. A stock market that, even after its blood-curdling decline, seems overvalued by historical measures, suggesting to many experts that stocks have further yet to fall. Commentary on the introduction. 9. A relentless decline in interest rates that has left investors with no attractive alternative to stocks. 10. An investing environment bristling with the unpredictable menace of global terrorism and war in the Middle East. Much of this damage could have been and was avoided by investors who learned and lived by Graham's principles. As Graham puts it, while enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster. By letting themselves get carried away on internet stocks, on big growth stocks, on stocks as a whole, many people made the same stupid mistakes as Sir Isaac Newton. They let other investors' judgments determine their own. They ignored Graham's warning that the really dreadful losses always occur after the buyer forgot to ask how much. Most painfully of all, by losing their self-control just when they needed it the most. These people proved Graham's assertion that the investor's chief problem and even his worst enemy is likely to be himself. The sure thing that wasn't many of those people got especially carried away on technology and internet stocks, believing the high-tech hype that this industry would keep outgrowing every other for years to come, if not forever. In mid-1999, after earning a 117.3% return in just the first 5 months of the year, Monument Internet Fund portfolio manager Alexander Chung predicted that his fund would gain 50% a year over the next 3 to 5 years and an annual average of 35% over the next 20 years. Constance Loizo's Q&A, Alex Chung, Investment News, May 17, 1999, peak 38. The highest 20-year return in mutual fund history was 25.8% per year, achieved by the legendary Peter Lynch of Fidelity Magellan over the 2 decades ending December 31, 1994. Lynch's performance turned $10,000 into more than $982,000 in 20 years. Chung was predicting that his fund would turn $10,000 into more than $4 million over the same length of time. Instead of regarding Chung as ridiculously over-optimistic, investors threw commentary on the introduction after his Amerindo Technology Fund rose an incredible 248.9% in 1999. Portfolio manager Alberto Weiler ridiculed anyone who dared to doubt that the internet was a perpetual money-making machine. If you're out of this sector, you're going to underperform. You're in a horse and buggy, and I'm in a Porsche. You don't like tenfold growth opportunities? Then go with someone else. In February 2000, hedge fund manager James J. Cramer proclaimed that internet-related companies are the only ones worth owning right now. These winners of the new world, as he called them, are the only ones that are going higher consistently in good days and bad. Cramer even took a pot shot at Graham. You have to throw out all of the matrices and formulas and texts that existed before the web. If we used any of what Graham and Dodd teach us, we wouldn't have a dime under management. All these so-called experts ignored Graham's sober words of warning. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. While it seems easy to foresee which industry will grow the fastest, that foresight has no real value if most other investors are already expecting the same thing. By the time everyone decides that a given industry is obviously the best money at him, flinging more than $100 million into his fund over the next year, a $10,000 investment in the Monument Internet Fund in May 1999 would have shrunk to roughly $2,000 by year in 2002. The Monument Fund no longer exists in its original form and is now known as Orbitech's Emerging Technology Fund. Lisa Riley Cullen, The Triple Digit Club, Money, December 1999, peak 170. If you had invested $10,000 in Weiler's fund at the end of 1999, you would have finished 2002 with just $1,195 left, one of the worst destructions of wealth in the history of the mutual fund industry. See www.thestreet.com/fund/smarter/8918. Cramer's favorite stocks did not go higher consistently in good days and bad. By year end 2002, one of the 10 had already gone bankrupt, and a $10,000 investment spread equally across Cramer's picks would have lost 94%, leaving you with a grand total of $597.44. Perhaps Cramer meant that his stocks would be winners not in the new world, but in the world to come. One to invest in, the prices of its stocks have been bid up so high that its future returns have nowhere to go but down. For now at least, no one has the gall to try claiming that technology will still be the world's greatest growth industry. But make sure you remember this, the people who now claim that the next sure thing will be healthcare or energy or real estate or gold are no more likely to be right in the end than the hypesters of high tech turned out to be. The silver lining. If no price seemed too high for stocks in the 1990s, in 2003 we've reached the point at which no price appears to be low enough. The pendulum has swung, as Graham knew it always does, from irrational exuberance to unjustifiable pessimism. In 2002, investors yanked $27 billion out of stock mutual funds, and a survey conducted by the Securities Industry Association found that 1 out of 10 investors had cut back on stocks by at least 25%. The same people who were eager to buy stocks in the late 1990s when they were going up in price and therefore becoming expensive sold stocks as they went down in price and by definition became cheaper. As Graham shows so brilliantly in Chapter 8, this is exactly backwards. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. The intelligent investor dreads a bull market since it makes stocks more costly to buy. And conversely, so long as you keep enough cash on hand to meet your spending needs, you should welcome a bear market since it puts stocks back on sale. So take heart, the death of the bull market is not the bad news everyone believes it to be. Thanks to the decline in stock prices, now is a considerably safer and saner time to be building wealth. Read on and let Graham show you how. The only exception to this rule is an investor in the advanced stage of retirement who may not be able to outlast a long bear market. Yet even an elderly investor should not sell her stocks merely because they have gone down in price. That approach not only turns her paper losses into real ones, but deprives her heirs of the potential to inherit those stocks at lower costs for tax purposes. Imagine standing in the eye of a financial storm where markets roar with greed and panic swirls like a tempest. What if you could navigate it all not with reckless bets or blind luck, but with an unshakable blueprint for success? In this chapter, Benjamin Graham, the legendary father of value investing, reveals the foundational truth that separates the wise from the reckless. Investing is not a game of chance, but a discipline of patience, analysis, and ironclad principles. Whether you're clutching your first dollar or managing a fortune, the rules here will rewrite your understanding of wealth. Press play and discover why true investing begins not with chasing profits, but with mastering your own mind. Chapter 1: Investment versus Speculation. Results to be expected by the intelligent investor. This chapter will outline the viewpoints that will be set forth in the remainder of the book. In particular, we wish to develop at the outset our concept of appropriate portfolio policy for the individual, non-professional investor. Investment versus speculation. What do we mean by investor? Throughout this book, the term will be used in contradistinction to speculator. As far back as 1934, in our textbook Security Analysis, we attempted a precise formulation of the difference between the two, as follows: an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. While we have clung tenaciously to this definition over the ensuing 38 years, it is worthwhile noting the radical changes that have occurred in the use of the term investor during this period. After the great market decline of 1929 to 1932, all common stocks were widely regarded as speculative by nature. A leading author, it stated flatly that only bonds could be bought for investment. Thus, we had then to defend our definition against the charge that it gave too wide scope to the concept of investment. Now our concern is of the opposite sort. We must prevent our readers from accepting the common jargon which applies the term investor to anybody and everybody in the stock market. In our last edition, we cited the following headline of a front-page article of our leading financial journal in June 1962. Investment versus speculation. Small investors bearish. They are selling odd lots short. In October 1970, the same journal had an editorial critical of what it called reckless investors, who this time were rushing in on the buying side. These quotations well illustrate the confusion that has been dominant for many years in the use of the words investment and speculation. Think of our suggested definition of investment given above and compare it with the sale of a few shares of stock by an inexperienced member of the public who does not even own what he is selling and has some largely emotional conviction that he will be able to buy them back at a much lower price. It is not irrelevant to point out that when the 1962 article appeared, the market had already experienced a decline of major size and was now getting ready for an even greater upswing. It was about as poor a time as possible for selling short. In a more general sense, the later used phrase reckless investors could be regarded as a laughable contradiction in terms something like spendthrift misers, were this misuse of language not so mischievous. The newspaper employed the word investor in these instances because, in the easy language of Wall Street, everyone who buys or sells a security has become an investor, regardless of what he buys, or for what purpose, or at what price, or whether for cash or on margin. Compare this with the attitude of the public toward common stocks in 1948, when over 90% of those queried expressed themselves as opposed to the purchase of common stocks. About half gave as their reason not safe, a gamble, and about half the reason not familiar with. It is indeed ironical. The survey Graham cites was conducted for the Fed by the University of Michigan and was published in the Federal Reserve Bulletin, July 1948. People were asked, suppose a man decides not to spend his money. He can either put it in a bank or in bonds, or he can invest it. What do you think would be the wisest thing for him to do with the money nowadays? Put it in the bank, buy savings bonds with it, invest it in real estate, or buy common stock with it? Only 4% thought common stock would offer a satisfactory return. 26% considered it not safe or a gamble. From 1949 through 1958, the stock market earned one of its highest 10-year returns in history. Though not surprising that common stock purchases of all kinds were quite generally regarded as highly speculative or risky at a time when they were selling on a most attractive basis and due soon to begin their greatest advance in history. Conversely, the very fact they had advanced to what were undoubtedly dangerous levels as judged by past experience later transformed them into investments and the entire stock buying public into investors. The distinction between investment and speculation in common stocks has always been a useful one, and its disappearance is a cause for concern. We have often said that Wall Street as an institution would be well advised to reinstate this distinction and to emphasize it in all its dealings with the public. Otherwise, the stock exchanges may someday be blamed for heavy speculative losses, which those who suffered them had not been properly warned against. Ironically, once more, much of the recent financial embarrassment of some stock exchange firms seems to have come from the inclusion of speculative common stocks in their own capital funds. We trust that the reader of this book will gain a reasonably clear idea of the risks that are inherent in common stock commitments, risks which are inseparable from the opportunities of profit that they offer, and both of which must be allowed for in the investor's calculations. What we have just said indicates that there may no longer be such a thing as a Simon Pure investment policy comprising representative common stocks, in the sense that one can always wait to buy them at a price that involves no risk of a market or quotidianal loss large enough to be disquieting. In most periods, the investor must recognize the existence of a speculative factor in his common stock holdings. It is his task to keep this component within minor limits and to be prepared financially and psychologically for adverse results that may be of short or long duration. 2 paragraphs should be added about stock speculation per se, as distinguished from the speculative component now inherent, averaging 18.7% annually. In a fascinating echo of that early Fed survey, a poll conducted by Businessweek at year in 2002 found that only 24% of investors were willing to invest more in their mutual funds or stock portfolios, down from 47% just 3 years earlier. In most representative common stocks, outright speculation is neither illegal, immoral, nor for most people fattening to the pocketbook. More than that, some speculation is necessary and unavoidable, for in many common stock situations there are substantial possibilities of both profit and loss, and the risks therein must be assumed by someone. There is intelligent speculation as there is intelligent investing, but there are many ways in which speculation may be unintelligent. Of these, the foremost are: 1. Speculating when you think you are investing; 2. Speculating seriously instead of as a pastime when you lack proper knowledge and skill for it; and 3. Risking more money in speculation than you can afford to lose. In our conservative view, every non-professional who operates on margin should recognize that he is ipso facto speculating, and it is his broker's duty so to advise him. And everyone who buys a so-called hot common stock issue or makes a purchase in any way similar thereto is either speculating or gambling. Speculation is always fascinating, and it can be a lot of fun while you are ahead of the game. If you want to try your luck at it, put aside a portion, the smaller the better, of your capital in a separate fund for this purpose. Never add more money to this account just because the speculation is beneficial onto levels. First, without speculation, untested new companies like Amazon.com or, in earlier times, the Edison Electric Light Co. would never be able to raise the necessary capital for expansion. The alluring, long-shot chance of a huge gain is the grease that lubricates the machinery of innovation. Secondly, risk is exchanged but never eliminated every time a stock is bought or sold. The buyer purchases the primary risk that this stock may go down. Meanwhile, the seller still retains a residual risk, the chance that the stock he just sold may go up. Plus, a margin account enables you to buy stocks using money you borrow from the brokerage firm. By investing with borrowed money, you make more when your stocks go up, but you can be wiped out when they go down. The collateral for the loan is the value of the investments in your account, so you must put up more money if that value falls below the amount you borrowed. For more information about margin accounts, see www.sec.gov/investor/pub/margin.htm, www.cia.com/publications/pdf/margin.pdf, nysa.com/pdfs/2001_factbook_09.pdf. Market has gone up and profits are rolling in. That's the time to think of taking money out of your speculative fund. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. Results to be expected by the defensive investor. We have already defined the defensive investor as one interested chiefly in safety plus freedom from bother. In general, what course should he follow and what return can he expect under average normal conditions, if such conditions really exist? To answer these questions, we shall consider first what we wrote on the subject 7 years ago, next what significant changes have occurred since then in the underlying factors governing the investor's expectable return, and finally what he should do and what he should expect under present day early 1970 to conditions. 1. What we said 6 years ago recommended that the investor divide his holdings between high-grade bonds and leading common stocks, that the proportion held in bonds be never less than 25% or more than 75%, with the converse being necessarily true for the common stock component, that his simplest choice would be to maintain a 50-50 proportion between the two, with adjustments to restore the equality when market developments had disturbed it by as much as, say, 5%. As an alternative policy, he might choose to reduce his common stock component to 25% if he felt the market was dangerously high, and conversely to advance it toward the maximum of 75% if he felt that a decline in stock prices was making them increasingly attractive. In 1965, the investor could obtain about 4% on high-grade taxable bonds and 3% on good tax-free bonds. The dividend return on leading common stocks with the GIA at 892 was only about 3.2%. This fact and others suggested caution. We implied that at normal levels of the market, the investor should be able to obtain an initial dividend return of between 3% and 4% on his stock purchases, to which should be added a steady increase in underlying value and in the normal market price of a representative stock list of about the same amount, giving a return from dividends and appreciation combined of about 7% per year. The half and half division between bonds and stocks would yield about 6% before income tax. We added that the stock component should carry a fair degree of protection against a loss of purchasing power caused by large-scale inflation. It should be pointed out that the above arithmetic indicated expectation of a much lower rate of advance in the stock market than had been realized between 1949 and 1964. That rate had ever aged a good deal better than 10% for listed stocks as a whole, and it was quite generally regarded as a sort of guarantee that similarly satisfactory results could be counted on in the future. Few people were willing to consider seriously the possibility that the high rate of advance in the past means that stock prices are now too high, and hence that the wonderful results since 1949 would imply not very good but bad results for the future. 2. What has happened since 1964? The major change since 1964 has been the rise in interest rates on first-grade bonds to record high levels, although there has since been a considerable recovery from the lowest prices of 1970. The obtainable return on good corporate issues is now about 7% and even more against 44% in 1964. In the meantime, the dividend return on GIA-type stocks had a fair advance also during the market decline of 1,969-70, but as we write with the Dow at 900, it is less than 3.5% against 3.2% at the end of 1964. The change in going interest rates produced a maximum decline of about 38% in the market price of medium-term, say 20-year bonds during this period. There is a paradoxical aspect to these developments. In 1964, we discussed at length the possibility that the price of stocks might be too high and subject ultimately to a serious decline. But we did not consider specifically the possibility that the same might happen to the price of high-grade bonds. Neither did anyone else that we know of. We did warn on Peak 90 that a long-term bond may vary widely in price in response to changes in interest rates. In the light of what has since happened, we think that this warning with attendant examples was insufficiently stressed. For the fact is that if the investor had a given sum in the GIA at its closing price of $874 in 1964, he would have had a small profit thereon in late 1971. Even at the lowest level 631 in 1970, his indicated loss would have been less than that shown on good long-term bonds. On the other hand, if he had confined his bond-type investments to U.S. savings bonds, short-term corporate issues, or savings accounts, he would have had no loss in market value of his principal during this period, and he would have enjoyed a higher income return than was offered by good stocks. It turned out, therefore, that true cash equivalents proved to be better investments in 1964 than common stocks, in spite of the inflation experience that in theory should have favored stocks over cash. The decline in quoted principal value of good longer-term bonds was due to developments in the money market, an abstruse area which ordinarily does not have an important bearing on the investment policy of individuals. This is just another of an endless series of experiences over time that have demonstrated that the future of security prices is never predictable. Almost always bonds have fluctuated much less than stock prices, and investors generally could buy good bonds of any maturity without having to worry about changes in their market value. There were a few exceptions to this rule, and the period after 1964 proved to be one of them. We shall have more to say about change in bond prices in a later chapter. 3. Expectations and policy in late 1971 and early 1972. Toward the end of 1971, it was possible to obtain 8% taxable interest on good medium-term corporate bonds and 5.7% tax-free on good state or municipal securities. In the shorter-term field, the investor could realize about 6% on U.S. government issues due in 5 years. In the latter case, the buyer need not be concerned about. Read Graham's sentence again and note what this greatest of investing experts is saying: the future of security prices is never predictable. And as you read ahead in the book, notice how everything else Graham tells you is designed to help you grapple with that truth. Since you cannot predict the behavior of the markets, you must learn how to predict and control your own behavior. A possible loss in market value, since he is sure of full repayment, including the 6% interest return, at the end of a comparatively short holding period. The GIA at its recurrent price level of 900 in 1971 yields only 3.5%. Let us assume that now, as in the past, the basic policy decision to be made is how to divide the fund between high-grade bonds or other so-called cash equivalents and leading GIA-type tono under present conditions. If we have no strong reason to predict either a significant upward or a significant downward movement for some time in the future. First, let us point out that if there is no serious adverse change, the defensive investor should be able to count on the current 3.5% dividend return on his stocks and also on an average annual appreciation of about 4%. As we shall explain later, this appreciation is based essentially on the reinvestment by the various companies of a corresponding amount annually out of undistributed profits. On a before-tax basis, the combined return of his stocks would then average, say, 7.5%, somewhat less than his interest on high-grade bonds. On an after-tax basis, the average return on stocks would work out at some 5.3%. This would be about the same as is now obtainable on good tax-free medium-term bonds. These expectations are much less favorable for stocks against bonds than they were in our 1964 analysis. That conclusion follows inevitably from the basic fact that bond yields have gone up much more than stock yields since 1964. We must never lose sight. How well did Graham's forecast pan out? At first blush, it seems very well. From the beginning of 1972 through the end of 1981, stocks earned an annual average return of 6.5%. Graham did not specify the time period for his forecast, but it's plausible to assume that he was thinking of a 10-year time horizon. However, inflation raged at 8.6% annually over this period, eating up the entire gain that stocks produced. In this section of his chapter, Graham is summarizing what is known as the Gordon equation, which essentially holds that the stock market's future return is the sum of the current dividend yield plus expected earnings growth. With a dividend yield of just under 2% in early 2003 and long-term earnings growth of around 2%, plus inflation at a bit over 2%, a future average annual return of roughly 6% is plausible. See the commentary on Chapter 3 of the fact that the interest and principal payments on good bonds are much better protected and therefore more certain than the dividends and price appreciation on stocks. Consequently, we are forced to the conclusion that now, toward the end of 1971, bond investment appears clearly preferable to stock investment. If we could be sure that this conclusion is right, we would have to advise the defensive investor to put all his money in bonds and none in common stocks until the current yield relationship changes significantly in favor of stocks. But of course, we cannot be certain that bonds will work out better than stocks from today's levels. the reader will immediately think of the inflation factor as a potent reason on the other side. In the next chapter, we shall argue that our considerable experience with inflation in the United States during this century would not support the choice of stocks against bonds at present differentials in yield. But there is always the possibility, though we consider it remote, of an accelerating inflation, which in one way or another would have to make stock equities preferable to bonds payable in a fixed amount of dollars. There is the alternative possibility, which we also consider highly unlikely, that American business will become so profitable without stepped-up inflation as to justify a large increase in common stock values in the next few years. Finally, there is the more familiar possibility that we shall witness another great speculative rise in the stock market without a real justification in the underlying values. Any of these reasons, and perhaps others we haven't thought of, might cause the investor to regret a 100% concentration on bonds even at their more favorable yield levels. Hence, after this foreshortened discussion of the major considerations, we once again enunciate the same basic compromise policy. A major point here is that the defensive investor's overall results are not likely to be decisively different from one diversified or representative list than from another, or more accurately, that neither he nor his advisors could predict with certainty whatever differences would ultimately develop. It is true that the art of skillful or shrewd investment is supposed to lie particularly in the selection of issues that will give better results than the general market. For reasons to be developed elsewhere, we are skeptical of the ability of defensive investors generally to get better than average results, which in fact would mean to beat their own overall performance. Our skepticism extends to the management of large funds by experts. Let us illustrate our point by an example that at first may seem to prove the opposite. Between December 1960 and December 1970, the GIA advanced from 616 to 839, or 36%. But in the same period, the much larger Standard & Poor's weighted index of 500 stocks rose from 58.11 to 92.15, or 58%. Obviously, the second group had proved a better buy than the first. But who would have been so rash as to predict in 1960 that what seemed like a miscellaneous assortment of all sorts of common stocks would definitely outperform the aristocratic 30 tyrants of the Dow? All this proves, we insist, that only rarely can one make dependable predictions about price changes, absolute or relative. We shall repeat here without apology, for the warning cannot be given too often that the investor cannot hope for better than average results by buying new offerings or hot issues of any sort, meaning thereby those recommended for a quick profit. The contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Any security analyst worth his salt could make up such traded stock in America, roughly 6,700 in all. But since the largest companies account for most of the total value of the index, the return of the Wilshire 5000 is usually quite similar to that of the S&P 500. Several low-cost mutual funds enable investors to hold the stocks in these indexes as a single, convenient portfolio. See Chapter 9. CPP 363366 and PP 376380. Plus, for greater detail, see Chapter 6, a list. Aggressive investors may buy other types of common stocks, but they should be on a definitely attractive basis as established by intelligent analysis. To conclude this section, let us mention briefly 3 supplementary concepts or practices for the defensive investor. The first is the purchase of the shares of well-established investment funds as an alternative to creating his own common stock portfolio. He might also utilize one of the common trust funds or commingled funds operated by trust companies and banks in many states. Or, if his funds are substantial, use the services of a recognized investment counsel firm. This will give him professional administration of his investment program along standard lines. The third is the device of dollar cost averaging, which means simply that the practitioner invests in common stocks the same number of dollars each month or each quarter. In this way, he buys more shares when the market is low than when it is high, and he is likely to end up since 1997, when Treasury inflation-protected securities or TIPS were introduced. Stocks have no longer been the automatically superior choice for investors who expect inflation to increase. TIPS, unlike other bonds, rise in value if the consumer price index goes up, effectively immunizing the investor against losing money after inflation. Stocks carry no such guarantee and, in fact, are a relatively poor hedge against high rates of inflation. For more details, see the commentary to Chapter 2 for defensive investors, namely that at all times they have a significant part of their funds in bond-type holdings and a significant part also in equities. It is still true that they may choose between maintaining a simple 50-50 division between the two components or a ratio, dependent on their judgment, varying between a minimum of 25% and a maximum of 75% of either. We shall give our more detailed view of these alternative policies in a later chapter. Since at present, the overall return envisaged from common stocks is nearly the same as that from bonds, the presently expectable return, including growth of stock values for the investor, would change little regardless of how he divides his fund between the two components. As calculated above, the aggregate return from both parts should be about 7.8% before taxes or 5.5% on a tax-free or estimated tax-paid basis. A return of this order is appreciably higher than that realized by the typical conservative investor over most of the long-term past. It may not seem attractive in relation to the 14% or so return shown by common stocks during the 20 years of the predominantly bull market after 1949. But it should be remembered that between 1949 and 1969, the price of the GIA had advanced more than fivefold while its earnings and dividends had about doubled. Hence, the greater part of the impressive market record for that period was based on a change in investors' and speculators' attitudes rather than in underlying corporate values. To that extent, it might well be called a bootstrap operation. In discussing the common stock portfolio of the defensive investor, we have spoken only of leading issues of the type included in the 30 components of the Dow Jones Industrial Average. We have done this for convenience and not to imply that these 30 issues alone are suitable for purchase by him. Actually, there are many other companies of quality equal to or excelling the average of the Dow Jones list. These would include a host of public utilities which have a separate Dow Jones average to represent them. But today, the most widely available alternatives to the Dow Jones Industrial Average are the Standard & Poor's 500 Stock Index, the S&P, and the Wilshire 5000 Index. The S&P focuses on 500 large, well-known companies that make up roughly 70% of the total value of the U.S. equity market. The Wilshire 5000 follows the returns of nearly every significant, publicly the intelligent investor's major point here is that the defensive investor's overall results are not likely to be decisively different from one diversified or representative list than from another, or more accurately that neither he nor his advisors could predict with certainty whatever differences would ultimately develop. It is true that the art of skillful or shrewd investment is supposed to lie particularly in the selection of issues that will give better results than the general market. For reasons to be developed elsewhere, we are skeptical of the ability of defensive investors generally to get better than average results, which in fact would mean to beat their own overall performance. Our skepticism extends to the management of large funds by experts. Let us illustrate our point by an example that at first may seem to prove the opposite. Between December 1960 and December 1970, the GIA advanced from 616 to 839, or 36%. But in the same period, the much larger Standard & Poor's weighted index of 500 stocks rose from 58.11 to 92.15, or 58%. Obviously, the second group had proved a better buy than the first. But who would have been so rash as to predict in 1960 that what seemed like a miscellaneous assortment of all sorts of common stocks would definitely outperform the aristocratic 30 tyrants of the Dow? All this proves, we insist, that only rarely can one make dependable predictions about price changes, absolute or relative. We shall repeat here without apology, for the warning cannot be given too often that the investor cannot hope for better than average results by buying new offerings or hot issues of any sort, meaning thereby those recommended for a quick profit. The contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Any security analyst worth his salt could make up such traded stock in America, roughly 6,700 in all. But since the largest companies account for most of the total value of the index, the return of the Wilshire 5000 is usually quite similar to that of the S&P 500. Several low-cost mutual funds enable investors to hold the stocks in these indexes as a single, convenient portfolio. See Chapter 9. CPP 363366 and PP 376380. Plus, for greater detail, see Chapter 6, a list. Aggressive investors may buy other types of common stocks, but they should be on a definitely attractive basis as established by intelligent analysis. To conclude this section, let us mention briefly 3 supplementary concepts or practices for the defensive investor. The first is the purchase of the shares of well-established investment funds as an alternative to creating his own common stock portfolio. He might also utilize one of the common trust funds or commingled funds operated by trust companies and banks in many states. Or, if his funds are substantial, use the services of a recognized investment counsel firm. This will give him professional administration of his investment program along standard lines. The third is the device of dollar cost averaging, which means simply that the practitioner invests in common stocks the same number of dollars each month or each quarter. In this way, he buys more shares when the market is low than when it is high, and he is likely to end up with a satisfactory overall price for all his holdings. Strictly speaking, this method is an application of a broader approach known as formula investing. The latter was already alluded to in our suggestion that the investor may vary his holdings of common stocks between the 25% minimum and the 75% maximum in inverse relationship to the action of the market. These ideas have merit for the defensive investor, and they will be discussed more amply in later chapters. Results to be expected by the aggressive investor or enterprising security buyer, of course, will desire and expect to attain better overall results than his defensive or passive companion. But first, he must make sure that his results will not be worse. It is no difficult trick to bring a great deal of energy, study, and native ability into Wall Street and to end up with losses instead of profits. These virtues, if channeled in the wrong directions, become indistinguishable from handicaps. Thus, it is most essential that the enterprising investor start with a clear conception as to. For more advice on well-established investment funds, see Chapter 9. Professional administration by a recognized investment counsel firm is discussed in Chapter 10. Dollar cost averaging is explained in Chapter 5. The Intelligent Investor 30, which courses of action offer reasonable chances of success and which do not. First, let us consider several ways in which investors and speculators generally have endeavored to obtain better than average results. These include 1. Trading in the market. This usually means buying stocks when the market has been advancing and selling them after it has turned downward. The stocks selected are likely to be among those which have been behaving better than the market average. A small number of professionals frequently engage in short selling. Here, they will sell issues they do not own but borrow through the established mechanism of the stock exchanges. Their object is to benefit from a subsequent decline in the price of these issues by buying them back at a price lower than they sold them for. As our quotation from the Wall Street Journal on page 19 indicates, even small investors perish the term, sometimes try their unskilled hand at short selling. 2. Short-term selectivity. This means buying stocks of companies which are reporting or expected to report increased earnings or for which some other favorable development is anticipated. 3. Long-term selectivity. Here the usual emphasis is on an excellent record of past growth, which is considered likely to continue in the future. In some cases, also the investor may choose companies which have not yet shown impressive results, but are expected to establish a high earning power later. Such companies belong frequently in some technological realm, computers, drugs, electronics, and they often are developing new processes or products that are deemed to be especially promising. We have already expressed a negative view about the investor's overall chances of success in these areas of activity. The first we have ruled out on both theoretical and realistic grounds from the domain of investment. Stock trading is not an operation which, on thorough analysis, offers safety of principal and a satisfactory return. More will be said on stock trading in a later chapter. In his endeavor to select the most promising stocks either for the near term or the longer future, the investor faces obstacles of two kinds, the first stemming from human fallibility and the second from the nature of his competition. He may be wrong in his estimate of the future, or even if he is right, the current market price may already fully reflect what he is anticipating. In the area of near-term selectivity, the current year's results of the company are generally common property on Wall Street. Next year's results, to the extent they are predictable, are already being carefully considered. Hence, the investor who selects issues chiefly on the basis of this year's superior results, or on what he is told he may expect for next year, is likely to find that others have done the same thing for the same reason. In choosing stocks for their long-term prospects, the investors' handicaps are basically the same. The possibility of outright error in the prediction, which we illustrated by our airlines example on page 6, is no doubt greater than when dealing with near-term earnings. Because the experts frequently go astray in such forecasts, it is theoretically possible for an investor to benefit greatly by making correct predictions when Wall Street as a whole is making incorrect ones. But that is only theoretical. How many enterprising investors could count on having the acumen or prophetic gift to beat the professional analysts at their favorite game of estimating long-term future earnings? We are thus led to the following logical, if disconcerting, conclusion: to enjoy a reasonable chance for continued better than average results, the investor must follow policies which are, 1, inherently sound and promising, and 2, not popular on Wall Street. Are there any such policies available for the enterprising investor? In theory, once again, the answer should be yes, and there are broad reasons to think that the answer should be affirmative in practice as well. Everyone knows that speculative stock movements are carried too far in both directions, frequently in the general market and at all times in at least some of the individual issues. Furthermore, a common stock may be undervalued because of lack of interest or unjustified popular prejudice. We can go further and assert that in an astonishingly large proportion of the trading in common stocks, those engaged therein don't appear to know in polite terms one part of their anatomy from another. In this book, we shall point out numerous examples of past discrepancies between price and value. Thus, it seems that any intelligent person with a good head for figures should have a veritable picnic on Wall Street, battening off other people's foolishness. So it seems, but somehow it doesn't work out that simply. Buying a neglected and therefore undervalued issue for profit generally proves a protracted and patience-trying experience. And selling short a too popular and therefore overvalued issue is apt to be a test not only of one's courage and stamina but also of the depth of one's pocketbook. The principle is sound, its successful application is not impossible, but it is distinctly not an easy art to master. There is also a fairly wide group of special situations which over many years could be counted on to bring a nice annual return of 20% or better, with a minimum of overall risk to those who knew their way around in this field. They include intersecurity arbitrage, payouts or workouts and liquidations, protected hedges of certain kinds. The most typical case is a projected merger or acquisition which offers a substantially higher value for certain shares than their price on the date of the announcement. The number of such deals increased greatly in recent years, and it should have been a highly profitable period for the cognoscenti. But with the multiplication of merger announcements came a multiplication of obstacles to mergers and of deals that didn't go through. Quite a few individual losses were thus realized in these once reliable operations. Perhaps, too, the overall rate of profit was diminished by too much competition. In selling short or shorting a stock, you make a bet that its share price will go down, not up. Shorting is a 3-step process. First, you borrow shares from someone who owns them, then you immediately sell the borrowed shares. Finally, you replace them with shares you buy later. If the stock drops, you will be able to buy your replacement shares at a lower price. The difference between the price at which you sold your borrowed shares and the price you paid for the replacement shares is your gross profit reduced by dividend or interest charges, along with brokerage costs. However, if the stock goes up in price instead of down, your potential loss is unlimited, making short sales unacceptably speculative for most individual investors. In the late 1980s, as hostile corporate takeovers and leveraged buyouts multiplied, Wall Street set up institutional arbitrage desks to profit from any investment versus speculation. 33. The lessened profitability of these special situations appears one manifestation of a kind of self-destructive process akin to the law of diminishing returns which has developed during the lifetime of this book. In 1949, we could present a study of stock market fluctuations over the preceding 75 years, which supported a formula based on earnings and current interest rates for determining a level to buy the GIA below its central or intrinsic value and to sell out above such value. It was an application of the governing maxim of the Rothschilds, buy cheap and sell dear. And it had the advantage of running directly counter to the ingrained and pernicious maxim of Wall Street that stocks should be bought because they have gone up and sold because they have gone down. Alas, after 1949, this formula no longer worked. A second illustration is provided by the famous Dow theory of stock market movements in a comparison of its indicated splendid results for 1897 to 1933 and its much more questionable performance since 1934. A third and final example of the golden opportunities not recently available. A good part of our own operations on Wall Street have been concentrated on the purchase of bargain issues easily identified as such by the fact that they were selling at less than their share in the net current assets working capital alone, not counting the planned account and other assets, and after deducting all liability. It is clear that these issues were selling at a price well below the value of the enterprise as a private business. No proprietor or majority holder would think of selling what he owned at so ridiculously low a figure. Strangely enough, such errors in pricing these complex deals. They became so good at it that the easy profits disappeared and many of these desks have been closed down. Although Graham does discuss it again, see pp. 17 for 175, this sort of trading is no longer feasible or appropriate for most people, since only multi-million-dollar trades are large enough to generate worthwhile profits. Wealthy individuals and institutions can utilize this strategy through hedge funds that specialize in merger or event arbitrage. The Rothschild family, led by Nathan Mayer Rothschild, was the dominant power in European investment banking and brokerage in the 19th century. For a brilliant history, see Niall Ferguson, The House of Rothschild, Money's Profits, 1798 to 1848, Viking, 1998. Anomalies were not hard to find. In 1957, a list was published showing nearly 200 issues of this type available in the market. In various ways, practically all these bargain issues turned out to be profitable, and the average annual result proved much more remunerative than most other investments. But they too virtually disappeared from the stock market in the next decade, and with them a dependable area for shrewd and successful operation by the enterprising investor. However, at the low prices of 1970, there again appeared a considerable number of such sub-working capital issues, and despite the strong recovery of the market, enough of them remained at the end of the year to make up a full-size portfolio. The enterprising investor under today's conditions still has various possibilities of achieving better than average results. The huge list of marketable securities must include a fair number that can be identified as undervalued by logical and reasonably dependable standards. These should yield more satisfactory results on the average than will the GIA or any similarly representative list. In our view, the search for these would not be worth the investor's effort unless he could hope to add, say, 5% before taxes to the average annual return from the stock portion of his portfolio. We shall try to develop one or more such approaches to stock selection for use by the active investor. Commentary on Chapter 1. All of human unhappiness comes from one single thing, not knowing how to remain at rest in a room. Blaise Pascal. Do you suppose the brokers on the floor of the New York Stock Exchange always cheer at the sound of the closing bell no matter what the market did that day? Because whenever you trade, they make money whether you did or not. By speculating instead of investing, you lower your own odds of building wealth and raise someone else's. Graham's definition of investing could not be clearer. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Note that investing, according to Graham, consists equally of three elements. You must thoroughly analyze a company and the soundness of its underlying businesses before you buy its stock. You must deliberately protect yourself against serious losses. You must aspire to adequate, not extraordinary, performance. Graham goes even further, fleshing out each of the key terms in his definition. Thorough analysis means the study of the facts in the light of established standards of safety and value, while safety of principle signifies protection against loss under all normal or reasonably likely conditions or variations, and adequate or satisfactory return refers to any rate or amount of return, however low, which the investor is willing to accept, provided he acts with reasonable intelligence. Security analysis, 1930 for ed. pp. 55 minus. An investor calculates what a stock is worth based on the value of its businesses. A speculator gambles that a stock will go up in price because somebody else will pay even more for it. As Graham once put it, investors judge the market price by established standards of value, while speculators base their standards of value upon the market price. For a speculator, the incessant stream of stock quotes is like oxygen. Cut it off and he dies. For an investor, what Graham called quotational values matter much less. Graham urges you to invest only if you would be comfortable owning a stock, even if you had no way of knowing its daily share price. Like casino gambling or betting on the horses, speculating in the market can be exciting or even rewarding if you happen to get lucky. But it's the worst imaginable way to build your wealth. That's because Wall Street, like Las Vegas or the racetrack, has calibrated the odds so that the house always prevails in the end against everyone who tries to beat the house at its own speculative game. On the other hand, investing is a unique kind of casino, one where you cannot lose in the end, so long as you play only by the rules that put the odds squarely in your favor. People who invest make money for themselves. People who speculate make money for their brokers. And that, in turn, is why Wall Street perennially downplays the durable virtues of investing and hypes the gaudy appeal of speculation. Unsafe at high speed, confusing speculation with investment, Graham warns, is always a mistake. In the 1990s, that confusion led to mass destruction. Almost everyone, it seems, ran out of patience at once, and America became the speculation nation, populated with traders who went shooting from stock to stock like grasshoppers whizzing around in an August hayfield. People began believing that the test of an investment technique was simply whether it worked. If they beat the market over any security analysis, 1934 ed. P310.as Graham advised in an interview, ask yourself, if there was no market for these shares, would I be willing to have an investment in this company on these terms? Forbes, January 1st, 1972, Pete 90, period. No matter how dangerous or dumb their tactics, people boasted that they were right. But the intelligent investor has no interest in being temporarily right. To reach your long-term financial goals, you must be sustainably and reliably right. The techniques that became so trendy in the 1990s, day trading, ignoring diversification, flipping hot mutual funds, following stock picking systems, seemed to work. But they had no chance of prevailing in the long run because they failed to meet all three of Graham's criteria for investing. To see why temporarily high returns don't prove anything, imagine that two places are 130 miles apart. If I observe the 65 mph speed limit, I can drive that distance into hours. But if I drive 130 miles per hour, I can get there in 1 hour. If I try this and survive, am I right? Should you be tempted to try it too because you hear me bragging that it worked? Flashy gimmicks for beating the market are much the same. In short streaks, so long as your luck holds out, they work. Over time, they will get you killed. In 1973, when Graham last revised The Intelligent Investor, the annual turnover rate on the New York Stock Exchange was 20%, meaning that the typical shareholder held a stock for 5 years before selling it. By 2002, the turnover rate had hit 105, a holding period of only 11.4 months. Back in 1973, the average mutual fund held onto a stock for nearly 3 years. By 2002, that ownership period had shrunk to just 10.9 months. It's as if mutual fund managers were studying their stocks just long enough to learn they shouldn't have bought them in the first place, then promptly dumping them and starting all over. Even the most respected money management firms got antsy. In early 1995, Jeffrey Vinnick, manager of Fidelity Magellan, then the world's largest mutual fund, had 40.5% of its assets in technology stocks. Vinnick proclaimed that most of his shareholders have invested in the fund for goals that are years away. I think their objectives are the same as mine, and that they believe, as I do, that a long-term approach is best. But 6 months after he wrote those high-minded words, Vinnick sold off almost all his technology shares, unloading nearly $19 billion worth in 8 frenzied weeks. So much for the long term. And by 1999, Fidelity's discount brokerage division was egging on its clients to trade anywhere, anytime, using a palm handheld computer which was perfectly in tune with the firm's new slogan, "Every second counts." And on the NASDAQ exchange, turnover hit warp speed as Figure 1-1 shows. In 1999, shares in Puma Technology, for instance, changed hands an average of once every 5.7 days. Despite NASDAQ's grandiose motto, the stock market for the next 100 years, many of its customers could barely hold onto a stock for 100 hours. The financial video game Wall Street made online trading sound like an instant way to mint money. Discover Brokerage, the online arm of the venerable firm Offsource, Steve Galbraith, Sanford C. Bernstein and Co. Research Report, January 10, 2000. The stocks in this table had an average return of April 11.96 in 1999. They lost an average of 79.1% in 2000, 35.5% in 2001, and 44.5% in 2002, destroying all the gains of 1999 and then some. Commentary on Chapter 1. Morgan Stanley ran a TV commercial in which a scruffy tow truck driver picks up a prosperous-looking executive. Spotting a photo of a tropical beachfront posted on the dashboard, the executive asks, "Vacation?" "Actually," replies the driver, "that's my home." Taken aback, the suit says, "Looks like an island." With quiet triumph, the driver answers, "Technically, it's a country." The propaganda went further. Online trading would take no work and require no thought. A television ad from Ameritrade, the online broker, showed two housewives just back from jogging. One logs onto her computer, clicks the mouse a few times, and exults, "I think I just made about $1,700. In a TV commercial for the Waterhouse broker-age firm, someone asked basketball coach Phil Jackson, "You know anything about the trade?" His answer, "I'm going to make it right now." How many games would Jackson's NBA teams have won if he had brought that philosophy to courtside? Somehow, knowing nothing about the other team, but saying, "I'm ready to play them right now," doesn't sound like a championship formula. By 1999, at least 6 million people were trading online, and roughly a tenth of them were day trading, using the internet to buy and sell stocks at lightning speed. Everyone from showbiz diva Barbra Streisand to Nicholas Burbis, a 25-year-old former waiter in Queens, New York, was flinging stocks around like live coals. Before, scoffed Burbis, "I was investing for the long term and I found out that it was not smart." Now, Burbis traded stocks up to 10 times a day and expected to earn $100,000 in a year. "I can't stand to see red in my profit or loss column," Streisand shuddered in an interview with Fortune. "I'm Taurus the bull, so I react to red. If I see red, I sell my stocks quickly." By pouring continuous data about stocks into bars and barbershops, kitchens and cafes, taxicabs and truck stops, financial websites and financial TV turned the stock market into a non-stop national video game. The public felt more knowledgeable about the markets than ever before. Unfortunately, while people were drowning in data, knowledge was nowhere to be found. Stocks became entirely deku instead of stargazing. Streisand should have been channeling Graham. The intelligent investor never dumps a stock purely because its share price has fallen. She always asks first whether the value of the company's underlying businesses has changed. Pled from the companies that had issued them pure abstractions, just blips moving across a TV or computer screen. If the blips were moving up, nothing else mattered. On December 20th, 1999, Juno Online Services unveiled a trailblazing business plan to lose as much money as possible. Juno announced that it would henceforth offer all its retail services for free, no charge for email, no charge for internet access, and that it would spend millions of dollars more on advertising over the next year. On this declaration of corporate harakiri, Juno's stock roared up from $16.375 to $66.75 in days. Why bother learning whether a business was profitable, or what goods or services a company produced, or who its management was, or even what the company's name was? All you needed to know about stocks was the catchy code of their ticker symbols: Siebel, Inked, PKL, Tiglo, Verzon, Dovin. That way you could buy them even faster without the pesky 2-second delay of looking them up on an internet search engine. In late 1998, the stock of a tiny, rarely traded building maintenance company, Temco Services, nearly tripled in a matter of minutes on record high volume. Why? In a bizarre form of financial dyslexia, thousands of traders bought Temco after mistaking its ticker symbol, TMCO, for that of Ticketmaster Online TMCS, an internet darling whose stock began trading publicly for the first time that day. Oscar Wilde joked that a cynic knows the price of everything and the value of nothing. Under that definition, the stock market is always cynical, but by the late 1990s, it would have shocked Oscar himself. A single half-baked opinion on price could double a company's stock, even as its value went entirely unexamined. In late 1998, Henry Blodgett, an analyst at CIBC Oppenheimer, warned that, as with all internet stocks, a valuation is clearly more art than science. Then, citing only the possibility of future growth, he jacked up his price target. On just 12 months later, Juno's shares had shriveled to $1.093. A ticker symbol is an abbreviation, usually 1 to 4 letters long, of a company's name used as shorthand to identify a stock for trading purposes. This was not an isolated incident. On at least 3 other occasions in the late 1990s, day traders sent the wrong stock soaring when they mistook its ticker symbol for that of a newly minted internet company. Amazon.com from $150 to $400 in one fell swoop. Amazon.com shot up 19% that day, and despite Blodgett's protest that his price target was a 1-year forecast, soared past $400 in just 3 weeks. A year later, PaineWebber analyst Walter Piesek predicted that Qualcomm stock would hit $1,000 a share over the next 12 months. The stock, already up 1,842% that year, soared another 31% that day, hitting $659 a share. From formula to fiascobic trading as if your underpants are on fire is not the only form of speculation. Throughout the past decade or so, one speculative formula after another was promoted, popularized, and then thrown aside. All of them shared a few traits. This is quick, this is easy, and it won't hurt a bit. And all of them violated at least one of Graham's distinct tie-ins between investing and speculating. Here are a few of the trendy formulas that fell flat. Cash in on the calendar. The January effect, the tendency of small stocks to produce big gains around the turn of the year, was widely promoted in scholarly articles and popular books published in the 1980s. These studies showed that if you piled into small stocks in the second half of December and held them into January, you would beat the market by 5 to 10 percentage points. That amazed many experts. After all, if it were this easy, surely everyone would hear about it, lots of people would do it, and the opportunity would wither away. What caused the January jolt? First of all, many investors sell their crummiest stocks late in the year to lock in losses that can cut their tax bills. Second, professional money managers grow more cautious as the year draws to a close, seeking to preserve their outperformance or minimize their underperformance. That makes them reluctant to buy or even hang on to a falling stock. And if an underperforming stock is also small and obscure, a money manager will be even less eager to show it in his year-end. In 2000 and 2001, Amazon.com and Qualcomm lost a cumulative total of 85.8% and 71.3% of their value, respectively. List of holdings. All these factors turn small stocks into momentary bargains. When the tax-driven selling ceases in January, they typically bounce back, producing a robust and rapid gain. The January effect has not withered away, but it has weakened. According to finance professor William Schwert of the University of Rochester, if you had bought small stocks in late December and sold them in early January, you would have beaten the market by 8.5 percentage points from 1962 through 1979, by 4.4 points from 1980 through 1989, and by 5.8 points from 1990 through 2001.10. As more people learned about the January effect, more traders bought small stocks in December, making them less of a bargain and thus reducing their returns. Also, the January effect is biggest among the smallest stocks, but according to Plexus Group, the leading authority on brokerage expenses, the total cost of buying and selling such tiny stocks can run up to 8% of your investment. Sadly, by the time you're done paying your broker, all your gains on the January effect will melt away. Just do what works. In 1996, an obscure money manager named James O'Shaughnessy published a book called What Works on Wall Street. In it, he argued that investors can do much better than the market. O'Shaughnessy made a stunning claim. From 1954 through 1994, you could have turned $10,000 into $8,074,500 beating the market by more than tenfold, a towering 18.2% average annual, by buying a basket of 50 stocks with the highest one-year returns, 5 straight years of rising earnings, and share prices less than 1.5 times their corporate revenues. As if he were the Edison of Wall Street, O'Shaughnessy obtained U.S. patent number 5,978,778 for his automated strategies and launched a group of 4 mutual funds based on his findings. By late 1999, the funds had sucked in more than $175 million from the public, and in his annual letter to shareholders, O'Shaughnessy stated grandly, "As always, I hope Ten Schwert discusses these findings in a brilliant research paper, Anomalies and Market Efficiency," available at http://schwerty.ssb.rochester.edu/papers.htm. See Plexus Group Commentary 54, The Official Icebergs of Transaction Costs, January 1998, at Woplexa Group FS Research. Hummel, 12 James O'Shaughnessy, What Works on Wall Street McGraw-Hill, 1996, pp. XV to 73 to 95, that together we can reach our long-term goals by staying the course and sticking with our time-tested investment strategies. But What Works on Wall Street stopped working right after O'Shaughnessy publicized it. As Figure 1-2 shows, two of his funds stank so badly that they shut down in early 2000, and few had used to work on Wall Street. Overall stock market, as measured by the S&P 500 index, wall-locked every O'Shaughnessy fund almost non-stop for nearly 4 years running. In June 2000, O'Shaughnessy moved closer to his own long-term goals by turning the funds over to a new manager, leaving his customers to fend for themselves with those time-tested investment strategies. O'Shaughnessy's shareholders might have been less upset if he had given his book a more precise title, for instance, What Used to Work on Wall Street. Until I wrote this book, follow The Foolish Four. In the mid-1990s, the Motley Fool website and several books hyped the daylights out of a technique called The Foolish Four. According to the Motley Fool, you would have trashed the market averages over the last 25 years and could crush your mutual funds by spending only 15 minutes a year on planning your investments. Best of all, this technique had minimal risk. All you needed to do was this. 1. Take the 5 stocks in the Dow Jones Industrial Average with the lowest stock prices and highest dividend yields. 2. Discard the one with the lowest price. 3. Put 40% of your money in the stock with the second lowest price. 4. Put 20% in each of the 3 remaining stocks. 5. 1 year later, sort the Dow the same way and reset the portfolio according to steps 1 through 4.6. Repeat until wealthy. Over a 25-year period, the Motley Fool claimed this technique would have beaten the market by a remarkable 10.1%. In a remarkable irony, the surviving 2 O'Shaughnessy funds, now known as the Hennessy funds, began performing quite well just as O'Shaughnessy announced that he was turning over the management to another company. The fund's shareholders were furious. In a chat room at www.morningstar.com, one fumed, "I guess long-term for Oz is 3 years. I feel your pain." I, too, had faith in Oz's method. I had told several friends and relatives about this fund, and now I'm glad they didn't act on my advice. Points annually. Over the next decades, they suggested $20,000 invested in the Foolish Four should flower into $1,791,000. And they claimed you could do still better by picking the 5 Dow stocks with the highest ratio of dividend yield to the square root of stock price, dropping the one that scored the highest, and buying the next 4. Let's consider whether this strategy could meet Graham's definitions of an investment. What kind of thorough analysis could justify discarding the stock with the single most attractive price and dividend but keeping the 4 that score lower for those desirable qualities? How could putting 40% of your money into only one stock be a minimal risk? And how could a portfolio of only 4 stocks be diversified enough to provide safety of principle? The Foolish Four, in short, was one of the most cockamamie stock-picking formulas ever concocted. The fools made the same mistake as O'Shaughnessy. If you look at a large quantity of data long enough, a huge number of patterns will emerge, if only by chance. By random luck alone, the companies that produce above-average stock returns will have plenty of things in common. But unless those factors cause the stocks to outperform, they can't be used to predict future returns. None of the factors that the Motley Fools discovered with such fanfare, dropping the stock with the best score, doubling up on the one with the second highest score, dividing the dividend yield by the square root of stock price, could possibly cause or explain the future performance of a stock. Money Magazine found that a portfolio made up of stocks whose names contain no repeating letters would have performed nearly as well as the Foolish Four, and for the same reason, luck alone. As Graham never stops reminding us, stocks do well or poorly in the future because the businesses behind them do well or poorly, nothing more and nothing less. 14. See Jason Zweig, False Prophets, Money, August 1999, pp. 55-57. A thorough discussion of the Foolish Four can also be found at willinvestorhome.com/fool.htm. Sure enough, instead of crushing the market, the Foolish Four crushed the thousands of people who were fooled into believing that it was a form of investing. In 2000 alone, the four foolish stocks Caterpillar, Eastman Kodak, SBC, and General Motors lost 14% while the Dow dropped by just 4.7%. As these examples show, there's only one thing that never suffers a bear market on Wall Street: dopey ideas. Each of these so-called investing approaches fell prey to Graham's law. All mechanical formulas for earning higher stock performance are a kind of self-destructive process akin to the law of diminishing returns. There are two reasons the returns fade away. If the formula was just based on random statistical flukes like the foolish four, the mere passage of time will expose that it made no sense in the first place. On the other hand, if the formula actually did work in the past, like the January effect, then by publicizing it, market pundits always erode and usually eliminate its ability to do so in the future. All this reinforces Graham's warning that you must treat speculating as veteran gamblers treat their trips to the casino. You must never delude yourself into thinking that you're investing when you're speculating. Speculating becomes mortally dangerous the moment you begento take it seriously. You must put strict limits on the amount you are willing to wager. Just as sensible gamblers take, say, $100 down to the casino floor and leave the rest of their money locked in the safe in their hotel room, the intelligent investor designates a tiny portion of her total portfolio as a mad money account. For most of us, 10% of our overall wealth is the maximum permissible amount to put at speculative risk. Never mingle the money in your speculative account with what's in your investment accounts. Never allow your speculative thinking to spill over into your investing activities. And never put more than 10% of your assets into your mad money account, no matter what happens. For better or worse, the gambling instinct is part of human nature. So it's futile for most people even to try suppressing it. But you must confine and restrain it. That's the single best way to make sure you will never fool yourself into confusing speculation with investment. Imagine waking up one day to find that your hard-earned savings have lost half their value without you even spending a dime. Sounds terrifying, right? That's the hidden danger of inflation. But legendary investor Benjamin Graham didn't just warn us about it, he gave us a blueprint to fight back. Welcome to Chapter 2 of The Intelligent Investor, where we uncover how inflation silently erodes wealth and, more importantly, how smart investors can turn the tide in their favor. If you want to protect and grow your money, keep watching, because what you don't know about inflation could be costing you more than you think. Here we explore this topic. So let's start Chapter 2, The Investor and Inflation. Inflation and the fight against it has been very much in the public's mind in recent years. The shrinkage in the purchasing power of the dollar in the past, and particularly the fear or hope by speculators of a serious further decline in the future, has greatly influenced the thinking of Wall Street. It is clear that those with a fixed dollar income will suffer when the cost of living advances, and the same applies to a fixed amount of dollar principal. Holders of stocks, on the other hand, have the possibility that a loss of the dollar's purchasing power may be offset by advances in their dividends and the prices of their shares. On the basis of these undeniable facts, many financial authorities have concluded that 1. Bonds are an inherently undesirable form of investment, and 2. Consequently, common stocks are by their very nature more desirable investments than bonds. We have heard of charitable institutions being advised that their portfolios should consist 100% of stocks and 0% of bonds. This is quite a reversal from the earlier days when trust investments were be the late 1990s. This advice, which can be appropriate for a foundation or endowment with an infinitely long investment horizon, had spread to individual investors whose lifespans are finite. In the 1994 edition of his influential book, Stocks for the Long Run, finance professor Jeremy Siegel of the Wharton School recommended that risk-taking investors should buy on margin, borrowing more than a third of their net worth to sink 135% of their assets into stocks. Even government officials got in on the act. In February 1999, the Honorable Richard Dixon, State Treasurer of Maryland, told the audience at an investment conference, "It doesn't make any sense for anyone to have any money in a bond fund restricted by law to high-grade bonds and a few choice preferred stocks." Our readers must have enough intelligence to recognize that even high-quality stocks cannot be a better purchase than bonds under all conditions, regardless of how high the stock market may be and how low the current dividend return compared with the rates available on bonds. A statement of this kind would be as absurd as was the contrary one to often heard years ago, that any bond is safer than any stock. In this chapter, we shall try to apply various measurements to the inflation factor in order to reach some conclusions as to the extent to which the investor may wisely be influenced by expectations regarding future rises in the price level. In this matter, as in so many others in finance, we must base our views of future policy on a knowledge of past experience. Is inflation something new for this country, at least in the serious form it has taken since 1965? If we have seen comparable or worse inflations in living experience, what lessons can be learned from them in confronting the inflation of today? Let us start with Table 2-1, a condensed historical tabulation that contains much information about changes in the general price level and concomitant changes in the earnings and market value of common stocks. Our figures will begin with 1915 and thus cover 55 years presented at Fix's wartime price controls. Year intervals. We use 1946 instead of 1945 to avoid the last year offshould clearly allow for the probability of continuing or recurrent varying rates, some rather small. On this showing, the investor had 3 periods of declining prices and then 6 of advances at the advance of 15% between 1965 and 1970. In between, we have 1920 when the cost of living nearly doubled. This compares with past lots of it. The largest 5-year dose was between 1915, and the first thing we notice is that we have had inflation and the inflation to come. 1965-1970 was 4.5%. That for 1970 alone was 5.4%. Official governed consumer price level for this period has been 2.5%. That for system record of the past 20 years. The average annual rise in the would seem sensible. However, to take our cue from the rather con answer is suggested by our table. It shows variations of all sorts. Can we tell what the rate of inflation is likely to be? No clear mint policy has been strongly against large-scale inflation, and there are some reasons to believe that federal policies will be more effective in the future than in recent years. We think it would be reasonable for an investor at this point to base his thinking and decisions on a probable far from certain rate of future inflation of, say, 3% per annum. This would compare with an annual rate of about 24% for the entire period 1915 to 1970. What would be the implications of such an advance? It would eat up in higher living costs, about 1/2 the income now obtainable on good medium-term tax-free bonds or are assumed after tax equivalent from high-grade corporate bonds. This would be a serious shrinkage, but it should not be exaggerated. It would not mean that the true value or the purchasing power of the investor's fortune need be reduced over the years. If he spent half his interest income after taxes, he would maintain this buying power intact, even against a 3% annual inflation. But the next question naturally is, can the investor be reasonably sure of doing better by buying and holding other things than high-grade bonds, even at the unprecedented rate of return offered in 1970 to 1971? Would not, for example, an all-stock program be preferable to a part bond, part stock program? Do not common stocks have a built-in protection against inflation? And are they not almost certain to give a better return over the years than will bonds? Have not in fact stocks treated the investor far better than have bonds over the 55-year period of our study? The answer to these questions is somewhat complicated. Common stocks have indeed done better than bonds over a long period of time in the past. The rise of the GIA from an average of 77 in 1915 to an average of 753 in 1970 works out at an annual compounded rate of just about 4%, to which we may add another 4% for average dividend return. The corresponding figures for the S&P Composite are about the same. These combined figures of 8. This is one of Graham's rare misjudgments. In 1973, just 2 years after President Richard Nixon imposed wage and price controls, inflation hit 8.7%, its highest level since the end of World War II. The decade from 1973 through 1982 was the most inflationary in modern American history, as the cost of living more than doubled per year are of course much better than the return enjoyed from bonds over the same 55-year period. But they do not exceed that now offered by high-grade bonds. This brings us to the next logical question. Is there a persuasive reason to believe that common stocks are likely to do much better in future years than they have in the last 5½ decades? Our answer to this crucial question must be a flat no. Common stocks may do better in the future than in the past, but they are far from certain to do so. We must deal here with 2 different time elements in investment results. The first covers what is likely to occur over the long-term future, say, the next 25 years. The second applies to what is likely to happen to the investor both financially and psychologically over short or intermediate periods, say 5 years or less. His frame of mind, his hopes and apprehensions, his satisfaction or discontent with what he has done, above all his decisions what to do next, are all determined not in the retrospect of a lifetime of investment, but rather by his experience from year to year. On this point, we can be categorical. There is no close time connection between inflationary or deflationary conditions and the movement of common stock earnings and prices. The obvious example is the recent period, 1966 to 1970. The rise in the cost of living was 22%, the largest in a 5-year period since 1946 to 1950. But both stock earnings and stock prices as a whole have declined since 1965. There are similar contradictions in both directions in the record of previous 5-year periods. Inflation and corporate earnings. Another and highly important approach to the subject is by a study of the earnings rate on capital shown by American business. This has fluctuated, of course, with the general rate of economic activity, but it has shown no general tendency to advance with wholesale prices or the cost of living. Actually, this rate has fallen rather markedly in the past 20 years in spite of the inflation of the period. To some degree, the decline was due to the charging of more liberal depreciation rates. See Table 2-2. Our extended studies have led to the conclusion that the investor cannot count on much above the recent 5-year rate earned on the GIA Group. The intelligent investor 52 about 10% on net tangible assets book value behind the shares. Since the market value of these issues is well above their book value, say 900 market vs 560 book in mid-1971, the earnings on current market price work out only at some 64%. This relationship is generally expressed in the reverse, or times earnings manner. For example, that the GIA price of 900 equals 18 times the actual earnings for the 12 months ended June 1971. Our figures gear indirectly with the suggestion in the previous chapter that the investor may assume an average dividend return of about 3.5% on the market value of his stocks, plus an appreciation of, say, 4% annually resulting from reinvested profits. Note that each dollar added to book value is here assumed to increase the market price by about $1.6. The reader will object that in the end our calculations make no allowance for an increase in common stock earnings and values to result from our projected 3% annual inflation. Our justification is the absence of any sign that the inflation of a comparable amount in the past has had any direct effect on reported per share earnings. The cold figures demonstrate that all the large gain in the earnings of the GIA unit in the past 20 years was due to a proportionately large growth of invested capital coming from reinvested profits. If inflation had operated as a separate favorable factor, its effect would have been to increase the value of previously existing capital. This in turn should increase the rate of earnings on such old capital and therefore on the old and new capital combined. But nothing of the kind actually happened in the past 20 years, during which the wholesale price level has advanced nearly 40%. Boosting net earnings should be influenced more by wholesale prices than by consumer prices. The only way that inflation can add to common stock values is by raising the rate of earnings on capital investment. On the basis of the past record, this has not been the case. In the economic cycles of the past, good business was accompanied by a rising price level and poor business by falling prices. It was generally felt that a little inflation was helpful to business profits. This view is not contradicted by the history of 1950 to 1970, which reveals a combination of generally continued prosperity and generally rising prices. But the figures indicate that the effect of all this on the earning power of common stock capital, equity capital, has been quite limited. In fact, it has not even served to maintain the rate of earnings on the investment. Clearly, there have been important offsetting influences which have prevented any increase in the real profitability of American corporations as a whole. Perhaps the most important of these have been 1. A rise in wage rates exceeding the gains in productivity, and 2. The need for huge amounts of new capital, thus holding down the ratio of sales to capital employed. Our figures in Table 2-2 indicate that so far from inflation having benefited our corporations and their shareholders, its effect has been quite the opposite. The most striking figures in our table are those for the growth of corporate debt between 1950 and 1969. It is surprising how little attention has been paid by economists and by Wall Street to this development. The debt of corporations has expanded nearly fivefold while their profits before taxes a little more than doubled. With the great rise in interest rates during this period, it is evident that the aggregate corporate debt is now ante 2 corporate debt, profits, and earnings on capital, 1950 to 1969 earnings of Standard & Poor's Industrial Index divided by average book value for year. Figures for 1950 and 1955 from Cottle and Whitman, those for 1960 to 1969 from Fortune, adverse economic factor of some magnitude and a real problem for many individual enterprises. Note that in 1950 net earnings after interest but before income tax were about 30% of corporate debt, while in 1969 they were only 13.2% of debt. The 1970 ratio must have been even less satisfactory. In sum, it appears that a significant part of the 11% being earned on corporate equities as a whole is accomplished by the use of a large amount of new debt costing 4% or less after tax credit. If our corporations had maintained the debt ratio of 1950, their earnings rate on stock capital would have fallen still lower in spite of the inflation. The stock market has considered that the public utility enterprises have been a chief victim of inflation, being caught between a great advance in the cost of borrowed money and the difficulty of raising the rates charged under the regulatory process. But this may be the place to remark that the very fact that the unit costs of electricity, gas, and telephone services have advanced so much less than the general price index puts these companies in a strong strategic position for the future. They are entitled by law to charge rates sufficient for an adequate return on their invested capital, and this will probably protect their shareholders in the future as it has in the inflations of the past. All of the above brings us back to our conclusion that the investor has no sound basis for expecting more than an average overall return of, say, 8% on a portfolio of GIA-type common stocks purchased at the late 1971 price level. But even if these expectations should prove to be understated by a substantial amount, the case would not be made for an all-stock investment program. If there is one thing guaranteed for the future, it is that the earnings and average annual market value of a stock portfolio will not grow at the uniform rate of 4% or any other figure. In the memorable words of the elder J.P. Morgan, they will fluctuate. This means, first, that the common stock buyer at today's prices, John Pierpont Morgan, was the most powerful financier of the late 19th and early 20th centuries. Because of his vast influence, he was constantly asked what the stock market would do next. Morgan developed a mercifully short and unfailingly accurate answer: it will fluctuate. See Gene Strauss, Morgan, American Financier Random House, 1999, or tomorrow's will be running a real risk of having unsatisfactory results there from over a period of years. It took 25 years for General Electric and the GIA itself to recover the ground lost in the 1929 to 1932 debacle. Besides that, if the investor concentrates his portfolio on common stocks, he is very likely to be led astray either by exhilarating advances or by distressing declines. This is particularly true if his reasoning is geared closely to expectations of further inflation. For then, if another bull market comes along, he will take the big rise not as a danger signal of an inevitable fall, not as a chance to cash in on his handsome profits, but rather as a vindication of the inflation hypothesis and as a reason to keep on buying common stocks no matter how high the market level nor how low the dividend return. That way lies sorrow. Alternatives to common stocks as inflation hedges standard policy of people all over the world who mistrust their currency has been to buy and hold gold. This has been against the law for American citizens since 1935, luckily for them. In the past 35 years, the price of gold in the open market has advanced from $35 per ounce to $48 in early 1972, a rise of only 35%. But during all this time, the holder of gold has received no income return on his capital and instead has incurred some annual expense for storage. Obviously, he would have done much better with his money at interest in a savings bank in spite of the rise in the general price level. The near-complete failure of gold to protect against a loss in the purchasing power of the dollar must cast grave doubt on the ability of the ordinary investor to protect himself against inflation by putting his money in things. Quite a few categories of valuable. The investment philosopher Peter L. Bernstein feels that Graham was dead wrong about precious metals, particularly gold, which at least in the years after Graham wrote this chapter has shown a robust ability to outpace inflation. Financial advisor William Bernstein agrees, pointing out that a tiny allocation to a precious metals fund, say 2% of your total assets, is too small to hurt your overall returns when gold does poorly. But when gold does well, its returns are often so spectacular, sometimes exceeding. Objects have had striking advances in market value over the years, such as diamonds, paintings by masters, first editions of books, rare stamps and coins, etc. But in many, perhaps most, of these cases, there seems to be an element of the artificial or the precarious or even the unreal about the quoted prices. Somehow, it is hard to think of paying $67,500 for a U.S. silver dollar dated 1804, but not even minted that year, as an investment operation. We acknowledge we are out of our depth in this area. Very few of our readers will find the swimming safe and easy there. The outright ownership of real estate has long been considered as a sound long-term investment, carrying with it a goodly amount of protection against inflation. Unfortunately, real estate values are also subject to wide fluctuations. Serious errors can be made in location, price paid, etc. There are pitfalls in salesmen's wiles. Finally, diversification is not practical for the investor of moderate means, except by various types of participations with others and with the special hazards that attach to new flotations, not too different from common stock ownership. This too is not our field. All we should say to the investor is, be sure it's yours before you go into it. Conclusion: naturally, we return to the policy recommended in our previous chapter. Just because of the uncertainties of the future, the investor cannot afford to put all his funds into one basket, neither in the bond basket, despite the unprecedentedly high returns that bonds have recently offered, nor in the stock basket, despite the prospect of continuing inflation. The more the investor depends on his portfolio and the income therefrom, the more necessary it is for him to guard against in a year that it can, all by itself, set an otherwise lackluster portfolio glittering. However, the intelligent investor avoids investing in gold directly with its high storage and insurance costs. Instead, seek out a well-diversified mutual fund specializing in the stocks of precious metal companies and charging below 1% in annual expenses. Limit your stake to 2% of your total financial assets, or perhaps 5% if you are over the age of 65. Unexpected and the disconcerting in this part of his life, it is axiomatic that the conservative investor should seek to minimize his risks. We think strongly that the risks involved in buying, say, a telephone company bond at yields of nearly 74% are much less than those involved in buying the GIA at 900 or any stock list equivalent thereto. But the possibility of large-scale inflation remains, and the investor must carry some insurance against it. There is no certainty that a stock component will insure adequately against such inflation, but it should carry more protection than the bond component. This is what we said on the subject in our 1965 edition, p. 97, and we would write the same today. It must be evident to the reader that we have no enthusiasm for common stocks at these levels 892 for the GIA. For reasons already given, we feel that the defensive investor cannot afford to be without an appreciable proportion of common stocks in his portfolio, even if we regard them as the lesser of two evils, the greater being the risks in an all-bond holding. Americans are getting stronger. 20 years ago, it took two people to carry $10 worth of groceries. Today, a 5-year-old can do it. Henny young man, inflation. Who cares about that? After all, the annual rise in the cost of goods and services averaged less than 2.2% between 1997 and 2002, and economists believe that even that rock-bottom rate may be overstated. Think, for instance, of how the prices of computers and home electronics have plummeted and how the quality of many goods has risen, meaning that consumers are getting better value for their money. In recent years, the true rate of inflation in the United States has probably run around 1% annually, an increase so infinitesimal that many pundits have proclaimed that inflation is dead. The U.S. Bureau of Labor Statistics, which calculates the consumer price index that measures inflation, maintains a comprehensive and helpful website at www.bls.gov/cpi/home.htm. For a lively discussion of the inflation is dead scenario, see WUPS. Org NewsHour BB Economy, July Dec 97, inflation 1216, Hummel. In 1996, the Boskin Commission, a group of economists asked by the government to investigate whether the official rate of inflation is accurate, estimated that it has been overstated, often by nearly 2 percentage points per year. For the Commission's report, see www.sa.gov/history/reports/boskinrpt.html. Many investment experts now feel that deflation or falling prices is an even greater threat than inflation. The best way to hedge against that risk is by including bonds as a permanent component of your portfolio. See the commentary on Chapter 4, commentary on Chapter 2, The Money Illusion. There's another reason investors overlook the importance of inflation, what psychologists call the money illusion. If you receive a 2% raise in a year when inflation runs at 4%, you will almost certainly feel better than you will if you take a 2% pay cut during a year when inflation is 0. Yet both changes in your salary leave you in a virtually identical position to worse off after inflation. So long as the nominal or absolute change is positive, we view it as a good thing even if the real or after inflation result is negative. And any change in your own salary is more vivid and specific than the generalized change of prices in the economy as a whole. Likewise, investors were delighted to earn 11% on bank certificates of deposit CDs in 1980 and are bitterly disappointed to be earning only around 2% in 2003, even though they were losing money after inflation back then but are keeping up with inflation now. The nominal rate we earn is printed in the bank's ads and posted in its window, where a high number makes us feel good. But inflation eats away at that high number in secret. Instead of taking out ads, inflation just takes away our wealth. That's why inflation is so easy to overlook and why it's so important to measure your investing success not just by what you make, but by how much you keep after inflation. More basically still, the intelligent investor must always be on guard against whatever is unexpected and underestimated. There are 3 good reasons to believe that inflation is not dead. As recently as 1973 to 1982, the United States went through one of the most painful bursts of inflation in our history. As measured by the Consumer Price Index, prices more than doubled over that period, rising at an annualized rate of nearly 9%. In 1979 alone, inflation raged at 13.3%. Paralyzing the economy in what became known as stagflation and leading many commentators to question whether America could compete in the global market. For more insights into this behavioral pitfall, see Eldar Shafir, Peter Diamond, and Amos Tversky, Money Illusion, in Daniel Kahneman and Amos Tversky, eds. Choices, Values, and Frames, Cambridge University Press, 2000 pp. 335355. Commentary on Chapter 2, Place. Goods and services priced at $100 in the beginning of 1973 cost $230 by the end of 1982, shriveling the value of $1 to less than 45 cents. No one who lived through it would scoff at such destruction of wealth. No one who is prudent can fail to protect against the risk that it might recur. Since 1960, 69% of the world's market-oriented countries have suffered at least 1 year in which inflation ran at an annualized rate of 25% or more. On average, those inflationary periods destroyed 53% of an investor's purchasing power. We would be crazy not to hope that America is somehow exempt from such a disaster. But we would be even crazier to conclude that it can never happen here. Rising prices allow Uncle Sam to pay off his debts with dollars that have been cheapened by inflation. Completely eradicating inflation runs against the economic self-interest of any government that regularly borrows money. That year, President Jimmy Carter gave his famous Malaise speech, in which he warned of a crisis in confidence that strikes at the very heart and soul and spirit of our national will and threatens to destroy the social and the political fabric of America. See Stanley Fischer, Ratna Sahay, and Carlos A. Veg, Modern Hyper and High Inflations, National Bureau of Economic Research, Working Paper 8930 at Wunderorger Papers W8930. In fact, the United States has had 2 periods of hyperinflation. During the American Revolution, prices roughly tripled every year from 1777 through 1779, with a pound of butter costing $12 and a barrel of flour fetching nearly $1,600 in revolutionary Massachusetts. During the Civil War, inflation raged at annual rates of 29% in the North and nearly 200% in the Confederacy. As recently as 1946, inflation hit 18.1% in the United States. I am indebted to Lawrence Siegel of the Ford Foundation for this cynical but accurate insight. Conversely, in a time of deflation or steadily falling prices, It's more advantageous to be a lender than a borrower, which is why most investors should keep at least a small portion of their assets in bonds as a form of insurance against deflating prices. Half a hedge watt then can the intelligent investor do to guard against inflation? The standard answer is buy stocks, but as common answers so often are, it is not entirely true. Figure 2-1 shows for each year from 1926 through 2002 the relationship between inflation and stock prices. As you can see, in years when the prices of consumer goods and services fell, as on the left side of the graph, stock returns were terrible, with the market losing up to 43% of its value. When inflation shot above 6%, as in the years on the right end of the graph, stocks also stank. The stock market lost money in 8 of the 14 years in which inflation exceeded 6%. The average return for those 14 years was a measly 2.6%. While mild inflation allows companies to pass the increased costs of their own raw materials onto customers, high inflation wreaks havoc, forcing customers to slash their purchases and depressing activity throughout the economy. The historical evidence is clear. Since the advent of accurate stock market data in 1926, there have been 64 5-year periods, 1926 to 1930, 1927 to 1931, 1928 to 1932, and so on through 1998 to 2002. In 50 of those 64 5-year periods, or 78% of the time, stocks outpaced inflation. That's impressive, but imperfect. It means that stocks fail to keep up with inflation about 1/5 of the time. When inflation is negative, it is technically termed deflation. Regularly falling prices may at first sound appealing until you think of the Japanese example. Prices have been deflating in Japan since 1989, with real estate and the stock market dropping in value year after year, a relentless water torture for the world's second largest economy. Ibbotson Associates, Stocks, Bonds, Bills, and Inflation, 2003 Handbook, Ibbotson Associates, Chicago, 2003, Table 2-8. The same pattern is evident outside the United States. In Belgium, Italy, and Germany, where inflation was especially high in the 20th century, inflation appears to have had a negative impact on both stock and bond markets. Note Roy Dempson, Paul March, and Mike Staunton in Triumph of the Optimists, 101 Years of Global Investment Returns, Princeton University Press, 2002. 2 acronyms to the rescue of foreignly. You can bolster your defenses against inflation by branching out beyond stocks. Since Graham last wrote, 2 inflation fighters have become widely available to investors, REITs. Real estate investment trusts, or REITs pronounced REITs, are companies that own and collect rent from commercial and residential properties. Bundled into real estate mutual funds, REITs do a decent job of combating inflation. The best choice is Vanguard REIT Index Fund. Other relatively low-cost choices include Cohen & Steers Realty Shares, Columbia Real Estate Equity Fund, and Fidelity Real Estate Investment Fund. While a REIT fund is unlikely to be a foolproof inflation fighter, in the long run it should give you some defense against the erosion of purchasing power without hampering your overall returns, TIPS. Treasury Inflation Protected Securities, or TIPS, are U.S. government bonds first issued in 1997 that automatically go up in value when inflation rises. Because the full faith and credit of the United States stands behind them, all Treasury bonds are safe from the risk of default or non-payment of interest. But TIPS also guarantee that the value of your investment won't be eroded by inflation. In one easy package, you insure yourself against financial loss and the loss of purchasing power. 12. There is one catch, however. When the value of your TIPS bond rises as inflation heats up, the Internal Revenue Service regards that increase in value as taxable income, even though it is purely a paper tin thorough, if sometimes outdated. Information on REITs can be found at www.narite.com. For further information, see www.vanguard.com, Waco Henninsters.com, www.columbiafunds.com, and www.fidelity.com. The case for investing in a REIT fund is weaker if you own a home, since that gives you an inherent stake in real estate ownership. 19. A good introduction to TIPS can be found at www.publicdebt.trees.gov/of/ofen-fi in .htm. For more advanced discussions, see Wofeder Rouser. GovPubs Feds 2002-2023 to 2002-23 2PAT PDF www.tiaa-cref-institute.org/publication/raise-the-ag/73_09-002.htm and Watercombe Research I-bonds HM gain unless you sold the bond at. Why does this make sense to the IRS? The intelligent investor will remember the wise words of financial analyst Mark Schwieber. The one question never to ask a bureaucrat is why? Because of this exasperating tax complication, TIPS are best suited for a tax-deferred retirement account like an IRA, KEO, or 401k, where they will not jack up your taxable income. You can buy TIPS directly from the U.S. government at publicdebt.therese.gov/of/ofinflin.htm or in a low-cost mutual fund like Vanguard Inflation Protected Securities or Fidelity Inflation Protected Bond Fund. Either directly or through a fund, TIPS are the ideal substitute for the proportion of your retirement funds you would otherwise keep in cash. Do not trade them. TIPS can be volatile in the short run, so they work best as a permanent, lifelong holding. For most investors, allocating at least 10% of your retirement assets to TIPS is an intelligent way to keep a portion of your money absolutely safe and entirely beyond the reach of the long, invisible claws of inflation. What if I told you that in early 1972, the stock market looked unstoppable, yet a brutal crash was just around the corner? Investors were riding high, but Benjamin Graham saw the warning signs that many ignored. Could history be repeating itself today? Let's dive into Chapter 2 of The Intelligent Investor and uncover the lessons that could save your portfolio. Chapter 3, A Century of Stock Market History. The level of stock prices in early 1972, the investor's portfolio of common stocks will represent a small cross-section of that immense and formidable institution known as the stock market. Prudence suggests that he have an adequate idea of stock market history, in terms particularly of the major fluctuations in its price level and of the varying relationships between stock prices as a whole and their earnings and dividends. With this background, he may be in a position to form some worthwhile judgment of the attractiveness or dangers of the level of the market as it presents itself at different times. By a coincidence, useful statistical data on prices, earnings, and dividends go back just 100 years to 1871. The material is not nearly as full or dependable in the first half period as in the second, but it will serve. In this chapter, we shall present the figures in highly condensed form with two objects in view. The first is to show the general manner in which stocks have made their underlying advance through the many cycles of the past century. The second is to view the picture in terms of successive 10-year averages, not only of stock prices but of earnings and dividends as well, to bring out the varying relationship between the three important factors. With this wealth of material as a background, we shall pass to a consideration of the level of stock prices at the beginning of 1972. The long-term history of the stock market is summarized into tables and a chart. Table 3-1 sets forth the low and high points of 19 bear and bull market cycles in the past 100 years. We have used two indexes here. The first represents a combination of an early study by the Cowles Commission going back to 1870, which has been spliced onto and continued to date in the well-known Standard & Poor's Composite Index of 500 stocks. The second is the even more celebrated Dow Jones Industrial Average, the GIA, or the Dow, which dates back to 1897. It contains 30 companies, of which one is American Telephone and Telegraph, and the other 29 are large industrial enterprises. Chart I, presented by courtesy of Standard & Poor's, depicts the market fluctuations of its 45 industrial stock index from 1900 through 1970. A corresponding chart available for the GIA will look very much the same. The reader will note three quite distinct patterns, each covering about a third of the 70 years. The first runs from 1900 to 1924 and shows for the most part a series of rather similar market cycles lasting from 3 to 5 years. The annual advance in this period averaged just about 3%. We move on to the new era bull market, culminating in 1929 with its terrible aftermath of collapse, followed by quite irregular fluctuations until 1949. Comparing the average level of 1949 with that of 1924, we find the annual rate of advance to be a mere 1. Hence, the close of our second period found the public with no enthusiasm at all for common stocks. By the rule of opposites, the time was ripe for the beginning of the greatest bull market in our history, presented in the last third of our chart. This phenomenon may have reached its culmination in December 1968 at 118 for Standard & Poor's 425 Industrials and 108 for its 500 stock composite. As Table 3-1 shows, there were fairly important setbacks between 1949 and 1968, especially in 1956-57 and 1961-62, but the recoveries therefrom were so rapid that they had to be denominated in the long-accepted semantics as recessions in a single bull market rather than as separate market cycles. Between the low level of 162 for the Dow in mid-1949 and the high of 995 in early 1966, the advance had been more than sixfold in 17 years, which is at the average compounded rate of 11% per year, not counting dividends of, say, 3% per annum. The advance for the Standard & Poor's Composite Index was somewhat greater than that of the GIA, actually from 14 to 96. These 14% and better returns were documented in 1963 and later in a much publicized study. It created a natural satisfaction. The study, in its final form, was Lawrence Fisher and James H. Lowry, Rates of Return on Investments in Common Stock, the year by year on Wall Street, with such fine achievements and a quite illogical and dangerous conviction that equally marvelous results could be expected for common stocks in the future. Few people seem to have been bothered by the thought that the very extent of the rise might indicate that it had been overdone. The subsequent decline from the 1968 high to the 1970 low was 36% for the Standard & Poor's Composite and 37% for the GIA, the largest since the 44% suffered in 1939 to 1942, which had reflected the perils and uncertainties after Pearl Harbor. In the dramatic manner so characteristic of Wall Street, the low level of May 1970 was followed by a massive and speedy recovery of both averages and the establishment of a new all-time high for the Standard & Poor's Industrials in early 1972. The annual rate of price advance between 1949 and 1970 works out at about 9% for the S&P Composite or the Industrial Index, using the average figures for both years. That rate of climb was, of course, much greater than for any similar period before 1950. But in the last decade, the rate of advance was much lower, 54 for the S&P Composite Index and only the once familiar 3% for the GIA. The record of price movements should be supplemented by corresponding figures for earnings and dividends in order to provide an overall view of what has happened to our share economy over the 10 decades. We present a conspectus of this kind in our Table 3-71. It is a good deal to expect from the reader that he study all these figures with care, but for some, we hope they will be interesting and instructive. Let us comment on them as follows. The full decade figures smooth out the year-to-year fluctuations and leave a general picture of persistent growth. Only 2 of the 9 decades after the first show a decrease in earnings and average prices in 1891 to 1900 and 1931-1940, and no decade after 1900 shows a decrease in average dividends. But the rates of growth in all 3 categories are quite variable. In general, the performance since World War II has been superior to that of earlier decades, but the advance in the 1960s was less pronounced than that of the 1950s. Today's investor record, 19-665, the Journal of Business Vol. Zli, number 3 July, 1968, pp. 291316. For a summary of the study's wide influence, see http://library.defoz.com/reprint/work_of_art/. Cannot tell from this record what percentage gain in earnings, dividends, and prices he may expect in the next 10 years, but it does supply all the encouragement he needs for a consistent policy of common stock investment. However, a point should be made here that is not disclosed in our table. The year 1970 was marked by a definite deterioration in the overall earnings posture of our corporations. The rate of profit on invested capital fell to the lowest percentage since the World War years. Equally striking is the fact that a considerable number of companies reported net losses for the year. Many became financially troubled, and for the first time in 3 decades, there were quite a few important bankruptcy proceedings. These facts, as much as any others, have prompted the statement made above that the Great Boom era may have come to an end in 1969 to 1970. A striking feature of Table 3-2 is the change in the price or earnings ratios since World War II. In June 1949, the S&P Composite Index sold at only 6.3 times the applicable earnings of the past 12 months. In March 1961, the ratio was 22.9 times. Similarly, the dividend yield on the S&P index had fallen from over 7% in 1949 to a striking feature of Table 3-2 is the change in the price-earnings ratios since World War II. In June 1949, the S&P Composite Index sold at only 6.3 times the applicable earnings of the past 12 months. In March 1961, the ratio was 22. Similarly, the dividend yield on the S&P index had fallen from over 7% in 1949 to only 3.0% in 1961, a contrast heightened by the fact that interest rates on high-grade bonds had meanwhile risen from 2.6% to. This is certainly the most remarkable turnabout in the public's attitude in all stock market history. To people of long experience and innate caution, the passage from one extreme to another carried a strong warning of true BLE ahead. They could not help thinking apprehensively of the 1926 to 1929 bull market and its tragic aftermath. But these fears have not been confirmed by the event. True, the closing price of the GIA plus, the price-earnings ratio of a stock or of a market average like the S&P 500 stock index is a simple tool for taking the market's temperature. If, for instance, a company earned $1 per share of net income over the past year, and its stock is selling at $8.93 per share, its price or earnings ratio would be 8.93. If, however, the stock is selling at $69.7, then the price or earnings ratio would be 69.7. In general, a price or earnings ratio or PE ratio below 10 is considered low, between 10 and 20 is considered moderate, and greater than 20 is considered expensive. For more on PE ratios, see P 168. In 1970 was the same as it was 6% years earlier, and the much heralded soaring 60s proved to be mainly a march up a series of high hills and then down again. But nothing has happened either to business or to stock prices that can compare with the bear market and depression of 1929 to 1932. The stock market level in early 1972 with a century-long conspectus of stock, prices, earnings, and dividends before our eyes. Let us try to draw some conclusions about the level of 900 for the GIA and 100 for the S&P Composite Index in January 1972. In each of our former editions, we have discussed the level of the stock market at the time of writing and endeavored to answer the question whether it was too high for conservative purchase. The reader may find it informing to review the conclusions we reached on these earlier occasions. This is not entirely an exercise in self-punishment. It will supply a sort of connecting tissue that links the various stages of the stock market in the past 20 years and also a taken-from-life picture of the difficulties facing anyone who tries to reach an informed and critical judgment of current market levels. Let us first reproduce the summary of the 1948, 1953, and 1959 analyses that we gave in the 1965 edition. In 1948, we applied conservative standards to the Dow Jones level of 180 and found no difficulty in reaching the conclusion that it was not too high in relation to underlying values. When we approached this problem in 1953, the average market level for that year had reached 275, a gain of over 50% in 5 years. We asked ourselves the same question, namely, whether in our opinion the level of 275 for the Dow Jones Industrials was or was not too high for sound investment. In the light of the subsequent spectacular advance, it may seem strange to have to report that it was by no means easy for us to reach a definitive conclusion as to the attractiveness of the 1953 level. We did say, positively enough, that from the standpoint of value indications, our chief investment guide, the conclusion about 1953 stock prices must be favorable. But we were concerned about the fact that in 1953, the averages had advanced for a longer period than in most bull markets of the century of stock market history past, and that its absolute level was historically high. Setting these factors against our favorable value judgment, we advised a co-tias or compromise policy. As it turned out, this was not a particularly brilliant counsel. A good prophet would have foreseen that the market level was due to advance an additional 100% in the next 5 years. Perhaps we should add in self-defense that few, if any, of those whose business was stock market forecasting as ours was not had any better inkling than we did of what lay ahead. At the beginning of 1959, we found the GIA at an all-time high of 584. Our lengthy analysis made from all points of view may be summarized in the following from page 59 of the 1959 edition. In sum, we feel compelled to express the conclusion that the present level of stock prices is a dangerous one. It may well be perilous because prices are already far too high. But even if this is not the case, the market's momentum is such as inevitably to carry it to unjustifiable heights. Frankly, we cannot imagine a market of the future in which there will never be any serious losses and in which every tyro will be guaranteed a large profit on his stock purchases. The caution we expressed in 1959 was somewhat better justified by the sequel than was our corresponding attitude in 1954, yet it was far from fully vindicated. The GIA advanced to 685 in 1961, then fell a little below our 584 level to 566 later in the year, advanced again to 735 in late 1961, and then declined in near panic to 536 in May 1962, showing a loss of 27% within the brief. At the same time, there was a far more serious shrinkage in the most popular growth stocks, as evidenced by the striking fall of the indisputable leader, International Business Machines, from a high of 607 in December 1961 to a low of 300 in June 1962. This period saw a complete debacle in a host of newly launched common stocks of small enterprises, the so-called hot issues, which had been offered to the public at ridiculously high prices and then have been further pushed up by needless speculation to levels little short of insane. Many of these lost 90% and more of the quotations in just a few months. The collapse in the first half of 1962 was disconcerting, if not disastrous, to many self-acknowledged speculators and perhaps to many more imprudent people who called themselves investors. But the turnabout that came later that year was equally unsuspected by the financial community. The stock market over ages resumed their upward course, producing the following sequence. The recovery and new ascent of common stock prices was indeed remarkable and created a corresponding revision of Wall Street sentiment. At the low level of June 1962, predictions had appeared predominantly bearish, and after the partial recovery to the end of that year, they were mixed, leaning to the skeptical side. But at the outset of 1964, the natural optimism of brokerage firms was again manifest. Nearly all the forecasts were on the bullish side, and they so continued through the 1964 advance. We then approached the task of appraising the November 1964 levels of the stock market, 892 for the GIA. After discussing it learnedly from numerous angles, we reached three main conclusions. The first was that old standards of valuation appear inapplicable. New standards have not yet been tested by time. The second was that the investor must base his policy on the existence of major uncertainties. The possibilities compass the extremes, on the one hand, of a protracted and further advance in the market's level, say by 50%, or to 1350 for the GIA, or, on the other hand, of a largely unheralded collapse of the same magnitude, bringing the average in the neighborhood of, say, 450.63. The third was expressed in much more definite terms. We said, speaking bluntly, if the 1960 for price level is not too high, how could we say that any price level is too high? And the chapter closed as follows. WHAT course to follow: investors should not conclude that the 1964 market level is dangerous merely because they read it in this book. They must weigh our reasoning against the contrary reasoning they will hear from most competent and experienced people on Wall Street. In the end, each one must make his own decision and accept responsibility therefor. We suggest, however, that if the investor is in doubt as to which course to pursue, he should choose the path of caution. The principles of investment as set forth herein would call for the following policy under 1964 conditions in order of urgency. 1. No borrowing to buy or hold securities. 2. No increase in the proportion of funds held in common stocks. 3. A reduction in common stock holdings where needed to bring it down to a maximum of 50% of the total portfolio. The capital gains tax must be paid with as good grace as possible, and the proceeds invested in first-quality bonds or held as a savings deposit. Investors who for some time have been following a bona fide dollar-cost averaging plan can in logic elect either to continue their periodic purchases unchanged or to suspend them until they feel the market level is no longer dangerous. We should advise rather strongly against the initiation of a new dollar averaging plan at the late 1964 levels, since many investors would not have the stamina to pursue such a scheme if the results soon after initiation should appear highly unfavorable. This time we can say that our caution was vindicated. The GIA advanced about 11% further to 995, but then fell irregularly to a low of 632 in 1970 and finished that year at the same kind of debacle took place in the price of hot issues, with declines running as much as 90 as had happened in the 1961-62 setback. And as pointed out in the introduction, the whole financial picture appeared to have changed in the direction of less enthusiasm and greater doubts. A single fact may summarize the story. The GIA closed 1970 at a level lower than 6 years before the first time such a thing had happened since 1944. Such were our efforts to evaluate former stock market levels. Is there anything we and our readers can learn from them? We considered the market level favorable for investment in 1948 and 1953, but too cautiously in the latter year, dangerous in 1959 at 584 for GIA, and too high at 892 in 1964. All of these judgments could be defended even today by adroit arguments. But it is doubtful if they have been as useful as our more pedestrian counsels in favor of a consistent and controlled common stock policy on the one hand, and discouraging endeavors to beat the market or to pick the winners on the other. Nonetheless, we think our readers may derive some benefit from a renewed consideration of the level of the stock market this time as of late 1971, even if what we have to say will prove more interesting than practically useful or more indicative than conclusive. There is a fine passage near the beginning of Aristotle's Ethics that goes, "It is the mark of an educated mind to expect that amount of exactness which the nature of the particular subject admits. It is equally unreasonable to accept merely probable conclusions from a mathematician and to demand strict demonstration from an orator. The work of a financial analyst falls somewhere in the middle between that of a mathematician and of an orator." At various times in 1971, the Dow Jones Industrial Average stood at the 892 level of November 1964, as we considered in our Preface edition. But in the present statistical study, we have decided to use the price level and the related data for the Standard & Poor's Composite Index, or S&P 500, because it is more comprehensive and representative of the general market than the 30-stock GIA. We shall concentrate on a comparison of this material near the 4 dates of our former editions, namely the year ends of 1948, 1953, 1958, and 1963 plus 1968. For the current price level, we shall take the convenient figure of 100, which was registered at various times in 1971 and in early 1972. The salient data are set forth in Table 3-3. For our earnings figures, we present both the last year's showing and the average of 3 calendar years. For 1971 dividends, we use the last 12 months figures, and for 1971 bond interest and wholesale prices, those of August 1971. The 3-year price or earnings ratio for the market was lower in October 1971 than at year-end 1963 and 1968. It was about the same as in 1958, but much higher than in the early years of the long bull market. This important indicator, taken by itself, could not be construed to indicate that the market was especially high in January 1972. But when the interest yield on high-grade bonds is brought into the picture, the implications become much less favorable. The reader will note from our table that the ratio of stock returns earnings price to bond returns has grown worse during the entire period, so that the January 1972 figure was less favorable to stocks, by this criterion, than in any of the previous years examined. When dividend yields are compared with bond yields, we find that the relationship was completely reversed between 1948 and 1972. In the early years, stocks yielded twice as much as bonds. Now bonds yield twice as much and more than stocks. Our final judgment is that the adverse change in the bond yield-stock yield ratio fully offsets the better price or earnings ratio for late 1971, based on the 3-year earnings figures. Hence, our view of the early 1972 market level would tend to be the same as it was some 7 years ago, that it is an unattractive one from the standpoint of conservative investment. This would apply to most of the 1971 price range of the GIA, between, say, 800 and 950. In terms of historical market swings, the 1971 picture would still appear to be one of irregular recovery from the bad setback suffered in 1969 to 1970. In the past, such recoveries have ushered in a new stage of the recurrent and persistent bull market that began in 1949. This was the expectation of Wall Street generally during 1971. After the terrible experience suffered by the public buyers of low-grade common stock offerings in the 1968 to 1970 cycle, it is too early in 1971 for another twirl of the new issue merry-go-round. Hence, that dependable sign of imminent danger in the market is lacking now, as it was at the 892 level of the GIA in November 1964, considered in our previous edition. Technically, then, the outlook would appear to favor another substantial rise far beyond the 900 GIA level before the next serious setback or collapse. But we cannot quite leave the matter there, as perhaps we should. To us, the early 1971 market's disregard of the harrowing experiences of less than a year before is a disquieting sign. Can such heedlessness go unpunished? We think the investor must be prepared for difficult times ahead, perhaps in the form of a fairly quick replay of the 1969 to 1970 decline, or perhaps in the form of another bull market fling to be followed by a more catastrophic collapse. A century of stock market history-wet course to follow turn back to what we said in the last edition, reproduced on peak 75. This is our view at the same price level, say 900 for the GIA in early 1972 as it was in late 1964. History has a way of repeating itself. Are you prepared? Benjamin Graham's insights from 1972 still hold valuable lessons for today's investors. Do you think the market is overvalued right now? Drop your thoughts in the comments. And if you found this video helpful, don't forget to like, subscribe, and hit the bell so you never miss an update on smart investing strategies. Chapter 4. Portfolio Policy. The defensive investor's basic characteristics of an investment portfolio are usually determined by the position and characteristics of the owner or owners. At one extreme, we have had savings banks, life insurance companies, and so-called legal trust funds. A generation ago, their investments were limited by law in many states to high-grade bonds and, in some cases, high-grade preferred stocks. At the other extreme, we have the well-to-do and experienced businessman who will include any kind of bond or stock in his security list provided he considers it an attractive purchase. It has been an old and sound principle that those who cannot afford to take risks should be content with a relatively low return on their invested funds. From this, there has developed the general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he is ready to run. Our view is different. The rate of return sought should be dependent, rather, on the amount of intelligent effort the investor is willing and able to bring to bear on his task. The minimum return goes to our passive investor who wants both safety and freedom from concern. The maximum return would be realized by the alert and enterprising investor who exercises maximum intelligence and skill. In 1965, we added, in many cases, there may be less real risk associated with buying a bargain issue offering the chance of a large profit than with a conventional bond purchase yielding about 44%. This statement had more truth in it than we ourselves suspected, since in subsequent years, even the best long-term bonds lost a substantial part of their market value because of the rise in interest rates. The basic problem of bond stock allocation have already outlined in briefest form the portfolio policy of the defensive investor. He should divide his funds between high-grade bonds and high-grade common stocks. We have suggested as a fundamental guiding rule that the investor should never have less than 25% or more than 75% of his funds in common stocks, with a consequent inverse range of between 75% and 25% in bonds. There is an implication here that the standard division should be an equal 1 or 50-50 between the two major investment mediums. According to tradition, the sound reason for increasing the percentage in common stocks would be the appearance of the bargain price levels created in a protracted bear market. Conversely, sound procedure would call for reducing the common stock component below 50%, and in the judgment of the investor, the market level has become dangerously high. These copybook maxims have always been easy to enunciate and always difficult to follow because they go against that very human nature which produces the excesses of bull and bear markets. It is almost a contradiction in terms to suggest as a feasible policy for the average stock owner that he lighten his holdings when the market advances beyond a certain point and add to them after a corresponding decline. It is because the average man operates, and apparently must operate, in opposite fashion that we have had the great advances and collapses of the past, and this writer believes we are likely to have them in the future. If the division between investment and speculative operations were as clear now as once it was, we might be able to envisage investors as a shrewd, experienced group who sell out to the heedless, hapless speculators at high prices and buy back from them at depressed levels. This picture may have had some verisimilitude in bygone days, but it is hard to identify it with financial development since 1949. There is no indication that such professional operations as those of the mutual funds have been conducted in this fashion. The percentage of the portfolio held in equities by major types of funds balanced and common stock has changed very little from year to year. Their selling activities have been largely related to endeavors to switch from less to more promising holdings. If, as we have long believed, the stock market has lost contact with its old bounds, and if new ones have not yet been established, then we can give the investor no reliable rules by which to reduce his common stock holdings toward the 25% minimum and rebuild them later to the 75% maximum. We can urge that in general the investor should not have more than one half in equities, unless he has strong confidence in the soundness of his stock position and is sure that he could view a market decline of the 1969-70 type with equanimity. It is hard for us to see how such strong confidence can be justified at the levels existing in early 1972. Thus, we would counsel against a greater than 50% apportionment to common stocks at this time. But, for complementary reasons, it is almost equally difficult to advise a reduction of the figure well below 50%, unless the investor is disquieted in his own mind about the current market level and will be satisfied also to limit his participation in any further rise to, say, 25% of his total funds. We are thus led to put forward for most of our readers what may appear to be an oversimplified 50-50 formula. Under this plan, the guiding rule is to maintain as nearly as practicable an equal deviation between bond and stock holdings. When changes in the market level have raised the common stock component to, say, 55%, the balance would be restored by a sale of 1/11 of the stock portfolio and the transfer of the proceeds to bonds. Conversely, a fall in the common stock proportion to 45% would call for the use of 1/11 of the bond fund to buy additional equities. Yale University followed a somewhat similar plan for a number of years after 1937, but it was geared around a 35% normal holding in common stocks. In the early 1950s, however, Yale seems to have given up its once famous formula, and in 1969 held 61% of its portfolio in equities, including some convertibles. At that time, the endowment funds of 71 such institutions, totaling $7.6 billion, held 60.3% in common stocks. The Yale example illustrates the almost lethal effect of the great market advance upon the once popular formula approach to investment. Nonetheless, we are convinced that our 50-50 version of this approach makes good sense for the defensive investor. It is extremely simple. It aims unquestionably in the right direction. It gives the follower the feeling that he is at least making some moves in response to market developments. Most important of all, it will restrain him from being drawn more and more heavily into common stocks as the market rises to more and more dangerous heights. Furthermore, a truly conservative investor will be satisfied with the gains shown on half his portfolio in a rising market, while in a severe decline he may derive much solace from reflecting how much better off he is than many of his more venturesome friends. While our proposed 50-50 division is undoubtedly the simplest all-purpose program devisable, it may not turn out to be the best in terms of results achieved. Of course, no approach, mechanical or otherwise, can be advanced with any assurance that it will work out better than another. The much larger income return now offered by good bonds than by representative stocks is a potent argument for favoring the bond component. The investor's choice between 50% or a lower figure in stocks may well rest mainly on his own temperament and attitude. If he can act as a cold-blooded weigher of the odds, he would be likely to favor the low 25% stock component at this time, with the idea of waiting until the dividend yield was, say, 2/3 of the bond yield before he would establish his median 50-50 division between bonds and stocks. Starting from $900 for the GIA and dividends of $36 on the unit, this would require either a fall in taxable bond yields from 74% to about 5.5% without any change in the present return on leading stocks, or a fall in the GIA to as low as $660 if there is no reduction in bond yields, and a combination of intermediate changes could produce the same buying point. A program of that kind is not especially complicated. The hard part is to adopt it and to stick to it, not to mention the possibility that it may turn out to have been much too conservative. The bond component, the choice of issues in the bond component of the investor's portfolio, will turn about two main questions. Should he buy taxable or tax-free bonds? And should he buy shorter or longer-term maturities? The tax decision should be mainly a matter of arithmetic, turning on the difference in yields as compared with the investor's tax bracket. In January 1972, the choice in 20-year maturities was between obtaining, say, 7% on grade AA corporate bonds and 5.3% on prime tax-free issues. The term municipals is generally applied to all species of tax-exempt bonds, including state obligations. There was thus for this maturity a loss in income of some 30% in passing from the corporate to the municipal field. Hence, if the investor was in a maximum tax bracket higher than 30%, he would have a net saving after taxes by choosing the Munich IPO bonds. The opposite, if his maximum tax was less than 30%, a single person starts paying a 30% rate when his income after deductions passes $10,000. For a married couple, the rate applies when combined taxable income passes $20,000. It is evident that a large proportion of individual investors would obtain a higher return after taxes from good municipals than from good corporate bonds. The choice of longer versus shorter maturities involves quite a different question. Viz., does the investor want to assure himself against a decline in the price of his bonds, but at the cost of 1, a lower annual yield, and 2, loss of the possibility of an appreciable gain in principal value? We think it best to discuss this question in Chapter 8, The Investor and Market Fluctuations. For a period of many years in the past, the only sensible bond purchases for individuals were the U.S. savings issues. Their safety was and is unquestioned. They gave a higher return than other bond investments of first quality. They had a money-back option and other privileges which added greatly to their attractiveness. In our earlier editions, we had an entire chapter entitled U.S. Savings Bonds, a Boon to Investors. As we shall point out, U.S. savings bonds still possess certain unique merits that make them a suitable purchase by any individual investor. For the man of modest capital with, say, not more than $10,000 to put into bonds, we think they are still the easiest and the best choice. But those with larger funds may find other mediums more desirable. Let us list a few major types of bonds that deserve investor consideration and discuss them briefly with respect to general description, safety, yield, market price, risk, income tax status, and other features. 1. U.S. savings bonds, Series E and Series H. We shall first summarize their important provisions and then discuss briefly the numerous advantages of these unique, attractive, and exceedingly convenient investments. The Series H bonds pay interest semi-annually, as do other bonds. The rate is 4.29% for the first year and then a flat 5.1% for the next 9 years to maturity. Interest on the Series E bonds is not paid out, but accrues to the holder through increase in redemption value. The bonds are sold at 75% of their face value and mature at 100% in 5 years, 10 months after purchase. If held to maturity, the yield works out at 5%, compounded semi-annually. If redeemed earlier, the yield moves up from a minimum of 4.01% in the first year to an average of 5.2% in the next 4% years. Interest on the bonds is subject to federal income tax, but is exempt from state income tax. However, federal income tax on the Series E bonds may be paid at the holder's option either annually as the interest accrues through higher redemption value or not until the bond is actually disposed of. Owners of Series E bonds may cash them in at any time shortly after purchase at their current redemption value. Holders of Series H bonds have similar rights to cash them in at par value cost. Series E bonds are exchangeable for Series H bonds with certain tax advantages. Bonds lost, destroyed, or stolen may be replaced without cost. There are limitations on annual purchases, but liberal provisions for co-ownership by family members make it possible for most investors to buy as many as they can afford. Comment: there is no other investment that combines 1. Absolute assurance of principal and interest payments, 2. The right to demand full money back at any time, and 3. Guarantee of at least a 5% interest rate for at least 10 years. Holders of the earlier issues of Series E bonds have had the right to extend their bonds at maturity and thus to continue to accumulate annual values at successively higher rates. The deferral of income tax payments over these long periods has been of great dollar advantage. We calculate it has increased the effective net after tax rate received by as much as a third in typical cases. Conversely, the right to cash in the bonds at cost price or better has given the purchasers in former years of low interest rates complete protection against the shrinkage in principal value that befell many bond investors. Otherwise stated, it gave them the possibility of benefiting from the rise in interest rates by switching their low interest holdings into very high coupon issues on an even money basis. In our view, the special advantages enjoyed by owners of savings bonds now will more than compensate for their lower current return as compared with other direct government obligations. 2. Other United States bonds. A profusion of these issues exists, covering a wide variety of coupon rates and maturity dates. All of them are completely safe with respect to payment of interest and principal. They are subject to federal income taxes but free from state income tax. In late 1971, the long-term issues over 10 years showed an average yield of 6.09%. Intermediate issues 3 to 5 years returned 6.35%, and short issues returned 6.03%. In 1970, it was possible to buy a number of old issues at large discounts. Some of these are accepted at par in settlement of estate taxes. Example, the U.S. Treasury 3s due 1990 are in this category. They sold at 60 in 1970, but closed 1970 above 77. It is interesting to note also that in many cases, the indirect obligations of the U.S. government yield appreciably more than its direct obligations of the same maturity. As we write, an offering appears of 7.05% of certificates fully guaranteed by the Secretary of Transportation of the Department of Transportation of the United States. The yield was fully 1% more than that on direct obligations of the U.S., maturing the same year 1986. The certificates were actually issued in the name of the trustees of the Penn Central Transportation Co., but they were sold on the basis of a statement by the U.S. Attorney General that the guarantee brings into being a general obligation of the United States, backed by its full faith and credit. Quite a number of indirect obligations of this sort have been assumed by the U.S. government in the past, and all of them have been scrupulously honored. The reader may wonder why all this hocus pocus involving an apparently personal guarantee by our Secretary of Transport tie-in and a higher cost to the taxpayer in the end. The chief reason for the indirection has been the debt limit imposed on government borrowing by the Congress. Apparently, guarantees by the government are not regarded as debts, a semantic windfall for shrewder investors. Perhaps the chief impact of this situation has been the creation of tax-free housing authority bonds, enjoying the equivalent of a U.S. guarantee, and virtually the only tax-exempt issues that are equivalent to government bonds. Another type of government-backed issues is the recently created new community debentures offered to yield 7.6% in September 1971. 3. State and municipal bonds. These enjoy exemption from federal income tax. They are also ordinarily free of income tax in the state of issue but not elsewhere. They are either direct obligatines of a state or subdivision, or revenue bonds dependent for interest payments on receipts from a toll road, bridge, building lease, etc. Not all tax-free bonds are strongly enough protected to justify their purchase by a defensive investor. He may be guided in his selection by the rating given to each issue by Moody's or Standard & Poor's. One of 3 highest ratings by both services, AAA, AAA, or should constitute a sufficient indication of adequate safety. The yield on these bonds will vary both with the quality and the maturity, with the shorter maturities giving the lower return. In late 1971, the issues represented in Standard & Poor's Municipal Bond Index averaged AA in quality rating, 20 years in maturity, and 5.78% in yield. A typical offering of Vineland NG bonds rated AA for and gave a yield of only 3% on the 1-year maturity, rising to 5.8% to the 1995 and 1994 corporation bonds. These bonds are subject to both federal and state tax. In early 1972, those of highest quality yielded 7.19% for a 25-year maturity, as reflected in the published yield of Moody's AAA Corporate Bond Index. The so-called lower medium grade issues rated BAA returned 8.23% for long maturities. In each class, shorter term issues would yield somewhat less than longer term obligations. Comment: the above summaries indicate that the average investor has several choices among high-grade bonds. Those in high-income tax brackets can undoubtedly obtain a better net yield from good tax-free issues than from taxable ones. For others, the early 1972 range of taxable yield would seem to be from 5.0% on U.S. savings bonds with their special options to about 74% on high-grade corporate issues. Higher-yielding bond investments be sacrificing quality. An investor can obtain a higher income return from his bonds. Long experience has demonstrated that the ordinary investor is wiser to keep away from such high-yield bonds. While taken as a whole, they may work out somewhat better in terms of overall return than the first quality issues. They expose the owner to too many individual risks of untoward development, ranging from disquieting price declines to actual default. It is true that bargain opportunities occur fairly often in lower grade bonds, but these require special study and skill to exploit successfully. Perhaps we should add here that the limits imposed by Congress on direct bond issues of the United States have produced at least two sorts of bargain opportunities for investors in the purchase of government-backed obligations. One is provided by the tax-exempt new housing issues, and the other by the recently created taxable new community debentures. An offering of new housing issues in July 1971 yielded as high as 5.8%, free from both federal and state taxes, while an issue of taxable new community debentures sold in September 1971 yielded 7.6%. Both obligations have the full faith and credit of the United States government behind them and hence are safe without question. And on a net basis, they yield considerably more than ordinary United States bonds. T. Graham's objection to high-yield bonds is mitigated today by the widespread availability of mutual funds that spread the risk and do the research of owning junk bonds. See the commentary on Chapter 6 for more detail. Plus, the new housing bonds and new community debentures are no more. New Housing Authority bonds were backed by the U.S. Department of Housing and Urban Development (HUD) and were exempt from income tax, but they have not been issued since 1974. New community debentures, also backed by HUD, were authorized by a federal law passed in 1968. About $350 million of these debentures were issued through 1975, but the program was terminated in 1983. Savings deposits in lieu of bonds. An investor may now obtain as high an interest rate from a savings deposit in a commercial or savings bank or from a bank certificate of deposit as he can from a first-grade bond of short maturity. The interest rate on bank savings accounts may be lowered in the future, but under present conditions, they are a suitable substitute for short-term bond investment by the individual. Convertible equity are discussed in Chapter 16. The price variability of bonds in general is treated in Chapter 8, the investor and market fluctuations. Call provisions. In previous editions, we had a fairly long discussion of this aspect of bond financing because it involved a serious but little noticed injustice to the investor. In the typical case, bonds were callable fairly soon after issuance and at modest premiums, say 5 above the issue price. This meant that during a period of wide fluctuations in the underlying interest rates, the investor had to bear the full brunt of unfavorable changes and was deprived of all but a meager participation in favorable ones. Example. Our standard example has been the issue of American Gas and Electric 100-year 5% debentures sold to the public at 101 in 1928. 4 years later, under near-panic conditions, the price of these good bonds fell to 62%, yielding 8%. By 1946, in a great reversal, bonds of this type could be sold to yield only 3%, and the 5% issue should have been quoted at close to 160. But at that point, the company took advantage of the call provision and redeemed the issue at a mere 106. The call feature in these bond contracts was a thinly disguised instance of heads I win, tails you lose. At long last, the bond-buying institutions refused to accept this unfair arrangement. In recent years, most long-term high-coupon issues have been protected against redemption for 10 years or more after issuance. This still limits their possible price rise, but not inequitably. In practical terms, we advise the investor in long-term issues to sacrifice a small amount of yield to obtain the assurance of non-callability, say for 20 or 25 years. Similarly, there is an advantage in buying a low-coupon bond at a discount rather than a high-coupon bond selling at about par and callable in a few years. For the discount, for example, of a 3% bond at 63, yielding 7.85 carries full protection against adverse call action. Straight-eyed non-convertible preferred stock. Certain general observations should be made here on the subject of preferred stocks. Really good preferred stocks can and do exist, but they are good in spite of their investment form, which is an inherently bad one. The typical preferred shareholder is dependent for his safety on the ability and desire of the company to pay dividends on its common stock. Once the common dividends are omitted or even in danger, his own position becomes precarious, for the directors are under no obligation to continue paying him unless they also pay on the common. On the other hand, the typical preferred stock carries no share in the company's profits beyond the fixed dividend rate. Thus, the preferred holder lacks both the legal claim of the bondholder or creditor and the profit possibilities of a common shareholder or partner. These weaknesses in the legal position of preferred stocks tend to come to the fore recurrently in periods of depression. Only a small percentage of all preferred issues are so strongly entrenched as to maintain an unquestioned investment status through all vicissitudes. Experience teaches that the time to buy preferred stocks is when their price is unduly depressed by temporary adversity. At such times, they may be well suited to the aggressive investor but too unconventional for the defensive investor. In other words, they should be bought on a bargain basis or not at all. We shall refer later to convertible and similarly privileged issues which carry some special possibilities of profits. These are not ordinarily selected for a conservative portfolio. Another peculiarity in the general position of preferred stocks. A bond's coupon is its interest rate. A low coupon bond pays a rate of interest income below the market average. General Portfolio Policy 99 deserves mention. They have a much better tax status for corporate tie-in buyers than for individual investors. Corporations pay income tax on only 15% of the income they receive in dividends, but on the full amount of their ordinary interest income. Since the 1972 corporate rate is 48%, this means that $100 received as preferred stock dividends is taxed only $7.2, whereas $100 received as bond interest is taxed $48. On the other hand, individual investors pay exactly the same tax on preferred stock investments as on bond interest, except for a recent minor exemption. Thus, in strict logic, all investment-grade preferred stocks should be bought by corporations, just as all tax-exempt bonds should be bought by investors who pay income tax. Security forms, bond form, and the preferred stock form, as hitherto discussed, are well understood and relatively simple matters. A bondholder is entitled to receive fixed interest and payment of principal on a definite date. The owner of a preferred stock is entitled to a fixed dividend, and no more, which must be paid before any common dividend. His principal value does not come due on any specified date. The dividend may be cumulative or non-cumulative. He may or may not have a vote. The above describes the standard provisions and, no doubt, the majority of bond and preferred issues, but there are innumerable departures from these forms. The best-known types are convertible and similar issues and income bonds. In the latter type, interest does not have to be paid unless it is earned by the company. Unpaid interest may accumulate as a charge against future earnings, but the period is often limited to 3 years. Income bonds should be used by corporations much more. While Graham's logic remains valid, the numbers have changed. Corporate tie-ins can currently deduct 70% of the income they receive from dividends, and the standard corporate tax rate is 35%. Thus, a corporation would pay roughly $24.5 in tax on $100 in dividends from preferred stock versus $35 in tax on $100 in interest income. Individuals pay the same rate of income tax on dividend income that they do on interest income, so preferred stock offers them no tax advantage. Extensively than they are. Their avoidance apparently arises from a mere accident of economic history, namely that they were first employed in quantity in connection with railroad reorganizations, and hence they have been associated from the start with financial weakness and poor investment status. But the form itself has several practical advantages, especially in comparison with and in substitution for the numerous convertible preferred stock issues of recent years. Chief of these is the deductibility of the interest paid from the company's taxable income, which in effect cuts the cost of that form of capital in half. From the investor's standpoint, it is probably best for him in most cases that he should have an unconditional right to receive interest payments when they are earned by the company, and a right to other forms of protection than bankruptcy proceedings if interest is not earned and paid. The terms of income bonds can be tailored to the advantage of both the borrower and the lender in the manner best suited to both. Conversion privileges can, of course, be included. The acceptance by everybody of the inherently weak preferred stock form and the rejection of the stronger income bond form is a fascinating illustration of the way in which traditional institutions and habits often tend to persist on Wall Street despite new conditions calling for a fresh point of view. With every new wave of optimism or pessimism, we are ready to abandon history and time-tested principles, but we cling tenaciously and unquestioningly to our prejudices. Treasury securities as obligations of the U.S. government carry. For more information, see www.vanguard.com, www.fidelity.com, www.schwab.com, and www.troprice.com. 10 For an accessible online summary of bond investing, see www.aii.com/promos/200-1118/bonds.html. Virtually no credit risk since, instead of defaulting on his debts, Uncle Sam can just jack up taxes or print more money at will. Treasury bills mature in 4, 13, or 26 weeks. Because of their very short maturities, T-bills barely get dented when rising interest rates knock down the prices of other income investments. Longer-term Treasury debt, however, suffers severely when interest rates rise. The interest income on Treasury securities is generally free from state but not federal income tax. And with $3.7 trillion in public hands, the market for Treasury debt is immense, so you can readily find a buyer if you need your money back before maturity. You can buy Treasury bills, short-term notes, and long-term bonds directly from the government with no brokerage fees at www.publicdebt.tres.gov. For more on inflation-protected TIPS, see the commentary on Chapter 2. Savings bonds, unlike treasuries, are not marketable. You cannot sell them to another investor, and you'll forfeit 3 months of interest if you redeem them in less than 5 years. Thus, they are suitable mainly as set-aside money to meet a future spending need, a gift for a religious ceremony that's years away, or a jump start on putting your newborn through Harvard. They come in denominations as low as $25, making them ideal as gifts to grandchildren. For investors who can confidently leave some cash untouched for years to come, inflation-protected I-bonds recently offered an attractive yield of around 4%. To learn more, see Wazaving's Bondism Beyond Uncle Sam Mortgage Securities. Pooled together from thousands of mortgages around the United States, these bonds are issued by agencies like the Federal National Mortgage Association, Fannie Mae, or the Government National Mortgage Association, Ginnie Mae. However, they are not backed by the U.S. Treasury, so they sell at higher yields to reflect their greater risk. Mortgage bonds generally underperform when interest rates fall and bomb when rates rise. Over the long run, those swings tend to even out and the higher average yields pay off. Good mortgage bond funds are available from Vanguard, Fidelity, and PIMCO. But if a broker ever tries to sell you an individual mortgage bond or CMO, tell him you are late for an appointment with your proctologist. Annuities. These insurance-like investments enable you to defer current taxes and capture a stream of income after you retire. Fixed annuities offer a set rate of return. Variable ones provide a fluctuating return. But what the defensive investor really needs to defend against here are the hard-selling insurance agents, stockbrokers, and financial planners who peddle annuities at rapaciously high costs. In most cases, the high expenses of owning an annuity, including surrender charges that gnaw away at your early withdrawals, will overwhelm its advantages. The few good annuities are bought, not sold. If an annuity produces fat commissions for the seller, chances are it will produce meager results for the buyer. Consider only those you can buy directly from providers with rock-bottom costs like Ameritas, Chiacref, and Vanguard. In general, variable annuities are not attractive for investors under the age of 50 who expect to be in a high tax bracket during retirement or who have preferred stock. Preferred shares are a worst of both worlds investment. They are less secure than bonds since they have only a secondary claim on a company's assets if it goes bankrupt. And they offer less profit potential than common stocks do, since companies typically call or forcibly buy back their preferred shares when interest rates drop or their credit rating improves. Unlike the interest payments on most of its bonds, an issuing company cannot deduct preferred dividend payments from its corporate tax bill. Ask yourself, if this company is healthy enough to deserve my investment, why is it paying a fat dividend on its preferred stock instead of issuing bonds and getting a tax break? The likely answer is that the company is not healthy, the market for its bonds is glutted, and you should approach its preferred shares as you would approach an unrefrigerated dead fish. Common stock. A visit to the stock screener at http://yahoo.com/stocks.html in early 2003 showed that 115 of the stocks in the Standard & Poor's 500 index had dividend yields of 3.0% or greater. No intelligent investor, no matter how starved for yield, would ever buy a stock for its dividend income alone. The company and its businesses must be solid, and its stock price must be reasonable. But thanks to the bear market that began in 2000, some leading stocks are now out-yielding treasury bonds. So even the most defensive investor should realize that selectively adding stocks to an all-bond or mostly bond portfolio can increase its income yield and raise its potential return. 12 not already contributed the maximum to their existing 401k or IRA accounts. Fixed annuities, with the notable exception of those from TIAA-CREF, can change their guaranteed rates and smack you with nasty surrender fees. Comment. The above summaries indicate that the average investor has several choices among high-grade bonds. Those in high-income tax brackets can undoubtedly obtain a better net yield from good tax-free issues than from taxable ones. For others, the early 1972 range of taxable yield would seem to be from 5.0% on U.S. savings bonds, with their special options, to about 74% on high-grade corporate issues. Higher-yielding bond investments be sacrificing quality. An investor can obtain a higher income return from his bonds. Long experience has demonstrated that the ordinary investor is wiser to keep away from such high-yield bonds. While taken as a whole, they may work out somewhat better in terms of overall return than the first quality issues. They expose the owner to too many individual risks of untoward development, ranging from disquieting price declines to actual default. It is true that bargain opportunities occur fairly often in lower grade bonds, but these require special study and skill to exploit successfully. Perhaps we should add here that the limits imposed by Congress on direct bond issues of the United States have produced at least two sorts of bargain opportunities for investors in the purchase of government-backed obligations. One is provided by the tax-exempt new housing issues, and the other by the recently created taxable new community debentures. An offering of new housing issues in July 1971 yielded as high as 5.8%, free from both federal and state taxes, while an issue of taxable new community debentures sold in September 1971 yielded 7.6%. Both obligations have the full faith and credit of the United States government behind them and hence are safe without question. And on a net basis, they yield considerably more than ordinary United States bonds. T. Graham's objection to high-yield bonds is mitigated today by the widespread availability of mutual funds that spread the risk and do the research of owning junk bonds. See the commentary on Chapter 6 for more detail. Plus, the new housing bonds and new community debentures are no more. New Housing Authority bonds were backed by the U.S. Department of Housing and Urban Development (HUD) and were exempt from income tax, but they have not been issued since 1974. New community debentures, also backed by HUD, were authorized by a federal law passed in 1968. About $350 million of these debentures were issued through 1975, but the program was terminated in 1983. Savings deposits in lieu of bonds. An investor may now obtain as high an interest rate from a savings deposit in a commercial or savings bank or from a bank certificate of deposit as he can from a first-grade bond of short maturity. The interest rate on bank savings accounts may be lowered in the future, but under present conditions, they are a suitable substitute for short-term bond investment by the individual. Convertible equity are discussed in Chapter 16. The price variability of bonds in general is treated in Chapter 8, the investor and market fluctuations. Call provisions. In previous editions, we had a fairly long discussion of this aspect of bond financing because it involved a serious but little noticed injustice to the investor. In the typical case, bonds were callable fairly soon after issuance and at modest premiums, say 5 above the issue price. This meant that during a period of wide fluctuations in the underlying interest rates, the investor had to bear the full brunt of unfavorable changes and was deprived of all but a meager participation in favorable ones. Example. Our standard example has been the issue of American Gas and Electric 100-year 5% debentures sold to the public at 101 in 1928. 4 years later, under near-panic conditions, the price of these good bonds fell to 62%, yielding 8%. By 1946, in a great reversal, bonds of this type could be sold to yield only 3%, and the 5% issue should have been quoted at close to 160. But at that point, the company took advantage of the call provision and redeemed the issue at a mere 106. The call feature in these bond contracts was a thinly disguised instance of heads I win, tails you lose. At long last, the bond-buying institutions refused to accept this unfair arrangement. In recent years, most long-term high-coupon issues have been protected against redemption for 10 years or more after issuance. This still limits their possible price rise, but not inequitably. In practical terms, we advise the investor in long-term issues to sacrifice a small amount of yield to obtain the assurance of non-callability, say for 20 or 25 years. Similarly, there is an advantage in buying a low coupon bond at a discount rather than a high coupon bond selling at about par and callable in a few years. For the discount, for example, of a 3% bond at 63, yielding 7.85 carries full protection against adverse call action. Straight-eyed non-convertible preferred stock. Certain general observations should be made here on the subject of preferred stocks. Really good preferred stocks can and do exist, but they are good in spite of their investment form, which is an inherently bad one. The typical preferred shareholder is dependent for his safety on the ability and desire of the company to pay dividends on its common stock. Once the common dividends are omitted or even in danger, his own position becomes precarious, for the directors are under no obligation to continue paying him unless they also pay on the common. On the other hand, the typical preferred stock carries no share in the company's profits beyond the fixed dividend rate. Thus, the preferred holder lacks both the legal claim of the bondholder or creditor and the profit possibilities of a common shareholder or partner. These weaknesses in the legal position of preferred stocks tend to come to the fore recurrently in periods of depression. Only a small percentage of all preferred issues are so strongly entrenched as to maintain an unquestioned investment status through all vicissitudes. Experience teaches that the time to buy preferred stocks is when their price is unduly depressed by temporary adversity. At such times, they may be well suited to the aggressive investor but too unconventional for the defensive investor. In other words, they should be bought on a bargain basis or not at all. We shall refer later to convertible and similarly privileged issues which carry some special possibilities of profits. These are not ordinarily selected for a conservative portfolio. Another peculiarity in the general position of preferred stocks. A bond's coupon is its interest rate. A low coupon bond pays a rate of interest income below the market average. General Portfolio Policy 99 deserves mention. They have a much better tax status for corporate tie-in buyers than for individual investors. Corporations pay income tax on only 15% of the income they receive in dividends, but on the full amount of their ordinary interest income. Since the 1972 corporate rate is 48%, this means that $100 received as preferred stock dividends is taxed only $7.2, whereas $100 received as bond interest is taxed $48. On the other hand, individual investors pay exactly the same tax on preferred stock investments as on bond interest, except for a recent minor exemption. Thus, in strict logic, all investment-grade preferred stocks should be bought by corporations, just as all tax-exempt bonds should be bought by investors who pay income tax. Security forms, bond form, and the preferred stock form, as hitherto discussed, are well understood and relatively simple matters. A bondholder is entitled to receive fixed interest and payment of principal on a definite date. The owner of a preferred stock is entitled to a fixed dividend, and no more, which must be paid before any common dividend. His principal value does not come due on any specified date. The dividend may be cumulative or non-cumulative. He may or may not have a vote. The above describes the standard provisions and, no doubt, the majority of bond and preferred issues, but there are innumerable departures from these forms. The best-known types are convertible and similar issues and income bonds. In the latter type, interest does not have to be paid unless it is earned by the company. Unpaid interest may accumulate as a charge against future earnings, but the period is often limited to 3 years. Income bonds should be used by corporations much more. While Graham's logic remains valid, the numbers have changed. Corporate tie-ins can currently deduct 70% of the income they receive from dividends, and the standard corporate tax rate is 35%. Thus, a corporation would pay roughly $24.5 in tax on $100 in dividends from preferred stock versus $35 in tax on $100 in interest income. Individuals pay the same rate of income tax on dividend income that they do on interest income, so preferred stock offers them no tax advantage. Extensively than they are. Their avoidance apparently arises from a mere accident of economic history, namely that they were first employed in quantity in connection with railroad reorganizations, and hence they have been associated from the start with financial weakness and poor investment status. But the form itself has several practical advantages, especially in comparison with and in substitution for the numerous convertible preferred stock issues of recent years. Chief of these is the deductibility of the interest paid from the company's taxable income, which in effect cuts the cost of that form of capital in half. From the investor's standpoint, it is probably best for him in most cases that he should have an unconditional right to receive interest payments when they are earned by the company, and a right to other forms of protection than bankruptcy proceedings if interest is not earned and paid. The terms of income bonds can be tailored to the advantage of both the borrower and the lender in the manner best suited to both. Conversion privileges can, of course, be included. The acceptance by everybody of the inherently weak preferred stock form and the rejection of the stronger income bond form is a fascinating illustration of the way in which traditional institutions and habits often tend to persist on Wall Street despite new conditions calling for a fresh point of view. With every new wave of optimism or pessimism, we are ready to abandon history and time-tested principles, but we cling tenaciously and unquestioningly to our prejudices. Chapter 5, The Defensive Investor and Common Stocks Investment Merits of Common Stocks. In our first edition 19 for 9, we found it necessary at this point to insert a long exposition of the case for including a substantial common stock component in all investment portfolios. Common stocks were generally viewed as highly speculative and therefore unsafe. They had declined fairly substantially from the high levels of 1946, but instead of attracting investors to them because of their reasonable prices, this fall had had the opposite effect of undermining confidence in equity securities. We have commented on the converse situation that has developed in the ensuing 20 years, whereby the big advance in stock prices made them appear safe and profitable investments at record high levels, which might act to ally carry with them a considerable degree of risk. The argument we made for common stocks in 1949 turned on. At the beginning of 1949, the average annual return produced by stocks over the previous 20 years was 3.1% versus 3.9% for long-term treasury bonds, meaning that $10,000 invested in stocks would have grown to $18,415 over that period, while the same amount in bonds would have turned into $21,494. Naturally enough, 1949 turned out to be a fabulous time to buy stocks. Over the next decade, the Standard & Poor's 500 stock index gained an average of 20.1% per year, one of the best long-term returns in the history of the U.S. stock market. Plus, Graham's earlier comments on this subject appear on pp. 19-20. Just imagine what he would have thought about the stock market of the late 1990s, in which each new record-setting high was considered further proof that stocks were the riskless way to wealth. Two main points. The first was that they had offered a considerable degree of protection against the erosion of the investor's dollar caused by inflation, whereas bonds offered no protection at all. The second advantage of common stocks lay in their higher average return to investors over the years. This was produced both by an average dividend income exceeding the yield on good bonds and by an underlying tendency for market value to increase over the years in consequence of the reinvestment of undistributed profits. While these two advantages have been of major importance and have given common stocks a far better record than bonds over the long-term past, we have consistently warned that these benefits could be lost by the stock buyer if he pays too high a price for his shares. This was clearly the case in 1929, and it took 25 years for the market level to climb back to the ledge from which it had abysmally fallen in 1929 to 1932. Since 1957, common stocks have once again, through their high prices, lost their traditional advantage in dividend yield over bond interest rates. It remains to. The Dow Jones Industrial Average closed at a then record high of 381.17 on September 3, 1929. It did not close above that level until November 23rd, 1954, more than a quarter of a century later, when it hit 382.74. When you say you intend to own stocks for the long run, do you realize just how long the long run can be, or that many investors who bought in 1929 were no longer even alive by 1954? However, for patient investors who reinvested their income, stock returns were positive over this otherwise dismal period, simply because dividend yields averaged more than 5.6% per year. According to Professors Elroy Dimson, Paul Marsh, and Mike Staunton of London Business School, if you had invested $1 in U.S. stocks in 1900 and spent all your dividends, your stock portfolio would have grown to $198 by 2000. But if you had reinvested all your dividends, your stock portfolio would have been worth $16,797. Far from being an afterthought, dividends are the greatest force in stock investing. Plus, why do the high prices of stocks affect their dividend yields? A stock's yield is the ratio of its cash dividend to the price of one share of common stock. If a company pays a $2 annual dividend when its stock price is $100 per share, its yield is 2%. But if the stock price doubles while the dividend stays constant, the dividend yield will drop to 1%. In 1959, when the trend Graham spotted in 1957 became noticeable to everyone, most Wall Street be seen whether the inflation factor and the economic growth factor will make up in the future for this significantly adverse development. It should be evident to the reader that we have no enthusiasm for common stocks in general at the 900 GA level of late 1971. For reasons already given, we feel that the defensive investor cannot afford to be without an appreciable proportion of common stocks in his portfolio, even if he must regard them as the lesser of two evils, the greater being the risks attached to an all-bond holding. Rules for the common stock component. The selection of common stocks for the portfolio of the defensive investor should be a relatively simple matter. Here, we would suggest 4 rules to be followed. 1. There should be adequate, though not excessive, diversification. This might mean a minimum of 10 different issues and a maximum of about 30 T2. Each company selected should be large, prominent, and conservatively financed. Indefinite as these adjectives must be, their general sense is clear. Observations on this point are added at the end of the chapter. 3. Each company should have a long record of continuous dividend payments. All the issues in the Dow Jones Industrial Average pundits declared that it could not possibly last. Never before had stocks yielded less than bonds. After all, since stocks are riskier than bonds, why would anyone buy them at all unless they pay extra dividend income to compensate for their greater risk? The experts argued that bonds would outyield stocks for a few months at most, and then things would revert to normal. More than 4 decades later, the relationship has never been normal again. The yield on stocks has so far continuously stayed below the yield on bonds. Plus, for another view of diversification, see the sidebar in the commentary. Onage met this dividend requirement in 1971. To be specific on this point, we would suggest the requirement of continuous dividend payments beginning at least in 1954. The investor should impose some limit on the price he will pay for an issue in relation to its average earnings over, say, the past 7 years. We suggest that this limit be set at 25 times such average earnings, and not more than 20 times those of the last 12-month period. But such a restriction would eliminate nearly all the strongest and most popular companies from the portfolio. In particular, it would ban virtually the entire category of growth stocks, which have for some years past been the favorites of both speculators and institutional investors. We must give our reasons for proposing so drastic an exclusion. Growth stocks and the defensive investor. The term growth stock is applied to one which has increased its per share earnings in the past at well above the rate for common stocks generally and is expected to continue to do so in the future. Some authorities would say that a true growth stock should be expected at least to double its per share earnings in 10 years, to increase them at a compounded annual rate of over 7.1. Plus, obviously, stocks of this kind are attractive to buy and to own, provided the price paid is not excessive. The problem lies thereof. Today's defensive investors should probably insist on at least 10 years of continuous dividend payments, which would eliminate from consideration only one member of the Dow Jones Industrial Average, Microsoft, and would still leave at least 317 stocks to choose from among the S&P 500 index. Even insisting on 20 years of uninterrupted dividend payments would not be overly restrictive. According to Morgan Stanley, 255 companies in the S&P 500 met that standard as of year-end 2002. Plus, the rule of 72 is a handy mental tool. To estimate the length of time and amount of money takes to double, simply divide its assumed growth rate into 72. At 6%, for instance, money will double in 12 years. 72 divided by 612. At the 7.1% rate cited by Graham, a growth stock will double its earnings in just over 10 years, 70 to 7, 10.1 years. Of course, since growth stocks have long sold at high prices in relation to current earnings and at much higher multiples of their average profits over a past period. This has introduced a speculative element of considerable weight in the growth stock picture and has made successful operations in this field a far from simple matter. The leading growth issue has long been international business machines, and it has brought phenomenal rewards to those who bought it years ago and held onto it tenaciously. But we have already pointed out that this best of common stocks actually lost 50% of its market price in a 6-month decline during 1961-62 and nearly the same percentage in 1969-70. Other growth stocks have been even more vulnerable to adverse developments. In some cases, not only has the price fallen back, but the earnings as well, thus causing a double discomfiture to those who own them. A good second example for our purpose is Texas Instruments, which in 6 years rose from 5 to 256 without paying a dividend, while its earnings increased from 40 cents to $3.91 per share. Note that the price advanced 5 times as fast as the profits. This is characteristic of popular common stocks. But 2 years later, the earnings had dropped off by nearly 50% and the price by 4/5 to 49t. The reader will understand from these instances why we regard growth stocks as a whole as too uncertain and risky a vehicle for the defensive investor. Of course, wonders can be accomplished with the right individual selections, bought at the right levels, and later sold after a huge rise and before the probable decline. But the average investor can no more expect to accomplish this than to find money growing on trees. In contrast, we think that the group of plus to show that Graham's observations are perennially true, we can substitute Microsoft for IBM and Cisco for Texas Instruments. 30 years apart, the results are uncannily similar. Microsoft stock dropped 55.7% from 2000 through 2002, while Cisco stock, which had risen roughly 50-fold over the previous 6 years, lost 76% of its value from 2000 through 2002. As with Texas Instruments, the drop in Cisco's stock price was sharper than the fall in its earnings, which dropped just 39.2%, comparing the 3-year average for 1997 to 1999 against 2000 to 2002. As always, the hotter they are, the harder they fall. Large companies that are relatively unpopular and therefore obtainable at reasonable earnings multipliers offers a sound if unspectacular area of choice by the general public. We shall illustrate this idea in our chapter on portfolio selection. Portfolio selection is now standard practice to submit all security lists for periodic inspection in order to see whether their quality can be improved. This, of course, is a major part of the service provided for clients by investment counselors. Nearly all brokerage houses are ready to make corresponding suggestions without special fee in return for the commission business involved. Some brokerage houses maintain investment services on a fee basis. Presumably, our defensive investor should obtain at least once a year the same kind of advice regarding changes in his portfolio as he sought when his funds were first committed. Since he will have little expertness of his own on which to rely, it is essential that he entrust himself only to firms of the highest reputation. Otherwise, he may easily fall into incompetent or unscrupulous hands. It is important, in any case, that at every such consultation he make clear to his advisor that he wishes to adhere closely to the 4 rules of common stock selection given earlier in this chapter. Incidentally, if his list has been competently selected in the first instance, there should be no need for frequent or numerous changes. T-earnings multiplier is a synonym for P or price or earnings ratios, which measure how much investors are willing to pay for a stock compared to the profitability of the underlying business. See footnote ton P70 in chapter 3. Plus, investors can now set up their own automated system to monitor the quality of their holdings by using interactive portfolio trackers at such websites as www.quicken.com, moneycentral.mizn.com, finance.yahoo.com, and www.morningstar.com. Graham would, however, warn against relying exclusively on such a system. You must use your own judgment to supplement the software. Dollar cost averaging. The New York Stock Exchange has put considerable effort into popularizing its monthly purchase plan, under which an investor devotes the same dollar amount each month to buying one or more common stocks. This is an application of a special type of formula investment known as dollar cost averaging. During the predominantly rising market experience since 1949, the results from such a procedure were certain to be highly satisfactory, especially since they prevented the practitioner from concentrating his buying at the wrong times. In Lucille Tomlinson's comprehensive study of formula investment plans, the author presented a calculation of the results of dollar cost averaging in the group of stocks making up the Dow Jones Industrial Index. Tests were made covering 23 10-year purchase periods, the first ending in 1929, the last in 1952. Every test showed a profit either at the close of the purchase period or within 5 years thereafter. The average indicated profit at the end of the 23 buying periods was 21.5%, exclusive of dividends received. Needless to say, in some instances, there was a substantial temporary depreciation at market value. Miss Tomlinson ends her discussion of this ultra-simple investment formula with a striking sentence: "No one has yet discovered any other formula for investing which can be used with so much confidence of ultimate success, regardless of what may happen to security prices, as dollar cost averaging." It may be objected that dollar cost averaging, while sound in principle, is rather unrealistic in practice, because few people are so situated that they can have available for common stock investment the same amount of money each year for, say, 20 years. It seems to me that this apparent objection has lost much of its force in recent years. Common stocks are becoming generally accepted as a necessary component of a sound savings investment program. Thus, systematic and uniform purchases of common stocks may present no more psychological and financial difficulties than similar continuous payments for United States savings bonds and for life insurance, to which they should be complementary. The monthly amount may be small, but the results after 20 or more years can be impressive and important to the saver. The investor's personal situation. At the beginning of this chapter, we referred briefly to the posy tie-in of the individual portfolio owner. Let us return to this matter in the light of our subsequent discussion of general policy. To what extent should the type of security selected by the investor vary with his circumstances? As concrete examples representing widely different conditions, we shall take: 1. A widow left $200,000 with which to support herself and her children. 2. A successful doctor in mid-career with savings of $100,000 and yearly accretions of $10,000. And 3. A young man earning $200 per week and saving $1,000 a year. For the widow, the problem of living on her income is a very difficult one. On the other hand, the need for conservatism in her investments is paramount. A division of her fund about equally between United States bonds and first-grade common stocks is a compromise between these objectives and corresponds to our general prescription for the defensive investor. The stock component may be placed as high as 75% if the investor is psychologically prepared for this decision, and if she can be almost certain she is not buying at a higher level. Assuredly, this is not the case in early 1972. We do not preclude the possibility that the widow may qualify as an enterprising investor, in which case her objectives and methods will be quite different. The one thing the widow must not do is to take speculative chances in order to make some extra income. By this, we mean trying for profits or high income without the necessary equipment to warrant full confidence in overall success. It would be far better for her to draw $2,000 per year out of her principal in order to make both ends meet than to risk half of it in poorly grounded and therefore speculative ventures. The prosperous doctor has none of the widow's pressures and compulsions, yet we believe that his choices are pretty much the same. Is he willing to take a serious interest in the business of investment? If he lacks the impulse or the flair, he will do best to update Graham's figures, take each dollar amount in this section and multiply it by 5. Accept the easy role of the defensive investor. The division of his portfolio should then be no different from that of the typical widow, and there would be the same area of personal choice in fixing the size of the stock component. The annual savings should be invested in about the same proportions as the total fund. The average doctor may be more likely than the average widow to elect to become an enterprising investor, and he is perhaps more likely to succeed in the undertaking. He has one important handicap, however, the fact that he has less time available to give to his investment education and to the administration of his funds. In fact, medical men have been notoriously unsuccessful in their security dealings. The reason for this is that they usually have an ample confidence in their own intelligence and a strong desire to make a good return on their money, without the realization that to do so successfully requires both considerable attention to the matter and something of a professional approach to security values. Finally, the young man who saves $1,000 a year and expects to do better gradually finds himself with the same choices, though for still different reasons. Some of his savings should go automatically into Series E bonds. The balance is so modest that it seems hardly worthwhile for him to undergo a tough educational and temperamental discipline in order to qualify as an aggressive investor. Thus, a simple resort to our standard program for the defensive investor would be at once the easiest and the most logical policy. Let us not ignore human nature at this point. Finance has a fascination for many bright young people with limited means. They would like to be both intelligent and enterprising in the placement of their savings, even though investment income is much less important to them than their salaries. This attitude is all to the good. There is a great advantage for the young capitalist to begin his financial education and experience early. If he is going to operate as an aggressive investor, he is certain to make some mistakes and to take some losses. Youth can stand these disappointments and profit by them. We urge the beginner in security buying not to waste his efforts and his money in trying to beat the market. Let him study security values and initially test out his judgment on price versus value with the smallest possible sums. Thus, we return to the statement made at the outset that the kind of securities to be purchased and the rate of return to be sought depend not on the investor's financial resources but on his financial equipment in terms of knowledge, experience, and temperament. Note on the concept of risk, it is conventional to speak of good bonds as less risky than good preferred stocks and of the latter as less risky than good common stocks. From this was derived the popular prejudice against common stocks because they are not safe, which was demonstrated in the Federal Reserve Board's survey of 1948. We should like to point out that the words risk and safety are applied to securities in two different senses, with a resultant confusion in thought. A bond is clearly proved unsafe when it defaults its interest or principal payments. Similarly, if a preferred stock or even a common stock is bought with the expectation that a given rate of dividend will be continued, then a reduction or passing of the dividend means that it has proved unsafe. It is also true that an investment contains a risk if there is a fair possibility that the holder may have to sell at a time when the price is well below cost. Nevertheless, the idea of risk is often extended to apply to a possible decline in the price of a security, even though the decline may be of a cyclical and temporary nature and even though the holder is unlikely to be forced to sell at such times. These chances are present in all securities other than United States savings bonds, and to a greater extent in the general run of common stocks than in senior issues as a class. But we believe that what is here involved is not a true risk in the useful sense of the term. The man who holds a mortgage on a building might have to take a substantial loss if he were forced to sell it at an unfavorable time. That element is not taken into account in judging the safety or risk of ordinary real estate mortgages, the only criterion being the certainty of punctual payments. In the same way, the risk attached to an ordinary commercial business is measured by the chance of its losing money, not by what would happen if the owner were forced to sell. In Chapter 8, we shall set forth our conviction that the bona fide investor does not lose money merely because the market price of his holdings declines. Hence, the fact that a decline may occur does not mean that he is running a true risk of loss. If a group of well-selected common stock investments shows a satisfactory overall return as measured through a fair number of years, then this group investment has proved to be safe. During that period, its market value is bound to fluctuate, and as likely as not it will sell for a while under the buyer's cost. If that fact makes the investment risky, it would then have to be called both risky and safe at the same time. This confusion may be avoided if we apply the concept of risk solely to a loss of value which either is realized through actual sale or is caused by a significant deterioration in the company's position or, more frequently perhaps, is the result of the payment of an excessive price in relation to the intrinsic worth of the security. Many common stocks do involve risks of such deterioration. But it is our thesis that a properly executed group investment in common stocks does not carry any substantial risk of this sort, and that therefore it should not be termed risky merely because of the element of price fluctuation. But such risk is present if there is danger that the price may prove to have been clearly too high by intrinsic value standards, even if any subsequent severe market decline may be recouped many years later. Note on the category of large, prominent, and conservatively financed corporations. The quoted phrase in our caption was used earlier in the chapter to describe the kind of common stocks to which defensive investors should limit their purchases, provided also that they had paid continuous dividends for a considerable number of years. A criterion based on adjectives is always ambiguous. Where is the dividing line for size, for prominence, and for conservatism of financial structure? On the last point, we can suggest a specific standard that, though arbitrary, is in line with accepted thinking. An industrial company's finances are not conservative unless the common stock at book value represents at least half of the total capitalization, including all bank debt. For a railroad or public utility, the figure should be at least 30%. The words large and prominent carry the notion of substantial size combined with a leading position in the industry. Such defensive investor and common stocks 1 to 3 companies are often referred to as primary. All other common stocks are then called secondary, except that growth stocks are ordinarily placed in a separate class by those who buy them as such. To supply an element of concreteness here, let us suggest that to be large in present-day terms, a company should have $50 million of assets or do $50 million of business. Again, to be prominent, a company should rank among the first quarter or first third in size within its industry group. It would be foolish, however, to insist upon such arbitrary criteria. They are offered merely as guides to those who may ask for guidance. But any rule which the investor may set for himself and which does no violence to the common sense meanings of large and prominent should be acceptable. By the very nature of the case, there must be a large group of companies that some will and others will not include among those suitable for defensive investment. There is no harm in such diversity of opinion and action. In fact, it has a salutary effect upon stock market conditions because it permits a gradual differentiation or transition between the categories of primary and secondary stock issues. In today's markets, to be considered large, a company should have a total stock value or market capitalization of at least $10 billion. According to the online stock screener at http://screen.yahoo.com/stocks.html that gave you roughly 300 stocks to choose from as of early 2003. Commentary on Chapter 5, Human Felicity, is product not so much by great pieces of good fortune that seldom happen, as by little advantages that occur every day. Benjamin Franklin's best defense is a good offense. After the stock market bloodbath of the past few years, why would any defensive investor put a dime into stocks? First, remember Graham's insistence that how defensive you should be depends less on your tolerance for risk than on your willingness to put time and energy into your portfolio. And if you go about it the right way, investing in stocks is just as easy as parking your money in bonds and cash. As we'll see in Chapter 9, you can buy a stock market index fund with no more effort than it takes to get dressed in the morning. Amidst the bear market that began in 2000, it's understandable if you feel burned and if, in turn, that feeling makes you determined never to buy another stock again. As an old Turkish proverb says, after you burn your mouth on hot milk, you blow on your yogurt. Because the crash of 2000 to 2002 was so terrible, many investors now view stocks as scaldingly risky, but paradoxically, the very act of crashing has taken much of the risk out of the stock market. It was hot milk before, but it is room temperature yogurt now. Viewed logically, the decision of whether to own stocks today has nothing to do with how much money you might have lost by owning them a few years ago. When stocks are priced reasonably enough to give you future growth, then you should own them regardless of the losses they may have cost you in the recent past. That's all the more true when bond yields are low, reducing the future returns on income-producing investments. As we have seen in Chapter 3, stocks are, as of early 2003, only mildly overpriced by historical standards. Meanwhile, at recent prices, bonds offer such low yields that an investor who buys them for their supposed safety is like a smoker who thinks he can protect himself against lung cancer by smoking low-tar cigarettes. No matter how defensive an investor you are in Graham's sense of low maintenance or in the contemporary sense of low risk, today's values mean that you must keep at least some of your money in stocks. Fortunately, it's never been easier for a defensive investor to buy stocks. And a permanent autopilot portfolio, which effortlessly puts a little bit of your money to work every month in predetermined investments, can defend you against the need to dedicate a large part of your life to stock picking. Should you buy what you know? But first, let's look at something the defensive investor must always defend against: the belief that you can pick stocks without doing any homework. In the 1980s and early 1990s, one of the most popular investing slogans was "Buy what you know." Peter Lynch, who from 1977 through 1990 piloted Fidelity Magellan to the best track record ever compiled by a mutual fund, was the most charismatic preacher of this gospel. Lynch argued that amateur investors have an advantage that professional investors have forgotten how to use: the power of common knowledge. If you discover a great new restaurant, car, toothpaste, or jeans, or if you notice that the parking lot at a nearby business is always full, or that people are still working at a company's headquarters long after Jay Leno goes off the air, then you have a personal insight into a stock that a professional analyst or portfolio manager might never pick up on. As Lynch put it, during a lifetime of buying cars or cameras, you develop a sense of what's good and what's bad, what sells and what doesn't, and the most important part is, you know it before Wall Street knows it. Lynch's rule: you can outperform the experts if you use your edge by investing in companies or industries you already understand, is Sneppeter Lynch with John Rothschild, one up on Wall Street Penguin 1989, totally implausible, and thousands of investors have profited from it over the years. But Lynch's rule can work only if you follow its corollary as well. Finding the promising company is only the first step. The next step is doing the research. To his credit, Lynch insists that no one should ever invest in a company, no matter how great its products or how crowded its parking lot, without studying its financial statements and estimating its business value. Unfortunately, most stock buyers have ignored that part. Barbara Streisand, the day trading diva, personified the way people abuse Lynch's teachings. In 1999, she burbled, "We go to Starbucks every day, so I buy Starbucks stock." But the funny girl forgot that no matter how much you love those tall, skinny lattes, you still have to analyze Starbucks' financial statements and make sure the stock isn't even more overpriced than the coffee. Countless stock buyers made the same mistake by loading up on shares of Amazon.com because they loved the website, or buying E-Trade stock because it was their own online broker. Experts gave the idea credence too. In an interview televised on CNN in late 1999, portfolio manager Kevin Landis of the First Hand Funds was asked plaintively, "How do you do it?" "Why can't I do it, Kevin?" From 1995 through the end of 1999, the First Hand Technol OGY Value Fund produced an astounding 58.2% average annualized gain. "Well, you can do it," Landis chirped. "All you really need to do is focus on the things that you know and stay close to an industry and talk to people who work in it every day." The most painful perversion of Lynch's rule occurred in corporate retirement plans. If you're supposed to buy what you know, then what could possibly be a better investment for your 401k than your own company's stock? After all, you work there. Don't you know more about the company than an outsider ever could? Sadly, the employee's Kevin Landis interview on CNN in the Money, November 5th, 1999, 11 Eastern Standard Time. If Landis's own record is any indication, focusing on the things that you know is not all you really need to do to pick stocks successfully. From the end of 1999 through the end of 2002, Landis's fund full of technology companies that he claimed to know firsthand from his base in Silicon Valley lost 73.2% of its value, and even worse pounding than the average technology fund suffered over that period. Of Enron, Global Crossing, and WorldCom, many of whom put nearly all their retirement assets in their own company stock, only to be wiped out, learned that insiders often possess only the illusion of knowledge, not the real thing. Psychologists led by Baruch Fishoff of Carnegie Mellon University have documented a disturbing fact. Becoming more familiar with a subject does not significantly reduce people's tendency to exaggerate how much they actually know about it. That's why investing in what you know can be so dangerous. The more you know going in, the less likely you are to probe a stock for weaknesses. This pernicious form of overconfidence is called home bias, or the habit of sticking to what is already familiar. Individual investors own 3 times more shares in their local phone company than in all other phone companies combined. The typical mutual fund owns stocks whose headquarters are 115 miles closer to the fund's main office, and the average U.S. company is 401k investors keep between 25% and 30% of their retirement assets in the stock of their own company. In short, familiarity breeds complacency. On the TV news, isn't it always the neighbor or the best friend or the parent of the criminal who says in a shocked voice, "He was such a nice guy"? That's because whenever we are too close to someone or something, we take our beliefs for granted instead of questioning them as we do when we confront something more remote. The more familiar a stock is, the more likely it is to turn a defensive investor into a lazy one who thinks there's no need to do any homework. Don't let that happen to you. Sarah Lichtenstein and Baruch Fischhoff. Do those who know more also know more about how much they know? Organizational Behavior and Human Performance. Vol. 20, Number 2, December 1977, pp. 159183. C. Ger Huberman. Familiarity Breeds Investment, Joshua D. Koval and Tobias J. Moskowitz, The Geography of Investment, and Ger Huberman and Paul Singmuller, Company Stock and 401k Plans, all available at http://papers.sseniorin.com. Can you roll your own? Fortunately, for a defensive investor who is willing to do the required homework for assembling a stock portfolio, this is the golden age. Never before in financial history has owning stocks been so cheap and convenient. Do it yourself through specialized online brokerages like www.shawrebuilder.com, www.foliofn.com, and www.buyandhold.com. You can buy stocks automatically even if you have very little cash to spare. These websites charge as little as $4 for each periodic purchase of any of the thousands of U.S. stocks they make available. You can invest every week or every month, reinvest the dividends, and even trickle your money into stocks through electronic withdrawals from your bank account or direct deposit from your paycheck. ShareBuilder charges more to sell than to buy, reminding you, like a little whack across the nose with a rolled up newspaper, that rapid selling is an investing no-no, while Folio often offers an excellent tax tracking tool. Unlike traditional brokers or mutual funds that won't let you in the door for less than $2,000 or $3,000, these online firms have no minimum account balances and are tailor-made for beginning investors who want to put fledgling portfolios on autopilot. To be sure, a transaction fee of $4 takes a monstrous 8% bite out of a $50 monthly investment, but if that's all the money you can spare, then these micro-investing sites are the only game in town for building a diversified portfolio. You can also buy individual stocks straight from the issuing company. In 1994, the U.S. Securities and Exchange Commission loosed in the handcuffs it had long ago clamped onto the direct sale of stocks to the public. Hundreds of companies responded by creating internet-based programs allowing investors to buy shares without going through a broker. Some helpful online sources of information on buying stocks directly include www.dripcentral.com, OneItStockDirect.com, an affiliate of ShareBuilder, and www.stockpower.com. According to finance professor Charles Jones of Columbia Business School, the cost of a small one-way trade, either a buy or a sell in a New York Stock Exchange listed stock, dropped from about 1.25% in Graham's day to about 0.25% in 2000. For institutions like mutual funds, those costs are actually higher. See Charles M. Jones, A Century of Stock Market Liquidity and Trading Costs, at http://papers.sseniorin.com. You may often incur a variety of nuisance fees that can exceed $25 per year. Even so, direct stock purchase programs are usually cheaper than stockbrokers. Be warned, however, that buying stocks in tiny increments for years on end can set off big tax headaches. If you are not prepared to keep a permanent and exhaustively detailed record of your purchases, do not buy in the first place. Finally, don't invest in only one stock or even just a handful of different stocks. Unless you are not willing to spread your bets, you shouldn't bet at all. Graham's guideline of owning between 10 and 30 stocks remains a good starting point for investors who want to pick their own stocks. But you must make sure that you are not overexposed to one industry. For more on how to pick the individual stocks that will make up your portfolio, see pp. 114115 and chapters 11, 14, and 15. If after you set up such an online autopilot portfolio, you find yourself trading more than twice a year or spending more than an hour or two per month total on your investments, then something has gone badly wrong. Do not let the ease and up-to-the-minute feel of the internet seduce you into becoming a speculator. A defensive investor runs and wins the race by sitting still. Get some help. A defensive investor can also own stocks through a discount broker, a financial planner, or a full-service stockbroker. At a discount brokerage, you'll need to do most of the stock-picking work yourself. Graham's guidelines will help you create a core portfolio requiring minimal maintenance and offering maximal odds of a steady return. On the other hand, if you cannot spare the time or summon the interest to do it yourself, there's no reason to feel any shame in hiring someone to pick stocks or mutual funds for you. But there's one responsibility that you must never delegate. You, and no one but you, must investigate before you hand over your money whether an advisor is trustworthy and charges reasonable fees. For more pointers, see Chapter 10. Farm it out. Mutual funds are the ultimate way for a defensive investor to capture the upside of stock ownership without the down to help determine whether the stocks you own are sufficiently diversified across different industrial sectors. You can use the free instant X-ray fungicide of having to police your own portfolio. At relatively low cost, you can buy a high degree of diversification and convenience, letting a professional pick and watch the stocks for you. In their finest form, index portfolios, mutual funds can require virtually no monitoring or maintenance whatsoever. Index funds are a kind of Rip Van Winkle investment that is highly unlikely to cause any suffering or surprises, even if, like Washington Irving's lazy farmer, you fall asleep for 20 years. They are a defensive investor's dream come true. For more detail, see Chapter 9, filling in the patholosis. The financial markets heave and crash their way up and down day after day. The defensive investor can take control of the chaos. Your very refusal to be active, your renunciation of any pretended ability to predict the future, can become your most powerful weapons. By putting every investment decision on autopilot, you drop any self-delusion that you know where stocks are headed, and you take away the market's power to upset you no matter how bizarrely it bounces. As Graham notes, dollar cost averaging enables you to put a fixed amount of money into an investment at regular intervals. Every week, month, or calendar quarter, you buy more whether the markets have gone or are about to go up, down, or sideways. Any major mutual fund company or brokerage firm can automatically and safely transfer the money electronically for you, so you never have to write a check or feel the conscious pang of payment. It's all out of sight, out of mind. The ideal way to dollar cost average is into a portfolio of index funds which own every stock or bond worth having. That way, you renounce not only the guessing game of where the market is going, but which sectors of the market and which particular stocks or bonds within them will do the best. Let's say you can spare $500 a month. By owning and dollar cost averaging into just 3 index funds, 300 into one that holds the total U.S. stock market, $100 into one that holds foreign stocks, and $100 into one that holds U.S. bonds, you can ensure that you own almost every investment on the planet that's worth owning. Every month, like clockwork, you buy more. If the market has dropped, your preset amount goes further, buying you more shares than the month before. If the market has gone up, then your money buys you fewer shares. By putting your portfolio on permanent autopilot this way, you prevent yourself from either flinging money at the market just when it seems most alluring and is actually most dangerous, or refusing to buy more after a market crash has made investments truly cheaper but seemingly more risky. According to Ibbotson Associates, the leading financial research firm, if you had invested $12,000 in the Standard & Poor's 500 stock index at the beginning of September 1929, 10 years later you would have had only $7,223 left. But if you had started with a paltry $100 and simply invested another $100 every single month, then by August 1939, your money would have grown to $15,571. That's the power of disciplined buying, even in the face of the Great Depression and the worst bear market of all time. Best of all, once you build a permanent autopilot portfolio with index funds as its heart and core, you'll be able to answer every market question with the most powerful response a defensive investor could ever have. I don't know and I don't care. If someone asks whether bonds will outperform stocks, just answer, I don't know and I don't care. After all, you're automatically buying both. Will healthcare stocks make high-tech stocks look sick? I don't know and I don't care. You're a permanent owner of both. What's the next Microsoft? I don't know and I don't care. As soon as it's big enough to own, your index fund will have it and you'll go along for the ride. Will foreign stocks be U.S. stocks next year? I don't know and I don't care. If they do, you'll capture that gain. If they don't, you'll get to buy more at lower prices. By enabling you to say, I don't know and I don't care, a permanent autopilot portfolio liberates you from the feeling that you need to forecast what the financial markets are about to do and the illusion that source spreadsheet data provided courtesy of Ibbotson Associates. Although it was not possible for retail investors to buy the entire S&P 500 index until 1976, the example nevertheless proves the power of buying more when stock prices go down. From the end of 1999 through the end of 2002, the S&P 500 stock average fell relentlessly. But if you had opened an index fund account with a $3,000 minimum investment and added $100 every month, your total outlay of $6,600 would have lost 32, considerably less than the 41.3% plunge in the market. Better yet, your steady buying at lower prices would build the base for an explosive recovery when the market rebounds. Source: The Vanguard Groupanion else can. The knowledge of how little you can know about the future, coupled with the acceptance of your ignorance, is a defensive investor's most powerful weapon. From the end of 1999 through the end of 2002, the S&P 500 stock average fell relentlessly. But if you had opened an index fund account with a $3,000 minimum investment and added $100 every month, your total outlay of $6,600 would have lost 32, considerably less than the 41.3% plunge in the market. Better yet, your steady buying at lower prices would build the base for an explosive recovery when the market rebounds. Source: The Vanguard Groupanion else can. The knowledge of how little you can know about the future, coupled with the acceptance of your ignorance, is a defensive investor's most powerful weapon. Chapter 6: Portfolio Policy for the Interpresent Torvstave. Negative approach. Aggressive investors should start from the same base as the defensive investor, namely, a division of his funds between high-grade bonds and high-grade common stocks bought at reasonable prices. He will be prepared to branch out into other kinds of security commitments, but in each case, he will want a well-reasoned justification for the departure. There is a difficulty in discussing this topic in orderly fashion because there is no single or ideal pattern for aggressive operations. The field of choice is wide. The selection should depend not only on the individual's competence and equipment, but perhaps equally well upon his interests and preferences. The most useful generalizations for the enterprising investor are of a negative sort. Let him leave high-grade preferred stocks to corporate buyers. Let him also avoid inferior types of bonds and preferred stocks unless they can be bought at bargain levels, which means ordinarily at prices at least 30% under par for high coupon. Here Graham has made a slip of the tongue. After insisting in Chapter 1 that the definition of an enterprising investor depends not on the amount of risk you seek, but the amount of work you are willing to put in, Graham falls back on the conventional notion that enterprising investors are more aggressive. The rest of the chapter, however, makes clear that Graham stands by his original definition. The great British economist John Maynard Keynes appears to have been the first to use the term enterprise as a synonym for analytical investment issues, and much less for the lower coupons. He will let someone else buy foreign government bond issues, even though the yield may be attractive. He will also be wary of all kinds of new issues, including convertible bonds and preferreds that seem quite tempting, and common stocks with excellent earnings confined to the recent past. For standard bond investments, the aggressive investor would do well to follow the pattern suggested to his defensive confrere and make his choice between high-grade taxable issues, which can now be selected to yield about 7%, and good quality tax-free bonds, which yield up to 5.3% on longer maturities, seeking grade bonds and preferred stocks. Since in late 1971 it is possible to find first-rate corporate bonds to yield 7%, and even more, it would not make much sense to buy second-grade issues merely for the higher return they offer. In fact, corporations with relatively poor credit standing have found it virtually impossible to sell straight bonds at non-convertibles to the public in the past 2 years. Hence, their debt financing has been done by the sale of convertible bonds or bonds with warrants attached, which place them in a separate category. It follows that virtually all the non-convertible bonds of inferior rating represent older issues which are selling at a large discount. Thus, they offer the possibility of a substantial gain in principal value under favorable future conditions, which would mean here a combination of an improved credit rating for the company and lower general interest rates. High coupon issues are corporate bonds paying above average interest rates in today's markets, at least 8%, or preferred stocks paying large dividend yields 10 or more. If a company must pay high rates of interest in order to borrow money, that is a fundamental signal that it is risky. For more on high yield or junk bonds, see pp. 1 for 5, 1 for 7. Plus, as of early 2003, the equivalent yields are roughly 5.1% on high-grade corporate bonds and 4.7% on 20-year tax-free municipal bonds. To update these yields, see www.bondsonline.com/ask/news/composite/html or www.bloomberg.com/market/rates.html and www.bloomberg.com/. But even in the matter of price discounts and resultant chance of principal gain, the second-grade bonds are in competition with better issues. Some of the well-entrenched obligations with old-style coupon rates 24 to 4% sold at about 50 cents on the dollar in 1970. Examples: American Telephone and Telegraph 2S, due 1986, sold at 51, Atchison, Topeka, and Santa Fe RR for seconds, due 1995, sold at 51, McGraw-Hill 3S, due 1992, sold at 50%. Hence, under conditions of late 1971, the enterprising investors can probably get from good-grade bonds selling at a large discount all that he should reasonably desire in the form of both income and chance of appreciation. Throughout this book, we refer to the possibility that any well-defined and protracted market situation of the past may return in the future. Hence, we should consider what policy the aggressive investor might have to choose in the bond field if prices and yields of high-grade issues should return to former normals. For this reason, we shall reprint here our observations on that point made in the 1965 edition when high-grade bonds yielded only 4%. Something should be said now about investing in second-grade issues, which can readily be found to yield any specified return up to 8% or more. The main difference between first and second-grade bonds is usually found in the number of times the interest charges have been covered by earnings. Example: in early 1960 for Chicago, Milwaukee, Steady Paul, and Pacific 5% income debenture bonds at 68 yielded 7.35%. But the total interest charges of the road before income taxes were earned only 1.5 times in 1963, against our requirement of 5 times for a well-protected railroad issue. Many investors buy securities of this kind because they need income and cannot get along with the meager return offered by top-grade issues. Experience clearly shows that it is unwise to buy a bond or a preferred which lacks adequate safety merely because the yield is attractive. Here the word merely implies that the issue is not selling at a large discount and thus does not offer an opportunity for a substantial gain in principal value. Where such securities are bought at full prices, that is, not many points under 100, the chances are very great that at some future time the holder will see much lower quotations. For when bad business comes, or just a bad market, issues of this kind prove highly susceptible to severe sinking spells. Often interest or dividends are suspended or at least endangered, and frequently there is a pronounced price weakness even though the operating results are not at all bad. As a specific illustration of this characteristic of second-quality senior issues, let us summarize the price behavior of a group of 10 railroad income bonds in 1946-47. These comprise all of those which sold at 96 or more in 1946, their high prices averaging 100%. By the following year, the group had registered low prices averaging only 68, a loss of 1/3 of the market value in a very short time. Peculiarly enough, the railroads of the country were showing much better earnings in 1947 than in 1946. Hence, the drastic price decline ran counter to the business picture and was a reflection of the sell-off in the general market. But it should be pointed out that the shrinkage in these income bonds was proportionately larger than that in the common stocks in the Dow Jones Industrial List, about 23%. Obviously, the purchaser of these bonds at a cost above 100 could not have expected to participate to any extent in a further rise in the securities market. The only attractive feature was the income yield, averaging about 4.25% against 2.5% for first-grade bonds, an advantage of 1.75% in annual income. Yet the sequel showed all too soon and too plainly that for the minor advantage in annual income, the buyer of these second-grade bonds was risking the loss of a substantial part of his principal. The above example permits us to pay our respects to the popular fallacy that goes under the sobriquet of a businessman's investment. That involves the purchase of a security showing a larger yield than is obtainable on a high-grade issue and carrying a correspondingly greater risk. It is bad business to accept in bond prices are quoted in percentages of par value or 100. A bond priced at 85 is selling at 85% of its principal value. A bond originally offered for $10,000, but now selling at 85 will cost $8,500. When bonds sell below 100, they are called discount bonds. Above 100, they become premium bonds. Acknowledge possibility of a loss of principal in exchange for a mere 1 or 2% of additional yearly income. If you are willing to assume some risk, you should be certain that you can realize a really substantial gain in principal value if things go well. Hence, a second-grade 5.5 or 6% bond selling at par is almost always a bad purchase. The same issue at 70 might make more sense, and if you are patient, you will probably be able to buy it at that level. Second-grade bonds and preferred stocks possess two contradictory attributes which the intelligent investor must bear clearly in mind. Nearly all suffer severe sinking spells in bad markets. On the other hand, a large proportion recover their position when favorable conditions return, and these ultimately work out all right. This is true even of cumulative preferred stocks that fail to pay dividends for many years. There were a number of such issues in the early 1940s as a consequence of the long depression of the 1930s. During the post-war boom period of 1945 to 1947, many of these large accumulations were paid off either in cash or in new securities, and the principal was often discharged as well. As a result, large profits were made by people who, a few years previously, had bought these issues when they were friendless and sold at low prices. It may well be true that, in an overall accounting, the higher yields obtainable on second-grade senior issues will prove to have offset those principal losses that were irrecoverable. In other words, an investor who bought all such issues at their offering prices might conceivably fare as well in the long run as one who limited himself to first-quality securities, or even somewhat better. But for practical purposes, the question is largely irrelevant. Regardless of the outcome, the buyer of second-grade issues at full prices will be worried and discommoded when their price declines precipitately. Furthermore, he cannot buy enough issues to assure an average result. Nor is he in a position to set aside a portion of his larger income to offset or amortize those principal losses which prove to be permanent. Finally, it is mere common sense to abstain from buying securities at around 100 if long experience indicates that they can probably be bought at 70 or less in the next weak market. Foreign government bonds or investors with even small experience know that foreign bonds, as a whole, have had a bad investment history since 1914. This was inevitable in the light of 2 world wars and an intervening world depression of unexampled depth. Yet every few years, market conditions are sufficiently favorable to permit the sale of some new foreign issues at a price of about par. This phenomenon tells us a good deal about the working of the average investor's mind, and not only in the field of bonds. We have no concrete reason to be concerned about the future history of well-regarded foreign bonds such as those of Australia or Norway. But we do know that, if and when trouble should come, the owner of foreign obligations has no legal or other means of enforcing his claim. Those who bought Republic of Cuba for as high as 117 in 1953 saw them default their interest and then sell as low as 20 cents on the dollar in 1963. The New York Stock Exchange bond list in that year also included Belgian Congo 5s at 36, Greek 7 seconds at 30, and various issues of Poland as low as 7. How many readers have any idea of the repeated vicissitudes of the 8% bonds of Czechoslovakia since they were first offered in this country in 1922 at 96%? They advanced to 112 in 1928, declined to 67% in 1932, recovered to 106 in 1936, collapsed to 6 in 1939, recovered unbelievably to 117 in 1946, fell promptly to 35 in 1948, and sold as low as 8 in 1970. Years ago, an argument of sorts was made for the purchase of foreign bonds here on the grounds that a rich creditor nation such as ours was under moral obligation to lend abroad. Time, which brings so many revenges, now finds us dealing with an intractable balance of payments problem of our own, part of which is ascribable to the large-scale purchase of foreign bonds by American investors seeking a small advantage in yield. For many years past, we have questioned the inherent attractiveness of such investments from the standpoint of the buyer. Perhaps we should add now that the latter would benefit both his country and himself if he declined these opportunities. New issues generally, it might seem ill-advised to attempt any broad statements about new issues as a class, since they cover the widest possible range of quality and attractiveness. Certainly, there will be exceptions to any suggested rule. Our one recommendation is that all investors should be wary of new issues, which means simply that these should be subjected to careful examination and unusually severe tests before they are purchased. There are two reasons for this double caveat. The first is that new issues have special salesmanship behind them, which calls therefore for a special degree of sales resistance. The second is that most new issues are sold under favorable market conditions, which means favorable for the seller and consequently less favorable for the buyer. The effect of these considerations becomes steadily more important as we go down the scale from the highest quality bonds through second-grade senior issues to common stock flotations at the bottom. A tremendous amount of financing consisting of the repayment of existing bonds at call price and their replacement by new issues with lower coupons was done in the past. Most of this was in the category of high-grade bonds and preferred stocks. The buyers were largely financial institutions amply qualified to protect their interests. Hence, these offerings were carefully priced too. New issues of common stock initial public offerings, or IPOs, normally are sold with an underwriting discount, a built-in commission of 7%. By contrast, the buyer's commission on older shares of common stock typically ranges below 4%. Whenever Wall Street makes roughly twice as much for selling something new as it does for selling something old, the new will get the harder sell. Plus, recently, finance professors Owen Lamont of the University of Chicago and Paul Schultz of the University of Notre Dame have shown that corporate tie-ins choose to offer new shares to the public when the stock market is near a peak. For technical discussion of these issues, see Lamont's Evaluating Value Weighting, Corporate Events and Market Timing, and Schultz's Pseudo-Market Timing and the Long-Run Performance of IPOs at http://papers.seniorn.com. Meet the going rate for comparable issues, and high-powered salesmanship had little effect on the outcome. As interest rates fell lower and lower, the buyers finally came to pay too high a price for these issues, and many of them later declined appreciably in the market. This is one aspect of the general tendency to sell new securities of all types when conditions are most favorable to the issuer, but in the case of first-quality issues, the ill effects to the purchaser are likely to be unpleasant rather than serious. The situation proves somewhat different when we study the lower-grade bonds and preferred stocks sold during the 1945-46 and 1960-61 periods. Here, the effect of the selling effort is more apparent because most of these issues were probably placed with individual and inexpert investors. It was characteristic of these offerings that they did not make an adequate showing when judged by the performance of the companies over a sufficient number of years. They did look safe enough, for the most part, if it could be assumed that the recent earnings would continue without a serious setback. The investment bankers who brought out these issues presumably accepted this assumption, and their salesmen had little difficulty in persuading themselves and their customers to a like effect. Nevertheless, it was an unsound approach to investment and one likely to prove costly. Bull market periods are usually characterized by the transformation of a large number of privately owned businesses into companies with quoted shares. This was the case in 1945-46 and again beginning in 1960. The process then reached extraordinary proportions until brought to a catastrophic close in May 1962. After the usual swearing off period of several years, the whole tragicomedy was repeated step by step in 1967 to 1969. In the 2 years from June 1960 through May 1962, more than 850 companies sold their stock to the public for the first time, an average of more than one per day. In late 1967, the IPO market heated up again. In 1969, an Aston issuing 781 new stocks were born. That oversupply helped create the bear markets of 1969 and 1973 to 1974. In 1974, the IPO market was so dead that only 9 new stocks were created all year. 1975 saw only 14 stocks born. That undersupply, in turn, helped feed the bull market of the 1980s, when roughly 4,000 new stocks flooded the market, helping to trigger the over new common stock offerings. Following paragraphs are reproduced unchanged from the 1959 edition, with comment added. Common stock financing takes 2 different forms. In the case of companies already listed, additional shares are offered pro rata to the existing stockholders. The subscription price is set below the current market, and the rights to subscribe have an initial money value. The sale of the new shares is almost always underwritten by one or more investment banking houses, but it is the general hope and expectation that all the new shares will be taken by the exercise of the subscription rights. Thus, the sale of volatile common stock of listed companies does not ordinarily call for active selling effort on the part of distributing firms. The second type is the placement with the public of common stock of what were formerly privately owned enterprises. Most of this stock is sold for the account of the controlling interest to enable them to cash in on a favorable market and to diversify their enthusiasm that led to the 1987 crash. Then the cycle swung the other way again as IPOs dried up in 1988 to 1990. That shortage contributed to the bull market of the 1990s, and right on cue, Wall Street got back into the boostiness of creating new stocks, cranking out nearly 5,000 IPOs. Then, after the bubble burst in 2000, only 88 IPOs were issued in 2001, the lowest annual total since 1979. In every case, the public has gotten burned on IPOs, has stayed away for at least 2 years, but has always returned for another scalding. For as long as stock markets have existed, investors have gone through this manic depressive cycle. In America's first great IPO boom, back in 1825, a man was said to have been squeezed to death in the stampede of speculators trying to buy shares in the new Bank of Southwark. The wealthiest buyers hired thugs to punch their way to the front of the line. Sure enough, by 1829, stocks had lost roughly 25% of their value. Here Graham is describing rights offerings in which investors who already own a stock are asked to pony up even more money to maintain the same proportional interest in the company. This form of financing, still widespread in Europe, has become rare in the United States, except among closed-end funds. The heedlessness of the public and the willingness of selling organizations to sell whatever may be profitably sold and have only one result: price collapse. In many cases, the new issues lose 75% and more of their offering price. The situation is worsened by the aforementioned fact that, at bottom, the public has a real aversion to the very kind of small issue that it bought so readily in its careless moments. Many of these issues fall proportionately as much below their true value as they formerly sold above it. An elementary requirement for the intelligent investor is an ability to resist the blandishments of salesmen offering new common stock issues during bull markets. Even if one or two can be found that can pass severe tests of quality and value, it is probably bad policy to get mixed up in this sort of business. Of course, the salesman will point to many such issues which have had good-sized market advances, including some that go up spectacularly the very day they are sold. But all this is part of the speculative atmosphere. It is easy money. For every dollar you make in this way, you will be lucky if you end up by losing only 2. Some of these issues may prove excellent buys a few years later when nobody wants them and they can be had at a small fraction of their true worth. In the 1965 edition, we continued our discussion of this subject as follows. While the broader aspects of the stock market's behavior since 1949 have not lent themselves well to analysis based on long experience, the development of new common stock flotations proceeded exactly in accordance with ancient prescription. It is doubtful whether we ever before had so many new issues offered of such low quality and with such extreme price collapses as we should of knave investors. By the peak of the IPO boom in late 1999 and early 2000, however, Wall Street's biggest investment banks had jumped in with both feet. Venerable firms cast off their traditional prudence and behaved like drunken mud wrestlers, scrambling to foist ludicrously overvalued stocks on a desperately eager public. Graham's description of how the IPO process works is a classic that should be required reading in investment banking ethics classes if there are any. Experienced in 1960 to 1962, the ability of the stock market as a whole to disengage itself rapidly from that disaster is indeed an extraordinary phenomenon, bringing back long-buried memories of the similar invulnerability it showed to the great Florida real estate collapse in 1925. Must there be a return of the new stock offering madness before the present bull market can come to its definitive close? Who knows? But we do know that an intelligent investor will not forget what happened in 1962 and will let others make the next batch of quick profits in this area and experience the consequent harrowing losses. We followed these paragraphs in the 1965 edition by citing a horrible example, namely the sale of stock of Aetna Maintenance Co. at $9 in November 1961. In typical fashion, the shares promptly advanced to $15. The next year, they fell to 2%, and in 1964 too. The later history of this company was on the extraordinary side and illustrates some of the strange metamorphoses that have taken place in American business, great and small, in recent years. The curious reader will find the older and newer history of this enterprise in Appendix 5. It is by no means difficult to provide even more harrowing examples taken from the more recent version of the same old story, which covered the years 1967 to 1970. Nothing could be more pat to our purpose than the case of AAA Enterprises, which happens to be the first company then listed in Standard & Poor's stock guide. The shares were sold to the public at $14 in 1968, promptly advanced to $28, but in early 1971 were quoted at a dismal $25. Even this price represented a gross overvaluation of the enterprise, since it had just entered the bankruptcy court in a hopeless condition. There is so much to be learned and such important warnings to be gleaned from the story of this flotation that we have reserved it for detailed treatment below in Chapter 17. Commentary on Chapter 6. The punches you miss are the ones that wear you out. Boxing trainer Angelo Dendifer, or the aggressive as well as the defensive investor. What you don't do is as important to your success as what you do. In this chapter, Graham lists his don'ts for aggressive investors. Here is a list for today. Junkyard dogs, high-yield bonds, which Graham calls second grade or lower grade and today are called junk bonds, get a brisk thumbs down from Graham. In his day, it was too costly and cumbersome for an individual investor to diversify away the risks of default. To learn how bad a default can be and how carelessly even sophisticated pro-cyno bond investors can buy into one, see the sidebar on page 146. Today, however, more than 130 mutual funds specialize in junk bonds. These funds buy junk by the cartload. They hold dozens of different bonds. That mitigates Graham's complaints about the difficulty of diversifying. However, his bias against high-yield preferred stock remains valid, since there remains no cheap and widely available way to spread their risks. Since 1978, an annual average of 4.4% of the junk bond market has gone into default, but even after those defaults, junk bonds heavy in the early 1970s, when Graham wrote, there were fewer than a dozen junk bond funds, nearly all of which charged sales commissions of up to 8.5%. Some even made investors pay a fee for the privilege of reinvesting their monthly dividends back into the fund. A world of hurt for WorldCom bonds. Buying a bond only for its yield is like getting married only for the sex. If the thing that attracted you in the first place dries up, you'll find yourself asking, what else is there? When the answer is nothing, spouses and bondholders alike end up with broken hearts. On May 9, 2001, WorldCom Inc. sold the biggest offering of bonds in U.S. corporate history, $11.9 billion worth. Among the eager beavers attracted by the yields of up to 8.3% were the California Public Employees Retirement System, one of the world's largest pension funds, Retirement Systems of Alabama, whose managers later explained that the higher yields were very attractive to us at the time they were purchased, and the strong corporate bond fund, whose co-manager was so fond of WorldCom's fat yield that he boasted, we're getting paid more than enough extra income for the risk. But even a 30-second glance at WorldCom's bond prospectus would have shown that these bonds had nothing to offer but their yield and everything to lose. In 2 of the previous 5 years, WorldCom's pre-tax income, the company's profits before it paid its dues to the IRS, fell short of covering its fixed charges, the costs of paying interest to its bondholders by a stupendous $4.1 billion. WorldCom could cover those bond payments only by borrowing more money from banks. And now, with this mountainous new helping of bonds, WorldCom was fattening its interest costs by another $900 million per year. Like Mr. Creosote in Monty Python's The Meaning of Life, WorldCom was gorging itself to the bursting point. No yield could ever be high enough to compensate an investor for risking that kind of explosion. The WorldCom bonds did produce fat yields of up to 8% for a few months. Then, as Graham would have predicted, the yield suddenly offered no shelter. WorldCom filed bankruptcy in July 2002. WorldCom admitted in August 2002 that it had overstated its earnings by more than $7 billion. WorldCom's bonds defaulted when the company could no longer cover their interest charges. The bonds lost more than 80% of their original value. See www.calpers.ca/whatshap/hot topic/WorldCom_FAQs.htm and wcalpers.ca/what's new/press/2002/0716.htm. Retirement Systems of Alabama Quarterly Investment Report for May 31st, 2001 at www.arsa.state.al. Us Investments Quarterly Report, HM, and John Bender, Strong Corporate Bond Fund Manager, quoted in www.businessweek.com/magazine/content/01. These numbers are all drawn from WorldCom's prospectus or sales document for the bond offering. Filed May 11, 2001, it can be viewed at www.sec.gov/edgar/search/company-search.html in company name window, enter WorldCom. Even without today's 2020's hindsight knowledge that WorldCom's earnings were fraudulently overstated, WorldCom's bond offering would have appalled Graham. For documentation on the collapse of WorldCom, see www.worldcom.com/infodesk. Still produced an annualized return of 10.5% versus 8.6% for 10-year U.S. Treasury bonds. Unfortunately, most junk bond funds charge high fees and do a poor job of preserving the original principal amount of your investment. A junk fund could be appropriate if you are retired, are looking for extra monthly income to supplement your pension, and can tolerate temporary tumbles in value. If you work at a bank or other financial company, a sharp rise in interest rates could limit your raise or even threaten your job security, so a junk fund, which tends to outperform most other bond funds when interest rates rise, might make sense as a counterweight in your 401k. A junk bond fund, though, is only a minor option, not an obligation for the intelligent investor. Edward I. Altman and Gaurav Bana, Defaults and Returns on High-Yield Bonds, Research Paper, Stern School of Business, New York University, 2002. The vodka and burrito portfoliogram considered foreign bonds no better a bet than junk bonds. Today, however, one variety of foreign bond may have some appeal for investors who can withstand plenty of risk. Roughly a dozen mutual funds specialize in bonds issued in emerging market nations, or what used to be called third world countries, like Brazil, Mexico, Nigeria, Russia, and Venezuela. No sane investor would put more than 10% of a total bond portfolio in spicy holdings like these. But emerging markets bond funds seldom move in sync with the U.S. stock market, so they are one of the rare investments that are unlikely to drop merely because the Dow is down. That can give you a small corner of comfort in your portfolio just when you may need it most. Dying a trader's death, as we've already seen in Chapter 1. Day trading, holding stocks for a few hours at a time, is one of the best weapons ever invented for committing financial suicide. Some of your trades might make money, most of your trades will lose money, but your broker will always make money. And your own eagerness to buy or sell a stock can lower your return. Someone who is desperate to buy a stock can easily end up having to bid 10 cents higher than the most recent share price before any sellers will be willing to part with it. That extra cost, called market impact, never shows up on your brokerage statement, but it's real. If you're overeager to buy 1,000 shares of a stock and you drive its price, Graham did not criticize foreign bonds lightly, since he spent several years early in his career acting as a New York-based bond agent for borrowers in Japan. Two low-cost, well-run emerging markets bond funds are Fidelity New Markets Income Fund and T. Rowe Price Emerging Markets Bond Fund. For more information, see www.fidelity.com, www.toroweprice.com, and wmorningstar.com. Do not buy any emerging markets bond fund with annual operating expenses higher than 1% to 5%, and be forewarned that some of these funds charge short-term redemption fees to discourage investors from holding them for less than 3 months. Up by just 5 cents, you've just cost yourself an invisible but very real $50. On the flip side, when panicky investors are frantic to sell a stock and they dump it for less than the most recent price, market impact hits home again. The costs of trading wear away your returns like so many swipes of sandpaper. Buying or selling a hot little stock can cost 2% to 4% or 4% to 8% for a round-trip buy and sell transaction. If you put $1,000 into a stock, your trading costs could eat up roughly $40 before you even get started. Sell the stock, and you could fork over another 4% in trading expenses. Oh, yes, there's one other thing. When you trade instead of invest, you turn long-term gains taxed at a maximum capital gains rate of 20% into ordinary income taxed at a maximum rate of 38.6%. Add it all up, and a stock trader needs to gain at least 10% just to break even on buying and selling a stock. Anyone can do that once, by luck alone. To do it often enough to justify the obsessive attention it requires, plus the nightmarish stress it generates, is impossible. Thousands of people have tried, and the evidence is clear. The more you trade, the less you keep. Finance professors Brad Barber and Terrence Odion of the University of California examined the trading records of more than 66,000 customers of a major discount brokerage firm. From 1991 through 1996, these clients made more than 1.9 million trades. Before the costs of trading sandpapered away at their returns, the people in the study actually outperformed the market by an average of at least half a percentage point per year. But after trading costs, the most active of these traders who shifted more than 20% of their stock holdings per. The definitive source on brokerage costs is the Plexus Group of Santa Monica, California, and its website, www.plexusgroup.com. Plexus argues persuasively that just as most of the mass of an iceberg lies below the ocean surface, the bulk of brokerage costs are invisible, misleading investors into believing that their trading costs are insignificant if commission costs are low. The costs of trading NASDAQ stocks are considerably higher for individuals than the costs of trading NYSE-listed stocks. CP 128, footnote 5. Real-world conditions are still more harsh, since we are ignoring state income taxes in this example. Month went from beating the market to underperforming it by an abysmal 6.4 percentage points per year. The most patient investors, however, who traded a minuscule 0.2% of their total holdings in an average month, managed to outperform the market by a whisker, even after their trading costs. Instead of giving a huge hunk of their gains away to their brokers and the IRS, they got to keep almost everything. For a look at these results, see Figure 6-1. The lesson is clear. Don't just do something, stand there. It's time for everyone to acknowledge that the term long-term investor is redundant. A long-term investor is the only kind of investor there is. Someone who can't hold on to stocks for more than a few months at a time is doomed to end up not as a victor but as a victim. The early bird gets wormed. Among the get-rich-quick toxins that poisoned the mind of the investing public in the 1990s, one of the most lethal was the idea that you can build wealth by buying IPOs. An IPO is an initial public offering, or the first sale of a company's stock to the public. At first blush, investing in IPO sounds like a great idea after all. If you bought 100 shares of Microsoft when it went public on March 13, 1986, your $2,100 investment would have grown to $720,000 by early 2003. And finance professors Jay Ritter and William Schwartz have shown that if you had spread a total of only $1,000 across every IPO in January 1960 at its offering price, sold out at the end of that month, then invested anew in each successive month's crop of IPOs, your portfolio would have been worth more than $533 decillion by year end 2001. On the printed page that looks like this, 533 7 Barber and Odion's findings are available at Edu Odion Current 20 Research, HM and http://faculty.gsm.ucdavis.edu/-bm Barber/research/ The numerous studies, incidentally, have found virtually identical results among professional money managers, so this is not a problem limited to naive individuals. See www.microsoft.com/MsFT/stock.htm. IPO investment results. Researchers Brad Barber and Terrence Odion divided thousands of traders into 5 tiers based on how often they turned over their holdings. Those who traded the least at the left kept most of their gains. But the impatient and hyperactive traders made their brokers rich, not themselves. The bars at the far right show a market index fund for comparison. Source: Profs. Brad Barber, University of California at Davis, and Terrence Odion, University of California at Berkeley. Unfortunately, for every IPO like Microsoft that turns out to be a big winner, there are thousands of losers. The psychologists Daniel Kahneman and Amos Tversky have shown when humans estimate the likelihood or frequency of an event, we make that judgment based not on how often the event has actually occurred, but on how vivid the past examples are. We all want to buy the next Microsoft precisely because we know we missed buying the first Microsoft. But we conveniently overlook the fact that most other IPOs were terrible investments. You could have earned that $533 decillion gain only if you never missed a single one of the IPO market's rare winners, a practical impossibility. Finally, most of the high returns on IPOs are captured by members of an exclusive private club, the big investment banks and fund houses that get shares at the initial or underwriting price before the stock begins public trading. The biggest run-ups often occur in stocks so small that even many big investors can't get any shares. There just aren't enough to go around. If, like nearly every investor, you can get access to IPOs only after their shares have rocketed above the exclusive initial price, your results will be terrible. From 1980 through 2001, if you had bought the average IPO at its first public closing price and held on for 3 years, you would have underperformed the market by more than 23 percentage points annually. Perhaps no stock personifies the pipe dream of getting rich from IPOs better than VA Linux. Linux, the next mess, exulted an early owner, buy now and retire in 5 years from now. 10 on December 9th, 1999, the stock was placed at an initial public offering price of $30. But demand for the shares was so ferocious that when NASDAQ opened that morning, none of the initial owners of VA Linux would let go of any shares until the price hit $299. The stock peaked at $320 and closed at $239.25, a gain of 697.5% in a single day. But that gain was earned by only a handful of institutional traders. Individual investors were almost entirely frozen out. More important, buying IPOs is a bad idea because it flagrantly violates one of Graham's most fundamental rules. No matter how many other people want to buy a stock, you should buy only if the stock is a cheap way to own a desirable business. At the peak price on day one, investors were valuing VA Linux's shares at a total of $12.7 billion. What was the company's business worth? Less than 5 years old, VA Linux had sold a cumulative total of $44 million worth of its software and services, but had lost $25 million in the process. In its most recent fiscal quarter, VA Linux had generated $15 million in sales, but J.R. Ritter and Ivo Welch, a review of IPO activity, pricing, and Aloka Tie-ins Journal of Finance, August 2002, peaked 1,797. Ritter's website at http CBA Uffle Edu Ritter and Welch's homepage at http Welch Som Yale Edu are gold mines of data for anyone interested in IPOs. 10 message number 9, posted by Goldfinger69 on the VA Linux LuxMe Sage board at messages.yahoo.com, dated December 16, 1999. MEST is the ticker symbol for Microsoft Corp, had lost $10 million on them. This business then was losing almost 70 cents on every dollar it took in. VA Linux's accumulated deficit, the amount by which its total expenses had exceeded its income, was $30 million. If VA Linux were a private company owned by the guy who lives next door, and he leaned over the picket fence and asked you how much you would pay to take his struggling little business off his hands, would you answer, "Oh, $12.7 billion sounds about right to me"? Or would you instead smile politely, turn back to your barbecue grill, and wonder what on earth your neighbor had been smoking? Relying exclusively on our own judgment, none of us would be caught dead agreeing to pay nearly $13 billion for a money loser that was already $30 million in the hole. But when we're in public instead of in private, when valuation suddenly becomes a popularity contest, the price of a stock seems more important than the value of the business it represents. As long as someone else will pay even more than you did for a stock, why does it matter what the business is worth? This chart shows why it matters. After going up like a bottle rocket on that first day of trading, VA Linux came down like a buttered brick. By December 9, 2002, 3 years to the day after the stock was at $239.5, VA Linux closed at $1.19 per share. Weighing the evidence objectively, the intelligent investor should conclude that IPO does not stand only for initial public offering. More accurately, it is also shorthand for it's probably overpriced, imaginary profits only, insider's private opportunity, or idiotic, preposterous, and outrageous. Chapter 7 Portfolio Policy for the Enterprising Store. The positive side enterprising investor, by definition, will devote a fair amount of his attention and efforts toward obtaining a better than run-of-the-mill investment result. In our discussion of general investment policy, we have made some suggestions regarding bond investments that are addressed chiefly to the enterprising investor. He might be interested in special opportunities of the following kinds. 1. Tax-free new housing authority bonds effectively guaranteed by the United States government. 2. Taxable but high-yielding new community bonds, also guaranteed by the United States government. 3. Tax-free industrial bonds issued by municipalities, but SRVIC by lease payments made by strong corporations. References have been made to these unusual types of bond issues in Chapter 4. At the other end of the spectrum, there may be lower quality bonds obtainable at such low prices as to constitute true bargain opportunities. But these would belong in the special situation area, where no true distinction exists between bonds and common stocks. As already noted, CP 96, footnote plus, the new housing authority and new community bonds are no longer issued. Plus, today these lower quality bonds in the special situation area are known as distressed or defaulted bonds. When a company is in or operations in common stocks, the activities specially characteristic of the enterprising investor in the common stock field may be classified under four heads. 1. Buying in low markets and selling in high markets. 2. Buying carefully chosen growth stocks. 3. Buying bargain issues of various types. 4. Buying into special situations. General market policy formula. Timing reserved for the next chapter. Our discussion of the possibilities and limitations of a policy of entering the market when it is depressed and selling out in the advanced stages of a boom. For many years in the past, this bright idea appeared both simple and feasible, at least from first inspection of a market chart covering its periodic fluctuations. We have already admitted ruefully that the market's action in the past 20 years has not lent itself to operations of this sort on any mathematical basis. The fluctuations that have taken place, while not inconsiderable in extent, would have required a special talent or feel for trading to take advantage of them. This is something quite different from the intelligence which we are assuming in our readers, and we must exclude operations based on such skill from our terms of reference. The 50-50 plan, which we propose to the defensive investor and described on page 90, is about the best specific or automatic formula we can recommend to all investors under the conditions of 1972. But we have retained a broad leeway between the 25% many approaching bankruptcy. Its common stock becomes essentially worthless since U.S. bankruptcy law entities bondholders to a much stronger legal claim than shareholders. But if the company reorganizes successfully and comes out of bankruptcy, the bondholders often receive stock in the new firm, and the value of the bonds usually recovers once the company is able to pay interest again. Thus, the bonds of a troubled company can perform almost as well as the common stock of a healthy company. In these special situations, as Graham puts it, no true distinction exists between bonds and common stocks. There are two catches to this simple idea. The first is that common stocks with good records and apparently good prospects sell at correspondingly high prices. The investor may be right in his judgment of their prospects and still not fare particularly well, merely because he has paid in full and perhaps overpaid for the expected prosperity. The second is that his judgment as to the future may prove wrong. Unusually rapid growth cannot keep up forever. When a company has already registered a brilliant expansion, its very increase in size makes a repetition of its achievement more difficult. At some point, the growth curve flattens out, and in many cases, it turns downward. It is obvious that if one confines himself to a few chosen instances, based on hindsight, he could demonstrate that fortunes can readily be either made or lost in the growth stock field. How can one judge fairly of the overall results obtainable here? We think that reasonably sound conclusions can be drawn from a study of the results achieved by the investment funds specializing in the growth stock approach. The authoritative manual entitled Investment Companies, published annually by Arthur Wiesenberger and Company, members of the New York Stock Exchange, computes the annual performance of some 120 such growth funds over a period of years. Of these, 45 have records covering 10 years or more. The average overall gain for these companies unweighted for size of fund works out at 108% for the decade 1961 to 1970, compared with 105% for the S&P Composite and 83% for the GIA. In the 2 years 1969 and 1970, the majority of the 126 growth funds did worse than either index. Similar results were found in our earlier studies. The implication here is that no outstanding rewards came from diversified investment in growth companies as compared with that in common stocks generally. Over the 10 years ending December 31, 2002, funds investing in large growth companies, today's equivalent of what Graham calls growth funds, earned an annual average of 5.6%, underperforming the overall stock market by an average of 3.7 percentage points per year. However, large value funds investing in more reasonably priced big companies also underperformed the market over the same period by a full percentage point per year. Is the problem merely that growth funds cannot reliably select? There is no reason at all for thinking that the average intelligent investor, even with much devoted effort, can derive better results over the years from the purchase of growth stocks than the investment companies specializing in this area. Surely these organizations have more brains and better research facilities at their disposal than you do. Consequently, we should advise against the usual type of growth stock commitment for the enterprising investor. This is one in which the excellent prospects are fully recognized in the market and already reflected in a current price-earnings ratio of, say, higher than 20. For the defensive investor, we suggested an upper limit of purchase price at 25 times average earnings of the past 7 years. The two criteria would be about equivalent in most cases, plus stocks that will outperform the market in the future? Or is it that the high costs of running the average fund, whether it buys growth or value companies, exceed any extra return the managers can earn with their stock picks? To update fund performance by type, see www.morningstar.com, category returns. For an enlightening reminder of how perishable the performance of different investment styles can be, see www.callan.com/resource/periodic table portable PDF. Graham makes this point to remind you that an enterprising investor is not one who takes more risk than average or who buys aggressive growth stocks. An enterprising investor is simply one who is willing to put in extra time and effort in researching his or her portfolio. Plus, notice that Graham insists on calculating the price or earnings ratio based on a multi-year average of past earnings. That way, you lower the odds that you will overestimate a company's value based on a temporarily high burst of profitability. Imagine that a company earned $3 per share over the past 12 months, but an average of only 50 cents per share over the previous 6 years. Which number, the sudden $3 or the steady 50 cents, is more likely to represent a sustainable trend? At 25 times the $3 it earned in the most recent year, the stock would be priced at $75. But at 25 times the average earnings of the past 7 years, 6 in total earnings, divided by 7 equals 85.7 cents per share in average annual earnings, the stock would be priced at only 21 for $3. Which number you pick makes a big difference. Finally, it's worth noting that the prevailing method on Wall Street today, basing price or earnings ratios primarily on next year's earnings, would be the striking thing about growth stocks as a class is their tendency toward wide swings in market price. This is true of the largest and longest established companies such as General Electric and International Business Machines, and even more so of newer and smaller successful companies. They illustrate our thesis that the main characteristic of the stock market since 1949 has been the injection of a highly speculative element into the shares of companies which have scored the most brilliant successes and which themselves would be entitled to a high investment rating. Their credit standing is of the best, and they pay the lowest interest rates on their borrowings. The investment caliber of such a company may not change over a long span of years, but the risk characteristics of its stock will depend on what happens to it in the stock market. The more enthusiastic the public grows about it, and the faster its advance as compared with the actual growth in its earnings, the riskier a proposition it becomes. But is it not true, the reader may ask, that the really big fortunes from common stocks have been garnered by those who made a substantial commitment in the early years of a company in whose future they had great confidence, and who held their original shares unwaveringly while they increased 100-fold or more in value? The answer is yes. But the big fortunes from single company investments are almost always realized by persons anathema to Graham. How can you value a company based on earnings it hasn't even generated yet? That's like setting house prices based on a rumor that Cinderella will be building her new castle right around the corner. Recent examples hammer Graham's point home. On September 21, 2000, Intel Corp, the maker of computer chips, announced that it expected its revenues to grow by up to 5% in the next quarter. At first blush, that sounds great. Most big companies would be delighted to increase their sales by 5% in just 3 months. But in response, Intel stock dropped 22%, a one-day loss of nearly $91 billion in total value. Why? Wall Street's analysts had expected Intel's revenue to rise by up to 10%. Similarly, on February 21, 2001, EMC Corp, a data storage firm, announced that it expected its revenues to grow by at least 25% into 2001, but that a new code tie-in among customers may lead to longer selling cycles. On that whiff of hesitation, EMC's shares lost 12.8% of their value in a single day. Have a close relationship with the particular company through employment, family connection, etc., which justifies them in placing a large part of their resources in one medium and holding on to this commitment through all vicissitudes, despite numerous temptations to sell out at apparently high prices along the way. An investor without such close personal contact will constantly be faced with the question of whether to large a portion of his funds are in this one medium. Each decline, however temporary it proves in the sequel, will accentuate his problem, and internal and external pressures are likely to force him to take what seems to be a goodly profit, but one far less than the ultimate bonanza. 3 recommended fields for enterprising investment. To obtain better than average investment results over a long pull requires a policy of selection or operation possessing a twofold merit. 1, it must meet objective or rational tests of underlying soundness, and 2, it must be different from the policy followed by most investors or speculators. Our experience and study leads us to recommend 3 investment approaches that meet these criteria. They differ rather widely from one another, and each may require a different type of knowledge and temperament on the part of those who assay it. Today's equivalent of investors who have a close relationship with the particular company are so-called control persons, senior managers, or directors who help run the company and own huge blocks of stock. Executives like Bill Gates of Microsoft or Warren Buffett of Berkshire Hathaway have direct control over a company's destiny, and outside investors want to see these chief executives maintain their large shareholdings as a vote of confidence. But less senior managers and rank-and-file workers cannot influence the company's share price with their individual decisions. Thus, they should not put more than a small percentage of their assets in their own employer's stock. As for outside investors, no matter how well they think they know the company, the same objection applies. The relatively unpopular large companion, if we assume that it is the habit of the market to overvalue common stocks which have been showing excellent growth or are glamorous for some other reason, it is logical to expect that it will undervalue relatively at least companies that are out of favor because of unsatisfactory developments of a temporary nature. This may be set down as a fundamental law of the stock market, and it suggests an investment approach that should prove both conservative and promising. The key requirement here is that the enterprising investor concentrate on the larger companies that are going through a period of unpopularity. While small companies may also be undervalued for similar reasons, and in many cases may later increase their earnings and share price, they entail the risk of a definitive loss of profitability and also of protracted neglect by the market in spite of better earnings. The large companies thus have a double advantage over the others. First, they have the resources and capital and brainpower to carry them through adversity and back to a satisfactory earnings base. Second, the market is likely to respond with reasonable speed to any improvement shown. A remarkable demonstration of the soundness of this thesis is found in studies of the price behavior of the unpopular issues in the Dow Jones Industrial Average. In these, it was assumed that an investment was made each year in either the 6 or the 10 issues in the GIA which were selling at the lowest multipliers of their current or previous year's earnings. These could be called the cheapest stocks in the list, and their cheapness was evidently the reflection of relative unpopularity with investors or traders. It was assumed further that these purchases were sold out at the end of holding periods ranging from 1 to 5 years. The results of these investments were then compared with the results shown in either the GIA as a whole or in the highest multiplier I, the most popular group. The detailed material we have available covers the results of annual purchases assumed in each of the past 53 years. In the early period, 1917 to 1933, this approach proved unprofitable. But since 1933, the method has shown highly successful results. In 34 tests made by Drexel and Company, now Rexel Firestone of 1 year holding from 1937 through 1969, the cheap stocks did definitely worse than the GIA in only 3 instances. The results were about the same in 6 cases, and the cheap stocks clearly outperformed the average in 25 years. The consistently better performance of the low multiplier stocks is shown table 7-2 by the average results for successive 5-year periods when compared with those of the GIA and of the 10 high multipliers. The Drexel computation shows further that an original investment of $10,000 made in the low multiplier issues in 1936 and switched each year in accordance with the principle would have grown to $66,900 by 1962. The same operations in high multiplier stocks would have ended with a value of only $25,300, while an operation in all 30 stocks would have increased the original fund to $44,000, plus the concept of buying unpopular large companies. And its Drexel Firestone, a Philadelphia investment bank, merged in 1973 with Burnham & Co. and later became Drexel Burnham Lambert, famous for its junk bond financing of the 1980s takeover boom. Plus, this strategy of buying the cheapest stocks in the Dow Jones Industrial Average is now nicknamed the Dogs of the Dow approach. Information on the Dow 10 is available at www.djindexes.com/JSP/Dow510FAQ.JSP, made by Drexel and Company, now Drexel Firestone of 1 year holding from 1937 through 1969. The cheap stocks did definitely worse than the GIA in only 3 instances. The results were about the same in 6 cases, and the cheap stocks clearly outperformed the average in 25 years. The consistently better performance of the low multiplier stocks is shown table 7-2 by the average results for successive 5-year periods when compared with those of the GIA and of the 10 high multipliers. The Drexel computation shows further that an original investment of $10,000 made in the low multiplier issues in 1936 and switched each year in accordance with the principle would have grown to $66,900 by 1962. The same operations in high multiplier stocks would have ended with a value of only $25,300, while an operation in all 30 stocks would have increased the original fund to $44,000, plus the concept of buying unpopular large companies. And its Drexel Firestone, a Philadelphia investment bank, merged in 1973 with Burnham & Co. and later became Drexel Burnham Lambert, famous for its junk bond financing of the 1980s takeover boom. Plus, this strategy of buying the cheapest stocks in the Dow Jones Industrial Average is now nicknamed the Dogs of the Dow approach. Information on the Dow 10 is available at www.djindexes.com/JSP/Dow510FA, the end of 1968 and revalued on June 30th, 1971. This time, the figures proved quite disappointing, showing a sharp loss for the low multiplier 6 or 10 and a good profit for the high multiplier Select tie-ins. This one bad instance should not vitiate conclusions based on 30-odd experiments, but its recent happening gives it a special adverse weight. Perhaps the aggressive investor should start with the low multiplier idea, but add other quantitative and qualitative requirements thereto in making up his portfolio. Purchase of bargain essuies define a bargain issue as one which, on the basis of facts established by analysis, appears to be worth considerably more than it is selling for. The genus includes bonds and preferred stocks selling well under par, as well as common stocks. To be as concrete as possible, let us suggest that an issue is not a true bargain unless the indicated value is at least 50% more than the price. What kind of facts would warrant the conclusion that so great a discrepancy exists? How do bargains come into existence, and how does the investor profit from them? There are 2 tests by which a bargain common stock is detected. The first is by the method of appraisal. This relies largely on estimating future earnings and then multiplying these by a factor appropriate to the particular issue. If the resultant value is sufficiently above the market price, and if the investor has confidence in the technique employed, he can tag the stock as a bargain. The second test is the value of the business to a private owner. This value also is often determined chiefly by expected future earnings, in which case the result may be identical with the first. But in the second test, more attention is likely to be paid to the realizable value of the assets, with particular emphasis on the net current assets or working capital. At low points in the general market, a large proportion of common stocks are bargain issues as measured by these standards. A typical example was General Motors when it sold at less than 30 in 1941, equivalent to only 5 for the 1971 shares. It had been earning in excess of $4 and paying $3.5 or more in dividends. It is true that current earnings and the immediate prospects may both be poor, but a level-headed appraisal of average future conditions would indicate values far above ruling prices. Thus, the wisdom of having courage in depressed markets is vindicated not only by the voice of experience, but also by application of plausible techniques of value analysis. The same vagaries of the marketplace that recurrently establish a bargain condition in the general list account for the existence of many individual bargains at almost all market levels. The market is fond of making mountains out of molehills and exaggerating ordinary vicissitudes into major setbacks. Even a mere lack of interest or enthusiasm may impel a price decline to absurdly low levels. Thus, we have what appear to be two major sources of undervaluation: one, currently disappointing results, and two, protracted neglect or unpopularity. However, neither of these causes, if considered by itself alone, can be relied on as a guide to successful common stock investment. How can we be sure that the currently disappointing results are indeed going to be only temporary? True, we can supply excellent examples of that happening. The steel stocks used to be famous for their cyclical quality, and the shrewd buyer could acquire them at low prices when earnings were low and sell them out in boom years at a fine profit. A spectacular example is supplied by Chrysler Corporation, as shown by the data in Table 7-3. If this were the standard behavior of stocks with fluctuating earnings, then making profits in the stock market would be an easy matter. Unfortunately, we could cite many examples of declines and name on the steepest of the mountains recently made out of molehills. In May 1998, Pfizer Inc. and the U.S. Food and Drug Administration announced that 6 men taking Pfizer's anti-impotence drug Viagra had died of heart attacks while having sex. Pfizer's stock immediately went flaccid, losing 3.4% in a single day on heavy trading. But Pfizer's shares surged ahead when research later showed that there was no cause for alarm. The stock gained roughly a third over the next 2 years. In late 1997, shares of Warner Lambert Co. fell by 19% in a day when sales of its new diabetes drug were temporarily halted in England. Within 6 months, the stock had nearly doubled. In late 2002, Carnival Corp., which operates cruise ships, lost roughly 10% of its value after tourists came down with severe diarrhea and vomiting on ships run by other companies, earnings and price which were not followed automatically by a handsome recovery of both. One such was Anaconda Wire and Cable, which had large earnings up to 1956, with a high price of $85 in that year. The earnings then declined irregularly for 6 years. The price fell to 23% in 1962, and the following year it was taken over by its parent enterprise, Anaconda Corporation, at the equivalent of only 33. The many experiences of this type suggest that the investor would need more than a mere falling off in both earnings and price to give him a sound basis for purchase. He should require an indication of at least reasonable stability of earnings over the past decade or more, no year of earnings deficit, plus sufficient size and financial strength to meet possible setbacks in the future. The ideal combination here is thus that of a large and prominent company selling both well below its past average price and its past average price or earnings multiplier. This would no doubt have ruled out most of the profitable opportunities in companies such as Chrysler, since their low price years are generally accompanied by high price or earnings ratios. But let us assure the reader now, and no doubt we shall do it again, that there is a world of difference between hindsight profits and real money profits. We doubt seriously whether the Chrysler type of roller coaster is a suitable medium for operations by our enterprising investor. We have mentioned protracted neglect or unpopularity as a second cause of price declines to unduly low levels. A current case of this kind would appear to be National Presto Industries. In the bull market of 1968, it sold at a high of 45, which was only 8 times the $5.61 earnings for that year. The per-share profits increased in both 1969 and 1970, but the price declined to only 21 in 1970. This was less than 4 times the record earnings in that year and less than its net current asset value. In March 1972, it was selling at 34, still only 5% times the last reported earnings, and at about its enlarged net current asset value. Another example of this type is provided currently by Standard Oil of California, a concern of major importance. In early 1972, it was selling at about the same price as 13 years before, say 56. Its earnings had been remarkably steady, with relatively small growth but with only one small decline over the entire period. Its book value was about equal to the market price. With this conservatively favorable 1,958-71 record, the company has never shown an average annual price as high as 15 times its current earnings. In early 1972, the price or earnings ratio was only about 10. A third cause for an unduly low price for a common stock may be the market's failure to recognize its true earnings picture. Our classic example here is Northern Pacific Railway, which in 1946-47 declined from 36 to 13%. The true earnings of the road in 1947 were close to $10 per share. The price of the stock was held down in great part by its $1 dividend. It was neglected also because much of its earnings power was concealed by accounting methods peculiar to railroads. The type of bargain issue that can be most readily identified is a common stock that sells for less than the company's net working capital alone after deducting all prior obligations. This would mean that the buyer would pay nothing at all for the fixed assets, buildings, machinery, etc., or any goodwill items that might exist. Very few companies turn out to have an ultimate value less than the working capital alone, although scattered instances may be found. The surprising thing, rather, is that there have been so many enterprises obtainable which have been valued in the market on this bargain basis. A compilation made in 1957, when the market's level was by no means low, disclosed about 150 of such common stocks. In Table 7-4, we summarize the result of buying on December 31, 1957, one share of each of the 85 companies in that list for which data appeared in Standard & Poor's monthly stock guide, and holding them for 2 years. By something of a coincidence, each of the groups advanced in the 2 years to somewhere in the neighborhood of the aggregate net current asset value. The gain for the entire portfolio in that period was 75% against 50% for Standard & Poor's for 125 industrials. What is more remarkable is that none of the issues showed significant losses, 7 held about even, and 78 showed appreciable gains. Our experience with this type of investment selection on a by net working capital, Graham means a company's current assets such as cash, marketable securities, and inventories minus its total liabilities including preferred stock and long-term debt. Diversified basis was uniformly good for many years prior to 1957. It can probably be affirmed without hesitation that it constitutes a safe and profitable method of determining and taking advantage of undervalued situations. However, during the general market advance after 1957, the number of such opportunities became extremely limited, and many of those available were showing small operating profits or even losses. The market decline of 1969-70 produced a new crop of these sub-working capital stocks. We discussed this group in Chapter 15 on stock selection for the enterprising investor. Bargain issue pattern in secondary companies. We have defined a secondary company as one that is not a leader in a fairly important industry. Thus, it is usually one of the smaller concerns in its field, but it may equally well be the chief unit in an unimportant line. By way of exception, any company that has established itself as a growth stock is not ordinarily considered secondary. In the great bull market of the 1920s, relatively little distinction was drawn between industry leaders and other listed issues, provided the latter were of respectable size. The public felt that a middle-sized company was strong enough to weather storms and that it had a better chance for really spectacular expansion than one that was already of major dimensions. The Depression years 1931-32, however, had a particularly devastating impact on the companies below the first rank, either in size or in inherent stability. As a result of that experience, investors have since developed a pro-asm and overvaluation. In a different way, this phenomenon was repeated in 1961 and 1968, the emphasis now being placed on new offerings of the shares of small companies of less than secondary character and on nearly all companies in certain favored fields such as electronics, computers, franchise concerns, and others. As was to be expected, the ensuing market declines fell most heavily on these overvaluations. In some cases, the pendulum swing may have gone as far as definite undervaluation. If most secondary issues tend normally to be undervalued, what reason has the investor to believe that he can profit from such a situation? For if it persists indefinitely, will he not always be in the same market position as when he bought the issue? The answer here is somewhat complicated. Substantial profits from the purchase of secondary companies at bargain prices arise in a variety of ways. First, the dividend return is relatively high. Second, the reinvested earnings are substantial in relation to the price paid and will ultimately affect the price. In a 5 to 7 year period, these advantages can bulk quite large in a well-selected list. Third, a bull market is ordinarily most generous to low-priced issues. Thus, it tends to raise the typical bargain issue to at least a reasonable level. Fourth, even during relatively featureless market periods, a continuous process of price adjustment goes on, under which secondary issues that were undervalued may rise at least to the normal level for their type of security. Fifth, the specific factors that in many from 1975 through 1983, small secondary stocks outperformed large stocks by an amazing average of 17.6 percentage points per year. The investing public eagerly embraced small stocks. Mutual fund companies rolled out hundreds of new funds specializing in them, and small stocks obliged by underperforming large stocks by 5 percentage points per year over the next decade. The cycle recurred in 1999 when small stocks beat big stocks by nearly 9 percentage points, inspiring investment bankers to sell hundreds of hot little high-tech stocks to the public for the first time. Instead of electronics, computers, or franchise in their names, the new buzzwords were optical, wireless, and even prefixes like ENI. Investing buzzwords always turn into buzzsaws, tearing apart anyone who believes in them. Cases made for a disappointing record of earnings may be corrected by the advent of new conditions, or the adoption of new policies, or by a change in management. An important new factor in recent years has been the acquisition of smaller companies by larger ones, usually as part of a diversified cation program. In these cases, the consideration paid has almost always been relatively generous and much in excess of the bargain levels existing not long before. When interest rates were much lower than in 1970, the field of bargain issues extended to bonds and preferred stocks that sold at large discounts from the amount of their claim. Currently, we have a different situation in which even well-secured issues sell at large discounts if carrying coupon rates of, say, 4% or less. Example, American Telephone and Telegraph 2S, due 1986, sold as low as 51 in 1970. Deere & Co. for seconds, due 1983, sold as low as 62. These may well turn out to have been bargain opportunities before very long if ruling interest rates should decline substantially. For a bargain bond issue in the more traditional sense, perhaps we shall have to turn once more to the first mortgage bonds of railroads now in financial difficulties, which sell in the 20s or 30 seconds. Such situations are not for the inexpert investor. Lacking a real sense of values in this area, he may burn his fingers. But there is an underlying tendency for market decline in this field to be overdone. Consequently, the group as a whole offers an especially rewarding invitation to careful and courageous analysis. In the decade ending in 1948, the billion-dollar group of defaulted railroad bonds presented numerous and spectacular opportunities in this area. Such opportunities have been quite scarce since then, but they seem likely to return in the 1970s. Defaulted railroad bonds do not offer significant opportunities today. However, as already noted, distressed and defaulted junk bonds, as well as convertible bonds issued by high-tech companies, may offer real value in the wake of the 2000 to 2002 market crash. But diversification in this area is essential and impractical without at least $100,000 to dedicate to distressed securities alone. Unless you are a millionaire several times over, this kind of diversification is not an option. Special situations or workouts. Not so long ago, this was a field which could almost guarantee an attractive rate of return to those who knew their way around in it. And this was true under almost any sort of general market situation. It was not actually forbidden territory to members of the general public. Some who had a flair for this sort of thing could learn the ropes and become pretty capable practitioners without the necessity of long academic study or apprenticeship. Others have been keen enough to recognize the underlying soundness of this approach and to attach themselves to bright young men who handled funds devoted chiefly to these special situations. But in recent years, for reasons we shall develop later, the field of arbitrages and workouts became riskier and less profitable. It may be that in years to come conditions in this field will become more propitious. In any case, it is worthwhile outlining the general nature and origin of these operations with one or two illustrative examples. The typical special situation has grown out of the increasing number of acquisitions of smaller firms by large ones, as the gospel of diversification of products has been adopted by more and more managements. It often appears good business for such an enterprise to acquire an existing company in the field it wishes to enter rather than to start a new venture from scratch. In order to make such acquisition possible and to obtain acceptance of the deal by the required large majority of shareholders of the smaller company, it is almost always necessary to offer a price considerably above the current level. Such corporate moves have been producing interesting profit-making opportunities for those who have made a study of this field and have good judgment fortified by ample experience. A great deal of money was made by shrewd investors not so many years ago through the purchase of bonds of railroads and bankruptcy bonds, which they knew would be worth much more than their cost when the railroads were finally reorganized. After promulgation of the plans of reorganization, when issued market for the new securities appeared, these could almost always be sold for considerably more than the cost of the old issues which were to be exchanged therefor. There were risks of non-consummation of the plans or of unexpected delays, but on the whole such arbitrage operations proved highly profitable. There were similar opportunities growing out of the breakup of public utility holding companies pursuant to 1935 legislation. Nearly all these enterprises proved to be worth considerably more when changed from holding companies to a group of separate operating companies. The underlying factor here is the tendency of the security markets to undervalue issues that are involved in any sort of complicated legal proceedings. An old Wall Street motto has been, "Never buy into a lawsuit." This may be sound advice to the speculator seeking quick action on his holdings, but the adoption of this attitude by the general public is bound to create bargain opportunities in the securities affected by it, since the prejudice against them holds their prices down to unduly low levels. The exploitation of special situations is a technical branch of investment which requires a somewhat unusual mentality and equipment. Probably only a small percentage of our enterprising investors are likely to engage in it, and this book is not the appropriate medium for expounding its complications. Broader implications of our rules for investment instant policy, as it has been developed here, depends in the first place on a choice by the investor of either the defensive passive or aggressive enterprising role. The aggressive investor must have a considerable knowledge of security values enough, in fact, to warrant viewing his security operations as equivalent to a business enterprise. There is no room in this philosophy for a classic recent example is Philip Morris, whose stock lost 23% in 2 days after a Florida court authorized jurors to consider punitive damages of up to $200 billion against the company which had finally admitted that cigarettes may cause cancer. Within a year, Philip Morris's stock had doubled only to fall back after a later multi-billion-dollar judgment in Illinois. Several other stocks have been virtually destroyed by liability lawsuits, including Johns Manville, W.R. Grace, and Us Corp. Thus, never buy into a lawsuit remains a valid rule for all but the most intrepid investors to live by. Middle ground, or a series of gradations between the passive and aggressive status. Many, perhaps most, investors seek to place themselves in such an intermediate category. In our opinion, that is a compromise that is more likely to produce disappointment than achievement. As an investor, you cannot soundly become half a businessman, expecting thereby to achieve half the normal rate of business profits on your funds. It follows from this reasoning that the majority of security owners should elect the defensive classification. They do not have the time or the determination or the mental equipment to embark upon investing as a quasi-business. They should therefore be satisfied with the excellent return now obtainable from a defensive portfolio and with even less, and they should stoutly resist the recurrent temptation to increase this return by deviating into other paths. The enterprising investor may properly embark upon any security operation for which his training and judgment are adequate and which appears sufficiently promising when measured by established business standards. In our recommendations and caveats for this group of investors, we have attempted to apply such business standards. In those for the defensive investor, we have been guided largely by the 3 requirements of underlying safety, simplicity of choice, and promise of satisfactory results, in terms of psychology as well as arithmetic. The use of these criteria has led us to exclude from the field of recommended investment a number of security classes that are normally regarded as suitable for various kinds of investors. These prohibitions were listed in our first chapter on p. 30. Let us consider a little more fully than before what is implied in these exclusions. We have advised against the purchase at full prices of 3 important categories of securities: 1 foreign bonds, 2 ordinary preferred stocks, and 3 secondary common stocks, including, of course, original offerings of such issues. By full prices, we mean prices close to par for bonds or preferred stocks, and prices that represent about the fair business value of the enterprise in the case of common stocks. The greater number of defensive investors are to avoid these categories regardless of price. The enterprising investor is to buy them only when obtainable at bargain prices, which we define as prices not more than 2/3 of the appraisal value of the securities. What would happen if all investors were guided by our advice in these matters? That question was considered in regard to foreign bonds on page 138, and we have nothing to add at this point. Investment-grade preferred stocks would be bought solely by corporations, such as insurance companies, which would benefit from the special income tax status of stock issues owned by them. The most troublesome consequence of our policy of exclusion is in the field of secondary common stocks. If the majority of investors, being in the defensive class, are not to buy them at all, the field of possible buyers becomes seriously restricted. Furthermore, if aggressive investors are to buy them only at bargain levels, then these issues would be doomed to sell for less than their fair value, except to the extent that they were purchased unintelligently. This may sound severe and even vaguely unethical, yet in truth we are merely recognizing what has actually happened in this area for the greater part of the past 40 years. Secondary issues, for the most part, do fluctuate about a central level which is well below their fair value. They reach and even surpass that value at times, but this occurs in the upper reaches of bull markets, when the lessons of practical experience would argue against the soundness of paying the prevailing prices for common stocks. Thus, we are suggesting only that the aggressive investor recognize the facts of life as it is lived by secondary issues, and that they accept the central market levels that are normal for that class as their guide in fixing their own levels for purchase. There is a paradox here, nevertheless. The average well-selected secondary company may be fully as promising as the average industrial leader. What the smaller concern lacks in inherent stability, it may readily make up in superior possibilities of growth. Consequently, it may appear illogical to many readers to term unintelligent the purchase of such secondary issues at their full enterprise value. We think that the strongest logic is that of experience. Financial history says clearly that the investor may expect satisfactory results, on the average, from secondary common stocks only if he buys them for less than their value to a private owner, that is, on a bargain basis. The last sentence indicates that this principle relates to the ordinary outside investor. Anyone who can control a secondary company, or who is part of a cohesive group with such control, is fully justified in buying the shares on the same basis as if he were investing in a closed corporation or other private business. The distinct tie-in between the position and consequent investment policy of insiders and of outsiders becomes more important as the enterprise itself becomes less important. It is a basic characteristic of a primary or leading company that a single detached share is ordinarily worth as much as a share in a controlling block. In secondary companies, the average market value of a detached share is substantially less than its worth to a controlling owner. Because of this fact, the matter of shareholder management relations and of those between inside and outside shareholders tends to be much more important and controversial in the case of secondary than in that of primary companies. At the end of Chapter 5, we commented on the difficulty of making any hard and fast distinction between primary and secondary companies. The many common stocks in the boundary area may properly exhibit an intermediate price behavior. It would not be illogical for an investor to buy such an issue at a small discount from its indicated or appraisal value, on the theory that it is only a small distance away from a primary classification and that it may acquire such a rating unqualifiedly in the not-too-distant future. Thus, the distinction between primary and secondary issues need not be made too precise, for if it were, then a small difference in quality must produce a large differential in justified purchase price. In saying this, we are admitting a middle ground in the classification of common stocks, although we counseled against such a middle ground in the classification of investors. Our reason for this apparent inconsistency is as follows. No great harm comes from some uncertainty of viewpoint regarding a single security, because such cases are exceptional and not a great deal is at stake in the matter. But the investor's choice as between the defensive or the aggressive status is of major consequence to him, and he should not allow himself to be confused or compromised in this basic decision. Commentary on Chapter 7. It requires a great deal of boldness and a great deal of caution to make a great fortune, and when you have got it, it requires 10 times as much wit to keep it. Nathan Mayer Rothschilding is Nathan an ideal world. The intelligent investor would hold stocks only when they are cheap and sell them when they become overpriced, then duck into the bunker of bonds and cash until stocks again become cheap enough to buy. From 1966 through late 2001, one study claimed $1 held continuously in stocks would have grown to $11.71. But if you had gotten out of stocks right before the 5 worst days of each year, your original $1 would have grown to $9.87. 12. One, like most magical market ideas, this one is based on sleight of hand. How exactly would you or anyone figure out which days will be the worst days before they arrive? On January 7, 1973, the New York Times featured an interview with one of the nation's top financial forecasters who urged investors to buy stocks without hesitation. It's very rare that you can be as unqualifiedly bullish as you can now. That forecaster was named Alan Greenspan, and it's very rare that anyone, the truth about timing, Barron's November 5, 2001, peak 20. The headline of this article is a useful reminder of an enduring principle for the intelligent investor. Whenever you see the word truth in an article about investing, brace yourself. Many of the quotes that follow are likely to be lies. For one thing, an investor who bought stocks in 1966 and held them through late 2001 would have ended up with at least $40, not $11.71. The study cited in Barron's AP pairs to have ignored the reinvestment of dividends has ever been so unqualifiedly wrong as the future Federal Reserve chairman was that day. 1973 and 1974 turned out to be the worst years for economic growth and the stock market since the Great Depression. Can professionals time the market any better than Alan Greenspan? I see no reason not to think the majority of the decline is behind us, declared Kate Leary, president of the market timing firm of R.M. Leary & Co. on December 3, 2001. This is when you want to be in the market, she added, predicting that stocks look good for the first quarter of 2002. Over the next 3 months, stocks earned a measly 0.8% return, underperforming cash by 1.5 percentage points. Leary is not alone. A study by 2 finance professors at Duke University found that if you had followed the recommendations of the best 10% of all market timing newsletters, you would have earned a 12.6% annual return from 1991 through 1995. But if you had ignored them and kept your money in a stock index fund, you would have earned 16.4%. As the Danish philosopher Søren Kierkegaard noted, life can only be understood backwards, but it must be lived forwards. Looking back, you can always see exactly when you should have bought and sold your stocks. But don't let that fool you into thinking you can see in real time just when to get in and out. In the financial markets, hindsight is forever 20/20ths, but foresight is legally blind. And thus, for most investors, market timing is a practical and emotional impossibility. The New York Times, January 7, 1973, Special Economic Survey Section, pp. 1944, press release. It's a good time to be in the market, says R.M. Leary & Company, December 3, 2001. You would also have saved thousands of dollars in annual subscription fees which have not been deducted from the calculations of these newsletters' returns. And brokerage costs and short-term capital gains taxes are usually much higher for market timers than for buy and hold investors. For the Duke study, see John R. Graham and Campbell R. Harvey, Grading the Performance of Market Timing Newsletters, Financial Analyst Journal, November or December, 1997, pp. 54-66. Also available at www.duke.edu/c harvey/research.htm. For more on sensible alternatives to market timing rebalancing and dollar cost averaging, see chapters 5 and 8. WHAT goes up like spacecraft that pick up speed as they rise into the Earth's stratosphere. Growth stocks often seem to defy gravity. Let's look at the trajectories of 3 of the hottest growth stocks of the 1990s: General Electric, Home Depot, and Sun Microsystems. See Figure 7-1. In every year from 1995 through 1999, each grew bigger and more profitable. Revenues doubled at Sun and more than doubled at Home Depot. According to Value Line, GE's revenues grew 29%, its earnings rose 65%. At Home Depot and Sun, earnings per share roughly tripled. But something else was happening, and it wouldn't have surprised Graham one bit. The faster these companies grew, the more expensive their stocks became. And when stocks grow faster than compa and eyes, investors always end up sorry. As Figure 7- shows, a great company is not a great investment if you pay too much for the stock. The more a stock has gone up, the more it seems likely to keep going up. But that instinctive belief is flatly contradicted by a fundamental law of financial physics. The bigger they get, the slower they grow. A 1 billion company can double its sales fairly easily. But where can a 50 billion company turn to find another $50 billion in business? Growth stocks are worth buying when their prices are reasonable, but when their price or earnings ratios go much above 25 or 30, the odds get ugly. Journalist Carol Loomis found that from 1960 through 1999, only 8 of the largest 150 companies on the Fortune 500 list managed to raise their earnings by an annual average of at least 15% for 2 decades. Looking at 5 decades of data, the research firm of Sanford C. Bernstein and Co. showed that only 10% of large U.S. companies had increased their earnings by 20% for at least 5 consecutive years. Only 3% had grown by 20% for at least 10 years straight, and not a single one had done it for 15 years in a row. Carol J. Loomis, The 15% Delusion, Fortune, February 5, 2001, pp. 102-108. See Jason Zweig, A Matter of Expectations, Money, January 2001, pp. 49-50. An academic study of thousands of U.S. stocks from 1951 through 1998 found that over all 10-year periods, net earnings grew by an average of 9.7% annually. But for the biggest 20% of companies, earnings grew by an annual average of just 9.3%. Even many corporate leaders failed to understand these odds. See sidebar on page 184. The intelligent investor, however, gets interested in big growth stocks not when they are at their most popular, but when something goes wrong. In July 2002, Johnson & Johnson announced that federal regulators were investigating accusations of false record-keeping at one of its drug factories, and the stock lost 16% in a single day. That took J&J's share price down from 24 times the previous 12 months' earnings to just 20 times. At that lower level, Johnson & Johnson might once again have become a growth stock with room to grow, making it an example of what Graham calls the relatively unpopular large company. This kind of temporary unpopularity can create lasting wealth by enabling you to buy a great company at a good price. Louis K.C. Chan, Jason Kurcheski, and Joseph Lakonishok, The Level and Persistence of Growth Rates, National Bureau of Economic Research, working paper number 8282, May 2001, available at Warburg Papers W8282. Almost exactly 20 years earlier, in October 1982, Johnson & Johnson stock lost 17.5% of its value in a week when several people died after ingesting Tylenol that had been laced with cyanide by an unknown outsider. Johnson & Johnson responded by pioneering the use of tamper-proof packaging, and the stock went on to be one of the great investments of the 1980s. Investors aren't the only people who fall prey to the delusion that hypergrowth can go on forever. In February 2000, Chief Executive John Roth of Nordell Networks was asked how much bigger his giant fiber optics company could get. The industry is growing 14% to 15% a year, Roth replied, and we're going to grow 6 points faster than that. For a company our size, that's pretty heady stuff. Nordell's stock, up nearly 51% annually over the previous 6 years, was then trading at 87 times what Wall Street was guessing it might earn in 2000. Was the stock overpriced? It's getting up there, shrugged Roth, but there's still plenty of room to grow our valuation as we execute on the wireless strategy. After all, he added, Cisco Systems was trading at 121 times its projected earnings. As for Cisco, in November 2000, its chief executive, John Chambers, insisted that his company could keep growing at least 50% annually. Logic, he declared, would indicate this is a breakaway. Cisco's stock had come way down. It was then trading at a mere 98 times its earnings over the previous year, and Chambers urged investors to buy. So who you going to bet on? He asked. Now may be the opportunity. Instead, these growth companies shrank and their overpriced stocks shriveled. Nortel's revenues fell by 37% in 2001, and the company lost more than $26 billion that year. Cisco's revenues did rise by 18% in 2001, but the company ended up with a net loss of more than $1 billion. Nortel's stock at $113.5 when Roth spoke finished 2002 at $1.65. Cisco's shares at $52 when Chambers called his company a breakaway crumbled to $13. Both companies have since become more circumspect about forecasting the future. Lisa Gibbs, Optic Uptick, Money, April 2000, pp. 54 minus 55. Brooke Southall, Cisco's Endgame Strategy, Investment News, November 30th, 2000, pp. 123. Should you put all your eggs in one basket? Put all your eggs into one basket and then watch that basket, proclaimed Andrew Carnegie a century ago. Do not scatter your shot. The great successes of life are made by concentration. As Graham points out, the really big fortunes from common stocks have been made by people who packed all their money into one investment they knew supremely well. Nearly all the richest people in America trace their wealth to a concentrated investment in a single industry or even a single company. Think Bill Gates and Microsoft, Sam Walton and Walmart, or the Rockefellers and Standard Oil. The Forbes 400 list of the richest Americans, for example, has been dominated by undiversified fortunes ever since it was first compiled in 1982. However, almost no small fortunes have been made this way, and not many big fortunes have been kept this way. What Carnegie neglected to mention is that concentration also makes most of the great failures of life. Look again at the Forbes Rich list. Back in 1982, the average net worth of a Forbes 400 member was $230 million. To make it onto the 2002 Forbes 400, the average 1982 member needed to earn only a 4.5% average annual return on his wealth during a period when even bank accounts yielded far more than that, and the stock market gained an annual average of 13.2%. So how many of the Forbes 400 fortunes from 1982 remained on the list 20 years later? Only 64 of the original members, a measly 16, were still on the list in 2002. By keeping all their eggs in the one basket that had gotten them onto the list in the first place, once booming industries like oil and gas, or computer hardware, or basic manufacturing, all the other original members fell away. When hard times hit, none of these people, despite all the huge advantages that great wealth can bring, were properly prepared. They could only stand by and wince at the sickening crunch as the constantly changing economy crushed their only basket and all their eggs. 1010 for the observation that it is amazingly difficult to remain on the Forbes 400. I am indebted to investment manager Kenneth Fisher, himself a Forbes columnist. The bargain bin. You might think that in our endlessly networked world, it would be a cinch to build and buy a list of stocks that meet Graham's criteria for bargains, p. 169. Although the internet is a help, you'll still have to do much of the work by hand. Grab a copy of today's Wall Street Journal, turn to the money and investing section, and take a look at the NYSE and NASDAQ scorecards to find the day's list of stocks that have hit new lows for the past year. A quick and easy way to search for companies that might pass Graham's net working capital tests. Online, try HTTP, morningstar.com/high-low.html ?m section equals high-low. To see whether a stock is selling for less than the value of net working capital, what Graham's followers call net nets, download or request the most recent quarterly or annual report from the company's website or from the Edgar database at www.sec.gov. From the company's current assets, subtract its total liabilities, including any preferred stock and long-term debt. Or consult your local public library's copy of the Value Line Investment Survey, saving yourself a costly annual subscription. Each issue carries a list of bargain-based mint stocks that come close to Graham's definition. Most of these stocks lately have been in bombed-out areas like high-tech and telecommunications. As of October 31st, 2002, for instance, Converse Technology had $2.4 billion in current assets and $1.0 billion in total liabilities, giving it $1.4 billion in net working capital. With fewer than 190 million shares of stock and a stock price under $8 per share, Converse had a total market capitalization of just under $1.4 billion. With the stock priced at no more than the value of Converse's cash and inventories, the company's ongoing business was essentially selling for nothing. As Graham knew, you can still lose money on a stock like Converse, which is why you should buy them only if you can find a couple dozen at a time and hold them patiently. But on the very rare occasions when Mr. Market generates that many true bargains, you're all but certain to make money. What's your foreign policy? Investing in foreign stocks may not be mandatory for the intelligent investor, but it is definitely advisable. Why? Let's try a little thought. Make it onto the 2000 to Forbes 400. The average 1982 member needed to earn only a 4.5% average annual return on his wealth during a period when even bank accounts yielded far more than that, and the stock market gained an annual average of 13.2%. So how many of the Forbes 400 fortunes from 1982 remained on the list 20 years later? Only 64 of the original members, a measly 16, were still on the list in 2002. By keeping all their eggs in the one basket that had gotten them onto the list in the first place, once booming industries like oil and gas, or computer hardware, or basic manufacturing, all the other original members fell away. When hard times hit, none of these people, despite all the huge advantages that great wealth can bring, were properly prepared. They could only stand by and wince at the sickening crunch as the constantly changing economy crushed their only basket and all their eggs. 1010 for the observation that it is amazingly difficult to remain on the Forbes 400. I am indebted to investment manager Kenneth Fisher, himself a Forbes columnist. The bargain bin. You might think that in our endlessly networked world, it would be a cinch to build and buy a list of stocks that meet Graham's criteria for bargains, p. 169. Although the internet is a help, you'll still have to do much of the work by hand. Grab a copy of today's Wall Street Journal, turn to the money and investing section, and take a look at the NYSE and NASDAQ scorecards to find the day's list of stocks that have hit new lows for the past year. A quick and easy way to search for companies that might pass Graham's net working capital tests. Online, try HTTP, morningstar.com/high-low.html ? M section equals high-low. To see whether a stock is selling for less than the value of net working capital, what Graham's followers call net nets, download or request the most recent quarterly or annual report from the company's website or from the Edgar database at www.sec.gov. From the company's current assets, subtract its total liabilities, including any preferred stock and long-term debt. Or consult your local public library's copy of the Value Line Investment Survey, saving yourself a costly annual subscription. Each issue carries a list of bargain-based mint stocks that come close to Graham's definition. Most of these stocks lately have been in bombed-out areas like high-tech and telecommunications. As of October 31, 2002, for instance, Converse Technology had $2.4 billion in current assets and $1.0 billion in total liabilities, giving it $1.4 billion in net working capital. With fewer than 190 million shares of stock and a stock price under $8 per share, Converse had a total market capitalization of just under $1.4 billion. With the stock priced at no more than the value of Converse's cash and inventories, the company's ongoing business was essentially selling for nothing. As Graham knew, you can still lose money on a stock like Converse, which is why you should buy them only if you can find a couple dozen at a time and hold them patiently. But on the very rare occasions when Mr. Market generates that many true bargains, you're all but certain to make money. What's your foreign policy? Investing in foreign stocks may not be mandatory for the intelligent investor, but it is definitely advisable. Why? Let's try a little thought experiment. It's the end of 1989 and you're Japanese. Here are the facts. Over the past 10 years, your stock market has gained an annual average of 21.2%, well ahead of the 17.5% annual gains in the United States. Japanese companies are buying up everything in the United States, from the Pebble Beach golf course to Rockefeller Center. Meanwhile, American firms like Drexel Burnham Lambert, Finn & Shaw Corp of America, and Texaco are going bankrupt. The U.S. high-tech industry is dying. Japan's is booming. In 1989, in the land of the rising sun, you can only conclude that investing outside of Japan is the dumbest idea since sushi vending machines. Naturally, you put all your money in Japanese stocks. The result? Over the next decade, you lose roughly 2/3 of your money. The lesson? It's not that you should never invest in foreign markets like Japan. It's that the Japanese should never have kept all their money at home. And neither should you. If you live in the United States, work in the United States, and get paid in US dollars, you are already making a multi-layered bet on the US economy. To be prudent, you should put some of your investment portfolio elsewhere simply because no one anywhere can ever know what the future will bring at home or abroad. Putting up to a third of your stock money in mutual funds that hold foreign stocks, including those in emerging markets, helps ensure against the risk that our own backyard may not always be the best place in the world to invest. Chapter 8, the investor and market fluctuations. To the extent that the investor's funds are placed in high-grade bonds of relatively short maturity, say of 7 years or less, he will not be affected significantly by changes in market prices and need not take them into account. This applies also to his holdings of U.S. savings bonds, which he can always turn in at his cost price or more. His longer-term bonds may have relatively wide price swings during their lifetimes, and his common stock portfolio is almost certain to fluctuate in value over any period of several years. The investor should know about these possibilities and should be prepared for them both financially and psychologically. He will want to benefit from changes in market levels, certainly through an advance in the value of his stock holdings as time goes on, and perhaps also by making purchases and sales at advantageous prices. This interest on his part is inevitable and legitimate enough, but it involves the very real danger that it will lead him into speculative attitudes and activities. It is easy for us to tell you not to speculate. The hard thing will be for you to follow this advice. Let us repeat what we said at the outset. If you want to speculate, do so with your eyes open, knowing that you will probably lose money in the end. Be sure to limit the amount at risk and to separate it completely from your investment program. We shall deal first with the more important subject of price changes in common stocks and pass later to the area of bonds. In Chapter 3, we supplied a historical survey of the stock market's action over the past 100 years. In this section, we shall return to that material from time to time in order to see what the past record promises the investor in either the form of long-term appreciation of a portfolio held relatively unchanged through successive rises and declines, or in the possibilities of buying near bear market lows and selling not too far below bull market highs. Market fluctuations as a guide to investment decisions. Since common stocks, even of investment grade, are subject to recurrent and wide fluctuations in their prices, the intelligent investor should be interested in the possibilities of profiting from these pendulum swings. There are two possible ways by which he may try to do this: the way of timing and the way of pricing. By timing, we mean the endeavor to anticipate the action of the stock market to buy or hold when the future course is deemed to be upward, to sell or refrain from buying when the course is downward. By pricing, we mean the endeavor to buy stocks when they are quoted below their fair value and to sell them when they rise above such value. A less ambitious form of pricing is the simple effort to make sure that when you buy, you do not pay too much for your stocks. This may suffice for the defensive investor, whose emphasis is on long pull holding, but as such it represents an essential minimum of attention to market levels. We are convinced that the intelligent investor can derive satisfactory results from pricing of either type. We are equally sure that if he places his emphasis on timing in the sense of forecasting, he will end up as a speculator and with a speculator's financial results. This distinction may seem rather tenuous to the layman, and it is not commonly accepted on Wall Street. As a matter of business practice, or perhaps of thoroughgoing conviction, the stockbrokers and the investment services seem wedded to the principle that both investors and speculators in common stocks should devote careful attention to market forecasts. The farther one gets from Wall Street, the more skepticism one will find, we believe, as to the pretensions of stock market forecasting or timing. The investor can scarcely take seriously the innumerable predictions which appear almost daily and are his for the asking. Yet in many cases he pays attention to them and even acts upon them. Why? Because he has been persuaded that it is important for him to form some opinion of the future course of the stock market, and because he feels that the brokerage or service forecast is at least more dependable than his own. We lack space here to discuss in detail the pros and cons of market forecasting. A great deal of brain power goes into this field, and undoubtedly some people can make money by being good stock market analysts. But it is absurd to think that the general public can ever make money out of market forecasts. For who will buy when the general public at a given signal rushes to sell out at a profit? If you, the reader, expect to get rich over the years by following some system or leadership in market forecasting, you must be expecting to try to do what countless others are aiming at and to be able to do it better than your numerous competitors in the market. There is no basis either in logic or in experience for assuming that any typical or average investor can anticipate market movements more successfully than the general public, of which he is himself a part. There is one aspect of the timing philosophy which seems to have escaped everyone's notice. Timing is of great psychological importance to the speculator because he wants to make his profit in. In the late 1990s, the forecasts of market strategists became more influential than ever before. They did not, unfortunately, become more accurate. On March 10, 2000, the very day that the NASDAQ Composite Index hit its all-time high of 5,048.62, Prudential Securities' chief technical analyst Ralph Acampora said in USA Today that he expected NASDAQ to hit 6,000 within 12 to 18 months. 5 weeks later, NASDAQ had already shriveled to 3.3 to 1.29, but Thomas Galvin, a market strategist at Donaldson, Lufkin, and Jenrette, declared that there's only 200 or 300 points of downside for the NASDAQ and 2,000 on the upside. It turned out that there were no points on the upside and more than 2,000 on the downside, as NASDAQ kept crashing until it finally scraped bottom on October 9, 2002 at November 11-14. In March 2001, Abby Joseph Cohen, chief investment strategist at Goldman Sachs & Co., predicted that the Standard & Poor's 500 stock index would close the year at 1,650 and that the Dow Jones Industrial Average would finish 2001 at 13,000. We do not expect a recession, said Cohen, and believe that corporate profits are likely to grow at close to trend growth rates later this year. The U.S. economy was sinking into recession even as she spoke, and the S&P 500 ended 2001 at August 11.48, while the Dow finished at 10,021.5, minus 30 and 23% below her forecasts, respectively. A hurry. The idea of waiting a year before his stock moves up is repugnant to him, but a waiting period as such is of no consequence to the investor. What advantage is there to him in having his money uninvested until he receives some presumably trustworthy signal that the time has come to buy? He enjoys an advantage only if by waiting he succeeds in buying later at a sufficiently lower price to offset his loss of dividend income. What this means is that timing is of no real value to the investor unless it coincides with pricing, that is, unless it enables him to repurchase his shares as substantially under his previous selling price. In this respect, the famous Dow theory for timing purchases and sales has had an unusual history. Briefly, this technique takes its signal to buy from a special kind of breakthrough of the stock averages on the upside, and its selling signal from a similar breakthrough on the downside. The calculated, not necessarily actual results of using this method showed an almost unbroken series of profits in operations from 1897 to the early 1960s. On the basis of this presentation, the practical value of the Dow theory would have appeared firmly established. The doubt, if any, would apply to the dependability of this published record as a picture of what a Dow theorist would actually have done in the market. A closer study of the figures indicates that the quality of the results shown by the Dow theory changed radically after 1938, a few years after the theory had begun to be taken seriously on Wall Street. Its spectacular achievement had been in giving a sell signal at 306 about a month before the 1929 crash, and in keeping its followers out of the long bear market until things had pretty well righted themselves at 84 in 1933. But from 1938 on, the Dow theory operated mainly by taking its practitioners out at a pretty good price, but then putting them back in again at a higher price. For nearly 30 years thereafter, one would have done appreciably better by just buying and holding the GIA. In our view, based on much study of this problem, the change in the Dow theory results is not accidental. It demonstrates an inherent characteristic of forecasting and trading formulas in the fields of business and finance. Those formulas that gain adherence and importance do so because they have worked well over a period, or sometimes merely because they have been plausibly adapted to the statistical record of the past. But as their acceptance increases, their reliability tends to diminish. This happens for two reasons. First, the passage of time brings new conditions which the old formula no longer fits. Second, in stock market affairs, the popularity of a trading theory has itself an influence on the market's behavior which detracts in the long run from its profit-making possibilities. The popularity of something like the Dow theory may seem to create its own vindication, since it would make the market advance or decline by the very action of its followers when a buying or selling signal is given. A stampede of this kind is, of course, much more of a danger than an advantage to the public trader. Buy low, sell high approach are convinced that the average investor cannot deal success fully with price movements by endeavoring to forecast them. Can he benefit from them after they have taken place by buying after each major decline and selling out after each major advance? The fluctuations of the market over a period of many years prior to 1950 lent considerable encouragement to that idea. In fact, a classic definition of a shrewd investor was one who bought in a bear market when everyone else was selling and sold out in a bull market when everyone else was buying. If we examine our chart covering the fluctuations of the Standard & Poor's Composite Index between 1900 and 1970 and the supporting figures in Table 3-1p66, we can readily see why this viewpoint appeared valid until fairly recent years. Between 1897 and 1949, there were 10 complete market cycles, running from bear market low to bull market high and back to bear market low. 6 of these took no longer than 4 years, 4 ran for 6 or 7 years, and the famous New Era cycle of 19 to 11932 lasted 11 years. The percentage of advance from the lows to highs ranged from 44% to 500%, with most between about 50% and 100%. The percentage of subsequent declines ranged from 24% to 89%, with most found between 40% and 50%. It should be remembered that a decline of 50% fully offsets a preceding advance of 100%. Nearly all the bull markets had a number of well-defined chart characteristics in common, such as 1. A historically high price level, 2. High price or earnings ratios, 3. Low dividend yields as against bond yields, 4. Much speculation on margin, and 5. Many offerings of new common stock issues of poor quality. Thus, to the student of stock market history, it appeared that the intelligent investor should have been able to identify the recurrent bear and bull markets, to buy in the former and sell in the latter, and to do so for the most part at reasonably short intervals of time. Various methods were developed for determining buying and selling levels of the general market, based on either value factors or percentage movements of prices or both. But we must point out that even prior to the unprecedented bull market that began in 1949, there were sufficient variations in the successive market cycles to complicate and sometimes frustrate the desirable process of buying low and selling high. The most notable of these departures, of course, was the great bull market of the late 1920s, which threw all calculations badly out of gear. Even in 1949, therefore, it was by no means a certainty that the investor could base his financial policies and procedures mainly on the endeavor to buy at low levels in bear markets and to sell out at high levels in bull markets. It turned out, in the sequel, that the opposite was true. Though without bear markets to take stock prices back down, anyone waiting to buy low will feel completely left behind and all too often will end up abandoning any former caution and jumping in with both feet. That's why Graham's message about the importance of emotional discipline is so important. From October 1990 through January 2000, the Dow Jones Industrial Average marched relentlessly upward, never losing more than 20% and suffering a loss of 10% or more only 3 times. The total gain, not counting dividends, 395.7%. According to Crandall, Pierce & Co., this was the second longest uninterrupted bull market of the past century. Only the 1949 to 1961 boom lasted longer. The longer a bull market lasts, the more severely investors will be afflicted with amnesia. After 5 years or so, many people no longer believe that bear markets are even possible. All those who forget are doomed to be reminded, and in the stock market, recovered memories are always unpleasant. Markets' behavior in the past 20 years has not followed the former pattern, nor obeyed what once were well-established danger signals, nor permitted its successful exploitation by applying old rules for buying low and selling high. Whether the old, fairly regular bull and bear market pattern will eventually return, we do not know. But it seems unrealistic to us for the investor to endeavor to base his present policy on the classic formula to wait for demonstrable bear market levels before buying any common stocks. Our recommended policy has, however, made provision for changes in the proportion of common stocks to bonds in the portfolio, if the investor chooses to do so, according as the level of stock prices appears less or more attractive by value standards. Formula plans. In the early years of the stock market rise that began in 1949-50, considerable interest was attracted to various methods of taking advantage of the stock market's cycles. These have been known as formula investment plans. The essence of all such plans, except the simple case of dollar averaging, is that the investor automatically does some selling of common stocks when the market advances substantially. In many of them, a very large rise in the market level would result in the sale of all common stock holdings. Others provided for retention of a minor proportion of equities under all circumstances. This approach had the double appeal of sounding logical and conservative and of showing excellent results when applied retrospectively to the stock market over many years in the past. Unfortunately, its vogue grew greatest at the very time when it was destined to work least well. Many of the formula planners found themselves entirely or nearly out of the stock market at some level in the middle 1950 seconds. True, they had realized excellent profits, but in a broad sense, the market ran away from them thereafter, and Graham discusses this recommended policy in chapter for pp. 89-91. This policy, now called tactical asset allocation, is widely followed by institutional investors like pension funds and university endowments. Their formulas gave them little opportunity to buy back a common stock position. There is a similarity between the experience of those adopting the formula investing approach in the early 1950s and those who embraced the purely mechanical version of the Dow theory some 20 years earlier. In both cases, the advent of popularity marked almost the exact moment when the system ceased to work well. We have had a discomforting experience with our own central value method of determining indicated buying and selling levels of the Dow Jones Industrial Average. The moral seems to be that any approach to money making in the stock market which can be easily described and followed by a lot of people is by its terms too simple and too easy to last. T. Spinoza's concluding remark applies to Wall Street as well as to philosophy. All things excellent are as difficult as they are rare. Market fluctuations of the investor's portfolio. Every investor who owns common stocks must expect to see them fluctuate in value over the years. The behavior of the GIA since our last edition was written in 1964 probably reflects pretty well what has happened to the stock portfolio of a conservative investor who limited his stock holdings to those of large, prominent, and conservatively financed corporations. The overall value advanced from an average level of about 890 to a high of 995, and many of these formula planners would have sold all their stocks at the end of 1954 after the U.S. stock market rose 52.6%, the second highest yearly return then on record. Over the next 5 years, these market timers would likely have stood on the sidelines as stocks doubled. Plus, easy ways to make money in the stock market fade for two reasons: the natural tendency of trends to reverse over time or regress to the mean, and the rapid adoption of the stock picking scheme by large numbers of people who pile in and spoil all the fun of those who got there first. Note that, in referring to his discomforting experience, Graham is as always honest in admitting his own failures. See Jason Zweig, Murphy Was an Investor, Money, July 2002, pp. 61-62, and Jason Zweig, New Year's Play, Money, December 2000, pp. 89-90. 1966 and 985 again in 1968, fell to 631 in 1970, and made an almost full recovery to 940 in early 1971. Since the individual issues set their high and low marks at different times, the fluctuations in the Dow Jones Group as a whole are less severe than those in the separate components. We have traced through the price fluctuations of other types of diversified and conservative common stock portfolios, and we find that the overall results are not likely to be markedly different from the above. In general, the shares of second-line companies fluctuate more widely than the major ones, but this does not necessarily mean that a group of well-established but smaller companies will make a poorer showing over a fairly long period. In any case, the investor may as well resign himself in advance to the probability rather than the mere possibility that most of his holdings will advance, say 50% or more from their low point, and decline the equivalent 1/3 or more from their high point at various periods in the next 5 years. A serious investor is not likely to believe that the day-to-day or even month-to-month fluctuations of the stock market make him richer or poorer. But what about the longer term and wider changes? Here, practical questions present themselves, and the psychological problems are likely to grow complicated. A substantial rise in the market is at once a legitimate reason for satisfaction and a cause for prudent concern, but it may also bring a strong tempt to tie in toward imprudent action. Your shares have advanced, good. Today's equivalent of what Graham calls second-line companies would be any of the thousands of stocks not included in the Standard & Poor's 500 stock index. A regularly revised list of the 500 stocks in the S&P index is available at www.standardandpoors.com. Plus, note carefully what Graham is saying here. It is not just possible, but probable that most of the stocks you own will gain at least 50% from their lowest price and lose at least 33% from their highest price, regardless of which stocks you own or whether the market as a whole goes up or down. If you can't live with that, or you think your portfolio is somehow magically exempt from it, then you are not yet entitled to call yourself an investor. Graham refers to a 33% decline as the equivalent 1/3 because a 50% gain takes a $10 stock to $15. From $15, a 33% loss or $5 drop takes it right back to $10, where it started. You are richer than you were. Good. But has the price risen to high, and should you think of selling? Or should you kick yourself for not having bought more shares when the level was lower? Or worst thought of all, should you now give way to the bull market atmosphere, become infected with the enthusiasm, the overconfidence, and the greed of the great public of which, after all, you are a part, and make larger and dangerous commitments? Presented thus in print, the answer to the last question is a self-evident no, but even the intelligent investor is likely to need considerable willpower to keep from following the crowd. It is for these reasons of human nature, even more than by calculation of financial gain or loss, that we favor some kind of mechanical method for varying the proportion of bonds to stocks in the investor's portfolio. The chief advantage, perhaps, is that such a formula will give him something to do. As the market advances, he will from time to time make sales out of his stock holdings, putting the proceeds into bonds. As it declines, he will reverse the procedure. These activities will provide some outlet for his otherwise to pent-up energies. If he is the right kind of investor, he will take added satisfaction from the thought that his operations are exactly opposite from those of the crowd. Business valuations versus stock market valuations. The impact of market fluctuations upon the investor's true situation may be considered also from the standpoint of the shareholder as the part owner of various businesses. The holder of marketable shares actually has a double status, and with it the privilege of taking advantage of either at his choice. On the one hand, his position is analogous to that of a minority shareholder or silent partner in a private business. Here, his results are entirely dependent on the profits of the enterprise or on a change in the underlying value of its assets. He would usually determine the value of such a private business interest by calculating his share of the net worth as shown in the most recent balance sheet. Other hand, the common stock investor holds a piece of paper, an engraved stock certificate, which can be sold in a matter of minutes at a price which varies from moment to moment when the market is open, that is, and often is far removed from the balance sheet value. The development of the stock market in recent decades has made the typical investor more dependent on the course of price quotations and less free than formerly to consider himself merely a business owner. The reason is that the successful enterprises in which he is likely to concentrate his holdings sell almost constantly at prices well above their net asset value or book value or balance sheet value. In paying these market premiums, the investor gives precious hostages to fortune, for he must depend on the stock market itself to validate his commitments. Plus, this is a factor of prime importance in present-day investing, and it has received less attention than it deserves. The whole structure of stock market quotations contains a built-in contradiction. The better a company's record and prospects, the less relationship the price of its shares will have to their book value. But the greater the premium above book value, the less certain the basis of determining its intrinsic value the more this value will depend on the changing moods and measurements of the stock market. Thus, we reach the final paradox that the more successful the company, the greater are likely to be the fluctuations in the price of its shares. This really means that, in a very real sense, the better the most companies today provide an engraved stock certificate only upon special request. Stocks exist, for the most part, in purely electronic form, much as your bank account contains computerized credits and debits, not actual currency, and thus have become even easier to trade than they were in Graham's day. Plus, net asset value, book value, balance sheet value, and tangible asset value are all synonyms for net worth, or the total value of a company's physical and financial assets minus all its liabilities. It can be calculated using the balance sheets in a company's annual and quarterly reports from total shareholders' equity, subtract all soft assets such as goodwill, trademarks, and other intangibles. Divide by the fully diluted number of shares outstanding to arrive at book value per share. Quality of a common stock. The more speculative it is likely to be, at least as compared with the unspectacular middle grade issues. What we have said applies to a comparison of the leading growth companies with the bulk of well-established concerns. We exclude from our purview here those issues which are highly speculative because the businesses themselves are speculative. The argument made above should explain the often erratic price behavior of our most successful and impressive enterprises. Our favorite example is the monarch of them all, International Boosie Nest Machines. The price of its shares fell from 607 to 307 months in 1962-63. After two splits, its price fell from 387 to 219 in 1970. Similarly, Xerox, an even more impressive earnings gainer in recent decades, fell from 171 to 87 in 1962-63 and from 116 to 65 in 1970. These striking losses did not indicate any doubt about the future long-term growth of IBM or Xerox. They reflected instead a lack of confidence in the premium valuation that the stock market itself had placed on these excellent prospects. The previous discussion leads us to a conclusion of practical importance to the conservative investor in common stocks. If he is to pay some special attention to the selection of his portfolio, it might be best for him to concentrate on issues selling at a reasonably close approximation to their tangible asset value, say at not more than 1/3 above that figure. Purchases made at such levels or lower may with logic be regarded as related to the Graham's use of the word paradox is probably an allusion to a classic article by David Durant, Growth Stocks and the Petersburg Paradox, the Journal of Finance, Vol. 12, number 3, September 1957, pp. 348-363, which compares investing in high-priced growth stocks to betting on a series of coin flips in which the payoff escalates with each flip of the coin. Durant points out that if a growth stock could continue to grow at a high rate for an indefinite period of time, an investor should in theory be willing to pay an infinite price for its shares. Why then has no stock ever sold for a price of infinity dollars per share? Because the higher the assumed future growth rate and the longer the time period over which it is expected, the wider the margin for error grows and the higher the cost of even a tiny miscalculation becomes. Graham discusses this problem further in Appendix 4 p. 570, Company's Balance Sheet, and as having a justification or support independent of the fluctuating market prices. The premium over book value that may be involved can be considered as a kind of extra fee paid for the advantage of stock exchange listing and the marketability that goes with it. A caution is needed here. A stock does not become a sound investment merely because it can be bought at close to its asset value. The investor should demand, in addition, a satisfactory ratio of earnings to price, a sufficiently strong financial position, and the prospect that its earnings will at least be maintained over the years. This may appear like demanding a lot from a modestly priced stock, but the prescription is not hard to fill under all but dangerously high market conditions. Once the investor is willing to forgo brilliant prospects by better than average expected growth, he will have no difficulty in finding a wide selection of issues meeting these criteria. In our chapters on the selection of common stocks, chapters 14 and 15, we shall give data showing that more than half of the GIA issues met our asset value criterion at the end of 1970. The most widely held investment of all, American Tel, and Tel actually sells below its tangible asset value as we write. Most of the Light and Power shares, in addition to their other advantages, are now early 1972 available at prices reasonably close to their asset values. The investor with a stock portfolio having such book values behind it can take a much more independent and detached view of stock market fluctuations than those who have paid high multipliers of both earnings and tangible assets. As long as the earning power of his holdings remains satisfactory, he can give as little attention as he pleases to the vagaries of the stock market. More than that, at times he can use these vagaries to play the master game of buying low and selling high. The AMP example. At this point, we shall introduce one of our original examples, which dates back many years, but which has a certain fascination for us because it combines so many aspects of corporate and investment experience. It involves the Great Atlantic and Pacific Tea Co. Here is the story. AMP shares were introduced to trading on the curb market, now the American Stock Exchange, in 1929 and sold as high as $494. By 1932, they had declined to 104, although the company's earnings were nearly as large in that generally catastrophic year as previously. In 1936, the range was between 111 and 131. Then in the Boosie-Ness recession and bear market of 1938, the shares fell to a new low of 36. That price was extraordinary. It meant that the preferred and common were together selling for $126 million, although the company had just reported that it held $85 million in cash alone and a working capital or net current assets of $134 million. A&P was the largest retail enterprise in America, if not in the world, with a continuous and impressive record of large earnings for many years. Yet in 1938, this outstanding business was considered on Wall Street to be worth less than its current assets alone, which means less as a going concern than if it were liquidated. Why? First, because there were threats of special taxes on chain stores. Second, because net profits had fallen off in the previous year. And third, because the general market was depressed. The first of these reasons was an exaggerated and eventually groundless fear. The other two were typical of temporary influences. Let us assume that the investor had bought A&P common in 1937 at, say, 12 times its 5-year average earnings, or about 80. We are far from asserting that the ensuing decline to 36 was of no importance to him. He would have been well advised to scrutinize the picture with some care to see whether he had made any miscalculations. But if the results of his study were reassuring as they should have been, he was entitled then to disregard the market decline as a temporary vagary of finance, unless he had the funds and the courage to take advantage of it by buying more on the bargain basis offered. Sequel and reflections. Following year, 1939, A&P shares advanced to 117%, or 3 times the low price of 1938 and well above the average of 1937. Such a turnabout in the behavior of common stocks is by no means uncommon, but in the case of A&P it was more striking than most. In the years after 1949, the grocery chain shares rose with the general market until in 1961 the split-up stock 10 for 1 reached a high of 70%, which was equivalent to 705 for the 1938 shares. This price of 70% was remarkable for the fact it was 30 times the earnings of 1961. Such a price or earnings ratio, which compares with 23 times for the GIA in that year, must have implied expectations of a brilliant growth in earnings. This optimism had no justification in the company's earnings record in the preceding years, and it proved completely wrong. Instead of advancing rapidly, the course of earnings in the ensuing period was generally downward. The year after the 70% high, the price fell by more than half to 34. But this time, the shares did not have the bargain quality that they showed at the low quotation in 1938. After varying sorts of fluctuations, the price fell to another low of 21% in 1970 and 18 in 1972, having reported the first quarterly deficit in its history. We see in this history how wide can be the vicissitudes of a major American enterprise in little more than a single generation, and also with what miscalculations and excesses of optimism and pessimism the public has valued its shares. In 1938, the business was really being given away, with no takers. In 1961, the public was clamoring for the shares at a ridiculously high price. After that came a quick loss of half the market value, and some years later a substantial further decline. In the meantime, the company was to turn from an outstanding to a mediocre earnings performer. Its profit in the boom year 1968 was to be less than in 1958. It had paid a series of confusing small stock dividends not warranted by the current additions to surplus, and so forth. A&P was a larger company in 1961 and 1972 and in 1938, but not as well run, not as profitable, and not as attractive. There are 2 chief morals to this story. The first is that the stock market often goes far wrong, and sometimes in alert and cura. The more recent history of A&P is no different. At year-end 1999, its share price was $27.875. At year-end 2000, $7.0. A year later, $23.78. At year-end 2002, 8. Although some accounting irregularities later came to light at A&P, it defies all logic to believe that the value of a relatively stable business like groceries could fall by 3/4 in 1 year, triple the next year, then drop by 2/3 the year after that. GIA's investor can take advantage of its patent errors. The other is that most businesses change in character and quality over the years, sometimes for the better, perhaps more often for the worse. The investor need not watch his company's performance like a hawk, but he should give it a good, hard look from time to time. Let us return to our comparison between the holder of marketable shares and the man with an interest in a private business. We have said that the former has the option of considering himself merely as the part owner of the various businesses he has invested in, or as the holder of shares which are saleable at any time he wishes at their quoted market price. But note this important fact: the true investor scarcely ever is forced to sell his shares, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book, and no more. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment. Incidentally, a widespread situation of this kind actually existed during the Dark Depression days of 1931 to 1933. There was then a psychological advantage in owning business interests that had no quoted market. For example, people who own first mortgages on real estate that continued to pay interest were able to tell themselves that their investments had kept their full value, there being no market quotations to indicate otherwise. On the other hand, many listed corporation bonds of even better quality and greater, only to the extent that it suits his book, means only to the extent that the price is favorable enough to justify selling the stock. In traditional brokerage lingo, the book is an investor's ledger of holdings and trades, plus. This may well be the single most important paragraph in Graham's entire book. In these 113 words, Graham sums up his lifetime of experience. You cannot read these words too often. They are like kryptonite for bear markets. If you keep them close at hand and let them guide you throughout your investing life, you will survive whatever the markets throw at you. Underlying strengths suffered severe shrinkages in their market quotations, thus making their owners believe they were growing distinctly poorer. In reality, the owners were better off with the listed securities despite the low prices of these. For if they had wanted to, or were compelled to, they could at least have sold the issues, possibly to exchange them for even better bargains. Or they could just as logically have ignored the market's action as temporary and basically meaningless. But it is self-deception to tell yourself that you have suffered no shrinkage in value merely because your securities have no quoted market at all. Returning to our A&P shareholder in 1938, we assert that as long as he held onto his shares, he suffered no loss in their price decline, beyond what his own judgment may have told him was occasioned by a shrinkage in their underlying or intrinsic value. If no such shrinkage had occurred, he had a right to expect that in due course, a market quotation would return to the 1937 level or better, as in fact it did the following year. In this respect, his posy tie-in was at least as good as if he had owned an interest in a private business with no quoted market for its shares. For in that case, too, he might or might not have been justified in mentally lopping off part of the cost of his holdings because of the impact of the 1938 recession, depending on what had happened to his company. Critics of the value approach to stock investment argue that listed common stocks cannot properly be regarded or appraised in the same way as an interest in a similar private enterprise because the presence of an organized security market injects into equity ownership the new and extremely important attribute of liquidity. But what this liquidity really means is, first, that the investor has the benefit of the stock market's daily and changing appraisal of his holdings for whatever that appraisal may be worth, and second, that the investor is able to increase or decrease his investment at the market's daily figure if he chooses. Thus, the existence of a quoted market gives the investor certain options that he does not have if his security is unquoted. But it does not impose the current quotation on an investor who prefers to take his idea of value from some other source. Let us close this section with something in the nature of a parable. Imagine that in some private business you own a small share that cost you $1,000. One of your partners, named Mr. Market, is very obliging indeed. Every day he tells you what he thinks your interest is worth and furthermore offers either to buy you out or to sell you an additional interest on that basis. Sometimes his idea of value appears plausible and justified by business developments and prospects as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems to you a little short of silly. If you are a prudent investor or a sensible businessman, will you let Mr. Market's daily communication determine your view of the value of a $1,000 interest in the enterprise? Only in case you agree with him or in case you want to trade with him. You may be happy to sell out to him when he quotes you a ridiculously high price and equally happy to buy from him when his price is low. But the rest of the time you will be wiser to form your own ideas of the value of your holdings based on full reports from the company about its operations and financial position. The true investor is in that very position when he owns a listed common stock. He can take advantage of the daily market price or leave it alone as dictated by his own judgment and inclination. He must take cognizance of important price movements, for otherwise his judgment will have nothing to work on. Conceivably, they may give him a warning signal, which he will do well to heed. This in plain English means that he is to sell his shares because the price has gone down, foreboding worse things to come. In our view, such signals are misleading at least as often as they are helpful. Basically, price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. At other times, he will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. Summarize most realistic distinction between the investor and the speculator is found in their attitude towards stock market movements. The speculator's primary interest lies in anticipating and profiting from market fluctuation. The investor's primary lies in acquiring and holding suitable securities at suitable prices. Market movements are important to him in a practical sense because they alternately create low price levels at which he would be wise to buy and high price levels at which he certainly should refrain from buying and probably would be wise to sell. It is far from certain that the typical investor should regularly hold off buying until low market levels appear, because this may involve a long wait, very likely the loss of income, and the possible missing of investment opportunities. On the whole, it may be better for the investor to do his stock buying whenever he has money to put in stocks, except when the general market level is much higher than can be justified by well-established standards of value. If he wants to be shrewd, he can look for the ever-present bargain opportunities in individual securities. Aside from forecasting the movements of the general market, much effort and ability are directed on Wall Street towards selecting stocks or industrial groups that in matter of price will do better than the rest over a fairly short period in the future. Logical as this endeavor may seem, we do not believe it is suited to the needs or temperament of the true investor, particularly since he would be competing with a large number of stock market traders and first-class financial analysts who are trying to do the same thing. As in all other activities that emphasize price movements first and underlying values second, the work of many intelligent minds constantly engaged in this field tends to be self-neutralizing and self-defeating over the years. The investor with a portfolio of sound stocks should expect their prices to fluctuate and should neither be concerned by sizable declines nor become excited by sizable advances. He should always remember that market quotations are there for his convenience, either to be taken advantage of or to be ignored. He should never buy a stock because it has gone up or sell one because it has gone down. He would not be far wrong if this motto read more simply: never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. An added consideration should be said about the significance of average market prices as a measure of managerial competence. The shareholder judges whether his own investment has been successful in terms both of dividends received and of the long-range trend of the average market value. The same criteria should logically be applied in testing the effectiveness of a company's management and the soundness of its attitude toward the owners of the business. This statement may sound like a truism, but it needs to be emphasized. For as yet, there is no accepted technique or approach by which management is brought to the bar of market opinion. On the contrary, managements have always insisted that they have no responsibility of any kind for what happens to the market value of their shares. It is true, of course, that they are not accountable for those fluctuations in price which, as we have been insisting, bear no relationship to underlying conditions and values. But it is only the lack of alertness and intelligence among the rank and file of shareholders that permits this immunity to extend to the entire realm of market quotations, including the permanent establishment of a depreciated and unsatisfactory price level. Good managements produce a good average market price, and bad managements produce bad market prices. Fluctuations in bond prices, the investor should be aware that even though safety of its principal and interest may be unquestioned, a long-term bond could vary widely in market price in response to changes in interest rates. In Table 8-1, we give data for various years back to 1902 covering yields for high-grade corporate and tax-free issues. As individual illustrations, we add the price fluctuations of two representative railroad issues for a similar period. These are the Atchison, Topeka, and Santa Fe General Mortgage for seconds, due 1995, for generations, one of our premier non-callable bond issues, and the Northern Pacific Rye. 3 seconds, due 2047, originally a 150-year maturity, long a typical BAA-rated bond. Because of their inverse relationship, the low yields correspond to the high prices and vice versa. The decline in the Northern has much more to say on what is now known as corporate governance. See the commentary on Chapter 19. Pacific 3 seconds in 1940 represented mainly doubts as to the safety of the issue. It is extraordinary that the price recovered to an all-time high in the next few years, and then lost 2/3 of its price chiefly because of the rise in general interest rates. There have been startling variations as well in the price of even the highest grade bonds in the past 40 years. Note that bond prices do not fluctuate in the same inverse proportion as the calculated yields because their fixed maturity value of 100% exerts a moderating influence. However, for very long maturities, as in our Northern Pacific example, prices and yields change at close to the same rate. Since 1960, record movements in both directions have taken place in the high-grade bond market. Taking prime municipals tax-free as an example, their yield more than doubled from 3.2% in January 1965 to 7% in June 1970. Their price index declined correspondingly from 110.8 to 67.5. In mid-1970, the yields on high-grade long-term bonds were higher than at any time in the nearly 200 years of this country's economic history. 25 years earlier, just before our protracted bull market began, bond yields were at their lowest point in history. Long-term municipals returned as little as 1%, and industrials gave 2.4% compared with the 4% to 5% formerly considered normal. Those of us with a long experience on Wall Street had seen Newton's law of action and reaction, equal and opposite, work itself out repeatedly in the stock market, the most noteworthy example being the rise in the GIA from 64 in 1921 to 381 in 1929, followed by a record collapse to 41 in 1932. But this time, the widest pendulum swings took place in the usually staid and slow-moving array of high-grade bond prices and yields. Moral: nothing important on Wall Street can be counted on to occur exactly in the same way as it happened before. This reprey by what Graham called the rule of opposites. In 2002, the yields on long-term U.S. Treasury bonds hit their lowest levels since 1963. Since bond yields move inversely to prices, those low yields meant that prices had risen, making investors most eager to buy just as bonds were at their most expensive and as their future returns were almost guaranteed to be low. This provides another proof of Graham's lesson that the intelligent refuse to make decisions based on market fluctuations. Since the first half of our favorite dictum, the more it changes, the more it's the same thing. If it is virtually impossible to make worthwhile predictions about the price movements of stocks, it is completely impossible to do so for bonds. In the old days, at least, one could often find a useful clue to the coming end of a bull or bear market by studying the prior action of bonds, but no similar clues were given to a calming change in interest rates and bond prices. Hence, the investor must choose between long-term and short-term bond investments on the basis chiefly of his personal preferences. If he wants to be certain that the market values will not decrease, his best choices are probably U.S. savings bonds, Series E or H, which were described above, Pete 93. Either issue will give him a 5% yield after the first year, the Series E for up to 5% years, the Series H for up to 10 years, with a guaranteed resale value of cost or better. If the investor wants the 7.5% now available on good long-term corporate bonds, or the 5.3% on tax-free municipals, he must be prepared to see them fluctuate in price. Banks and insurance companies have the privilege of valuing high-rated bonds of this type on the mathematical basis of amortized cost, which disregards market prices. It would not be a bad idea for the individual investor to do something similar. The price fluctuations of convertible bonds and preferred stocks are the resultant of three different factors: 1, variations in the price of the related common stock; 2, variations in the credit standing of the company; and 3, variations in general interest rates. A good many of the convertible issues have been sold by companies that have credit ratings well below the best. Some of these were badly affected by the financial squeeze in 1970. As a result, convertible issues as a whole have been subjected to triply unsettling influences in recent years, and price variations have been unusually wide. In the typical case, therefore, the investor would delude himself if he expected to find in convertible issues that ideal combination of the safety of a high-grade bond and price. An updated analysis for today's readers explaining recent yields and the wider variety of bonds and bond funds available today can be found in the commentary on Chapter 4, Protection plus a chance to benefit from an advance in the price of the common. This may be a good place to make a suggestion about the long-term bond of the future. Why should not the effects of changing interest rates be divided on some practical and equitable basis between the borrower and the lender? One possibility would be to sell long-term bonds with interest payments that vary with an appropriate index of the going rate. The main results of such an arrangement would be, 1. The investor's bond would always have a principal value of about 100 if the company maintains its credit rating, but the interest received will vary, say, with the rate offered on conventional new issues. 2. The corporation would have the advantages of long-term debt being spared problems and costs of frequent renewals of refinancing, but its interest costs would change from year to year. Over the past decade, the bond investor has been confronted by an increasingly serious dilemma. Shall he choose complete stability of principal value, but with varying and usually low short-term interest rates? Or shall he choose a fixed interest income with considerable variations, usually downward, it seems, in his principal value? It would be good for most investors if they could compromise between these extremes and be assured that neither their interest return nor their principal value will fall below a stated minimum over, say, a 20-year period. This could be arranged without great difficulty in an appropriate bond contract of a new form. Important note, in effect, the U.S. government has done a similar thing in its combination of the original savings bonds contracts with their extensions at higher interest rates. The suggestion we make here would cover a longer fixed investment period than the savings bonds and would introduce more flexibility in the interest rate provisions. It is hardly worthwhile to talk about non-convertible preferred stocks, since their special tax status makes the safe ones much more desirable holdings by corporations, for example, insurance companies. As mentioned in the commentary on Chapters 2 and 4, Treasury Inflation Protected Securities, or TIPS, are a new and improved version of what Graham is suggesting here, than by individuals. The poorer quality ones almost always fluctuate over a wide range, percentage-wise, not too differently from common stocks. We can offer no other useful remark about them. Table 16-2 below, peak 406, gives some information on the price changes of lower-grade non-convertible preferreds between December 1968 and December 1970. The average decline was 17% against 11.3% for the S&P Composite Index of common stocks.